trade zero. And now, please welcome Benzinga's Executive Vice President, Patrick Lane.
Good morning, good morning, good morning. Welcome, welcome, welcome. I'm Patrick Lane. It's great to see so many familiar faces here at now the 10th year that we've been running this Fintech Deal Day and Awards. And of course, our future of digital assets downstairs. I'd like to introduce Andrew Lebos, our Senior Vice President of Content Licensing. Andrew, say hello.
Good morning, everyone. Thank you for coming. See a lot of API partners out in the crowd. Appreciate you guys coming. Appreciate your business. If you guys want to learn more about Benzinga APIs, stop by our booth and stop by all of the booths. Today, we're here to celebrate innovation in fintech, and all of our partners are changing the way that we do money.
Well said, Andrew. And for anybody who doesn't know Benzinga, I'm sure most of you do. We're the #1 provider of news and data to the North American brokerage space. A lot of the financial media companies out there are powered by Benzinga news and data sources. So thank you, Andrew. Very much appreciated. Go check out the booth right outside, Benzinga APIs. And for those of you tuning in at home, watching our live stream, let us know how we're doing. Give us a comment. Let us know what you like, what you're interested in. We will follow up with you after this as well. Thanks, Andrew. Much appreciated. I'd like to welcome out Benzinga's CEO, recently joined, Jerry Ferrara. Come on out. Let's give Jerry a round of applause, please.
Thanks, Patrick. Hi, everyone. I just wanted to say thank you for joining us today. Without all of you, there would be no Benzinga, so it's greatly appreciated. We have a great event today filled with terrific insights and actionable content. Really, this is one of the most, if not the most, innovative time in our industry, and so it's fantastic to get everyone in a room like this and get to these insights. So thanks again, and congrats to the awards finalists as well. Those will be announced at the end of the day. And again, that was the number of applications we got was just crazy.
Outstanding.
And tons of innovation. So thanks again. We appreciate it, and let's have a great day.
There we go. Thank you. Thanks, Jerry. I'll take that. There we go. Next up, I'd like to welcome Sean Kozak, CEO of TickBlaze. TickBlaze is one of our premium partners here at the conference today. Sean, you want to say a few words to our friends here?
Good morning. How's everybody doing? Okay. It's a pleasure to welcome you all here today. The energy in here is quite incredible. It's a dynamic event. We're glad to be a part of it. My name is Sean Kozak. I'm the CEO of TickBlaze. We're thrilled to be one of the sponsors here, to be able to participate with such an innovative group of people. We're here today to witness the incredible strides that everybody here has accomplished in fintech, and technology is transforming trading and finance. It's a moment for brokers, institutions, hedge funds, platforms, prop firms to come together and share ideas and build connections and pave the way in which we partner, right? So I want to give a thanks to Benzinga for putting on this conference. We share a common mission in that technology should be accessible to everyone. And by sponsoring this conference, we're here to show how we can innovate with traders and partners to be able to thrive in a competitive landscape. So get ready for a day packed with insights and opportunities from some of the speakers and some of the participants. And make sure you come by our booth and meet my team and I, and we'll be able to make this an event to remember. Take care, everybody.
Thanks very much, Sean. Much appreciated. Next up, I get to bring out two people I'm sure you're already familiar with. Come on out. We've got Jamie Rackover, CRO, and Roy McKaylee, CEO, the co-founders of Winston AI, with a pretty cool announcement, gents. By the way, I like that hat, Jamie. We got to get one of those hats.
Well, first of all, we're super excited to be here, and it's been an incredible year for us. At Winston, we're building AI-driven platforms for publishers and brokers and financial institutions to improve the experience and impact through the entire funnel, from acquisition through the platform engagement and retentions of brokers. Our first tool, Winston Markets, is a portfolio assistant that can help you personalize your investments, use real-time data and insights to optimize your portfolio. We also provide Winston Connect, which is an industry standard for advanced AI tool required transparency and compliance awareness. So Winston is not just a tool. It's a way for us to boost user experience. Differentiate your platform and future-proof your business with the competitive market. So we're thrilled to be here.
We'd also like to announce today Benzinga AI, which just launched right now and is available inside of Pro. So if you don't already have a Pro subscription, please do sign up for Benzinga Pro. It will also be rolling out to content widgets throughout the site, where Winston will kind of read an article, suggest some follow-up questions, and allow you to do further research through our tool. So please come by our booth, meet Winston. We have a game we're playing where you have an opportunity to win Ray-Ban Meta AI sunglasses by competing for a portfolio. So hope to meet you all later. And thanks again, Benzinga, for having us.
Thank you very much.
Our pleasure. Thank you, gents. Thank you. Thank you. We're growing up around here, my friends. We're growing up, and I'm sure a lot of the companies that are familiar with Benzinga is seeing that maturity in action. My friends in the doorway, feel free to come in and grab a seat. We're going to be here a while. Next up, I get to introduce some friends, longtime friends of pretty much all of us in this industry, to talk about the state of fintech, a decade of disruption and connection. We've got Bill Capuzzi, the CEO of Apex Fintech Solutions, led by Sarah Biller, co-founder of Fintech Sandbox. Let's give it up for our friends. Come on out.
Good morning. Can everybody hear me? Okay. I guess it's no confusion. I'm Sarah and this is Bill. And we're really excited to kick you all off because I do think at this moment of financial services and fintech, we banter around words like unprecedented, never before seen, new era of digital investing. And I can't think of a better person for me to talk to about that than Bill Capuzzi.
Yeah.
Bill, welcome to the stage.
Yeah, thanks so much for having me. Thank you to the Benzinga folks. This amazing, we were talking about how many people registered for the 650. And I think about the first year they did this and where it was then versus where it is now. It's pretty amazing. So congrats to the Benzinga crew.
Yeah, we think Bitcoin was trading about 75 cents, but we're going to see how that goes. But Bill, just kind of quickly, you're the CEO of Apex, which we're going to dive into and your thoughts there. But you're also many other things. You're an industry veteran. You're an investor in fintech yourself. You're really putting your money where your thoughts are, I think, on a daily basis. You're a father of 4. I was really surprised to figure out where you had time to do that. But I want to really, if we may, just dive in a little bit to the Apex story. There's no question that part of the rise of fintech is because of infrastructure and the ability to actually create frictionless and seamless investing kind of from the back to the middle to the front office.
Yep.
You've been an industry leader there. Do you want to kind of talk us through some of the milestones that you've seen in the company?
Yeah, sure. I mean, first of all, show of hands, how many people actually know Apex? All right, most hands went up. We started the company now 12 years ago, and I think the cool part for me is sitting here. We have these town halls every month, and I asked somebody from the 900 people that work at Apex now, what's the purpose of the company? And it hasn't changed in now 12 years, which is how do we help every person on the planet invest? The second thing I talk to, especially the client-facing side for Apex, is always got to work on solving a hard problem. Right? And those are the kind of 2 ethos for Apex when we started the company 12 years ago is, right, mantra around, okay, we're going to help people that haven't had a chance to invest, right? There's ages old, there's decades old kind of precedent around helping people that have a lot of money. What about the people that don't have a lot of money, right? The mass affluent and down. And that's how we started the company back when, 12 years ago. I think along the way, the second part is solve hard problems, right? So, the advent of Robo started with Apex, right? And now it's kind of, it's commonplace, but back, 12 years ago, Wealthfront Betterment, they needed a partner that was going to lean into how this Robo thing was going to happen. Zero commission with our friends at Robinhood started with Apex. Fractional share trading, now fractional fixed income trading, things like 24/7 access to the US markets. And so along the way, I want to say we're really clairvoyant and really strategic and we can see the future. But the reality is you got to solve clients' hard problems. We are infrastructure, think of us as a platform, right? Amazon of sorts for investing. And the focus for us is really around listening to our clients and responding to what their needs are.
Yeah, Bill, I'd say you've done that in spades. For those who don't know Apex by the numbers, 19 million and growing accounts on the platform, 170 plus companies. What really can you attribute to that incredible growth? I mean, to get to that level in just over a decade is astounding.
Yeah, look, I think it goes to what I said in the beginning, which is partnering with a bunch of partners in the room. Dan, it's partnering with folks that have mutual interests, which is right. How are we going to help every person on the planet invest? Right, we do our part, which is all the guts, the plumbing behind the scenes, right, from account opening through settling trades and confirms and statements and cost basis, tax reporting. And our client's job is to engage that end customer, right? And when you think about how hard it is to do what we do, you kind of connect those dots, and it's sort of this perfect marriage, just in terms of their focus, right? In terms of take Tradier. Tradier's focus on providing a great end client service, and for Apex to do all those things behind the scenes.
Yeah, Bill, thank you for that. You talk about doing the right thing for the customer, the contemplation of how to bring more individuals into contemporary capital markets. But you mentioned a lot of firms that you've supported that arguably are disruptors.
Yeah.
Robinhood as one example. And, I think there's a lot of argument in this room that we as innovators are in this period of disrupting the traditional way that wealth creation happens, that investment happens. I take a different stance. I'm also an academic. I teach at Brandeis, and I teach in my class that we're really 3,000 years into this evolution of the industry, adopting the latest technology. Of course, that belies the fact that more and more data is available to us every day. How do you see things?
Yeah, look, I think you think about the folks that are in the room and the things you're building, the things you're offering out to the fintech community. The acceleration over the course of the last 10 years has been remarkable, right? Now we have AI coming in. The acceleration for the next 10 years is going to be even more remarkable. But you think about, this, let's just take the last 5 years, right? The pandemic and what it did for this room, right? It's pretty amazing, right? Everyone was at home, right? Couldn't go to work. There was no sports to watch or bet on. And there was, government stimulus. And then at the same time, we were offering the ability, this room was offering the ability to access, whether it's, payments, whether it's investing, banking, amazing. The explosion of opportunity for us. So let's go back to our purpose, which is help every person on the planet invest. We were opening 1 million accounts in a weekend.
Crazy.
During 2021. And that's amazing, right? Now we have work to do. There's a lot more to do, but it's pretty amazing the acceleration, a lot of it driven by the technology, innovation, disruption in the room over the course of the last 5 years. And it's amazing, show of hands, how many people are working with AI? I presume everyone's hands goes up. The opportunity for us to leverage the large language models to continue sort of this kind of upswing in terms of opportunity is pretty amazing.
Yeah. Bill, I hear that, and I just every day thinking about those individuals that you're empowering, those million people who came online during a period of COVID. It was a huge, obviously an accelerant. The ability, I'm sitting here with my phone today. I can do more trading on my phone today at a cheaper cost than I could when I was sitting in a large institutional asset manager on the desk. Do you view this sort of shift towards the application of AI and other emerging technologies as a positive, a negative, or both? And if I could double click for a minute, the reason I ask that is because we will create ostensibly a period for some time of digital divide. Individuals who understand how to get onto your system, how to participate in the capital markets, the implications, good and bad, of AI in decisioning. What's your view on the whole sort of period of adoption, rapid adoption of technology.
Yeah, look, overall, it's amazing, right?
Yeah, for sure.
Let's start with the sort of not so great. So we're in the world of investing, retail investing, right? And you have things like meme stocks, right? And there was a run this year on meme stocks, right? And it's bad information that's being pushed out, through channels. I don't wanna make a bad word for Reddit, but there's channels out there that are pushing information to retail investors and then driving behavior that's not necessarily in the best interest, I think, of a long-term investment strategy. So part of this is around education. We as an industry have to do and continue to lean into being better around educating people on how to properly invest. So that's a place where I think we have plenty of opportunity to run. On the other side, the positive side is like amazing, right? It's amazing. We lower the barriers. Think about this room and all the things that you've done. To allow people with $100 to invest. Open an account, you said on your phone, be able to put $100 in and start investing, right? Was impossible to do. I'm looking at rough ages in the room here. It was impossible to do when I was a 22-year-old kid. Impossible. There was no chance. There's no such thing as fractional shares. There was no online anything. It was a rigged system for people that had a lot of money. And so you fast forward to today, I think we've done a great job as an industry lowering that barrier to entry. I do think there's a lot of work to do to sort of advance in terms of the investment thesis around helping people, retail investors, make proper decisions around investing now.
Yeah, Bill, I love that because it speaks to a future that's brighter, that's better, that actually is good for business because you're expanding the opportunity for new customers to come on. Let's really contemplate the future. It's hard to believe that we only had a few minutes to dive into your wealth of thinking.
Yeah.
I'm going to leave here inspired, and I think everyone else will, about what is possible. But let's just really think about the future of wealth creation through your lens, through the lens of innovators and industry professionals. How frictionless can we make investing? It's already pretty frictionless.
Yeah. So I sit on the board of DTCC. Let's just start there, right? Best market in the world, and the best we can do, which by the way is amazing. We're now T+1, right?
Yeah.
Great. Okay, amazing. But we still, for retail investors, we're settling trades 24 hours later, right? So just think about that. It's like, okay, a retail client has money in their account. It's sitting there. The cash is sitting there. They buy a stock, and we go 24 hours to settle that trade, right? Contrast that to if any of you guys are in crypto, right? It's a very different experience on the crypto side. So there's a place where there's plenty of opportunity for us to continue down this path of creating frictionless access. Things like alts, right? That's it's all I hear about is access to alts. But think about it's for an accredited investor. Okay, an accredited investor today is, my words, is effectively somebody who has a lot of money. Right? This notion that just because you have a lot of money means that you're a sophisticated investor is kind of ridiculous to me. And so the hurdles for people to access private investments for mass affluent and under is almost impossible today. And it's a gigantic market, and it provides really interesting opportunities. There's a bunch of work we need to do as an industry to kind of lean into, sort of that private market that today, again, is all for the rich. And then the last part, I would say, the 401k, the employer space. There's a bunch of folks. I don't know if Aaron's here, but Vestwell's doing some really good things around disrupting the 401k space. There's a lot of work to do to help all of these employers around. Let's just stay in the United States and think globally. There's a lot of work to do for us to get to a better place in terms of taking what we did for the non-401k space and applying it to 401k space, which is a place that Apex is kind of leaning in.
Yeah, thank you, Bill. I want to also point out you brushed over it, but the astounding work you're doing in fractional trading. Again, another sort of pathway for the everyday investor to come into this marketplace. It's really tremendous, the product innovation you just talked about. I'd love to know what you're excited about for the future. I just think this is a group that will grasp it, will run with it. What
Yeah.
excites you?
Yeah. So you mentioned fractionals. So we obviously did equities years and years ago. We launched fractional fixed income last year, and the expectation 25 will launch fractional options, which is, if anybody's an options trader here or knows options, is hard to do, really hard to do. We're down the path on fractionalizing option, which again, think about an option, right? It's 100 shares. Lots of people can't afford that. And so providing the ability to do fractional shares is just something obvious that Apex should do. I think the other two parts I would say, one is this notion of stock as a reward. All right, so you think about you go on Amazon, a package shows up at my house every day. What if you go on Amazon and your reward, instead of it being some points or something like an airline, you got stock as a reward. That we have some patents at Apex. Why can't we do that? For, let's just say we partnered with Amazon, not to start rumors, but what if instead of some point system, you could get stock and turn a consumer into a shareholder? And you think about the marketing side for a public company turning a consumer like Amazon or somebody that walks into Lululemon into a shareholder, right? The loyalty, right? Home Depot, right? Versus going to Lowe's, right? There's path in terms of using stock as a reward, as a hook, is now something we can do. And then the last part is just globalization. Later this week, we'll announce publicly that we're launching a 24/7. When it started as 24/5 ATS, soon to follow 24/7. And the premise there is, why do retail investors have to stop having access to the markets, U.S. markets, between 9:30 and 4, right? At 8 o'clock at night, why can't you buy Tesla? There are some places to go today, but I think the market needs better, different options that are out there today.
Bill, thank you. I think what I just heard is the opportunity, the landscape is vast, and we can't say enough thanks to you and the Apex team for your vision and then operationalizing it for that future you just described. Please join me in thanking Bill for this morning.
Thanks, everyone. Thank you.
Thank you so much, Sarah, Bill. We really appreciate it. Apex always at the forefront of that innovation. And Sarah, thank you as always. My friends, we're going to keep this rolling. I'll bring out our next panel, the latest catchphrases, disrupting financial services. Here to moderate, we've got Braden Dennis, the co-founder and CEO of FinChat. And joining him is Jerome Favres, the COO of Trading Central, Eugene Sorensen, head of Chart IQ at S&P, Dr. Leslie Kanthan, CEO of Turintech AI, and Jan Sislaji, founder and CEO at Reflexivity. Come on out. Let's give them a round of applause, please. All right, guys.
Hello, is this on? All right. Hi, everyone. Thank you for joining us this morning. My name is Braden Dennis. I'll be your moderator today. And, we got the ultimate buzzword panel that they gave us, the latest catchphrases in financial services. But I'm going to talk about a couple things that are specific and relevant to the people in this room. By way of introductions here, I have Jerome. Jerome is a cross-asset strategist with over 15 years of investment banking. He's busy incubating new ideas and decision support algorithms in AI. Eugene, we have a leader in financial information visualization. You head up the Chart IQ business, which is now acquired by S&P Global Market Intelligence. Dr. Leslie Kantham, how are we doing there? Founder and CEO of Turintech, a company at the forefront of revolutionizing software engineering. And Jan, you are the founder of Reflexivity, formerly Toggle, hails from asset management and algorithmic trading, has a background quant finance, and you spent most of your career with Stanley Druckenmiller, which is kind of cool. I'm the CEO and founder of a company called FinChat. It's a fundamental equity research platform, and I'll be your moderator today. Quickly, there's a lot of smart people on the floor that are not on the panel too. So I encourage you to chime in, put your hand up, engage in conversation, ask questions. I'll go for there. Leslie, let's start with you. The big topic is obviously AI. Your company's directly involved in that. You're doing the hard, nerdy stuff that the people are very grateful for. What's going to change? And I think to counteract that and invert the question, what's going to stay the same?
Yeah, sure. So AI is here to revolutionize a lot of the services that we see within financial institutions. What's going to change is that it's going to be more about AI-driven optimization and sustainability as well. What that means is that, in particular, for what we do is using AI to optimize code, make them more faster and efficient, and sustainability element of that is to reduce the costs, i.e., your cloud costs, your compute, your energy consumption, and that's what we're starting to see as well across the space. What stays the same? Actually, as AI is always evolving, you see very little of it staying the same. Though I would say that traditionally we see AI being used in data analytics, analysis of big data. So this will still continue to be the mainstay for industries.
Anyone else have any comments on that?
Yeah, I do have one. So at Trading Central, we service roughly 300 clients around the world, servicing a community of 150 million traders. And for us, AI represents more an idea of personalization at scale. It's really this ability to answer questions to any user, whether you are a seasoned trader or a newcomer, in their own words. And that's what we think is very valuable here. And that's really changed, because otherwise we always send our stuff or insights the same way to everyone. We do change a little bit the colors and everything, but it's slightly different. So it brings something new. What remains the same is financial market. So don't expect AI to give you predictive analytics and you will make money all of the time, because it won't happen, clearly.
It was programmed by humans after all, right?
Exactly.
Yeah. And to follow on that, I mean, obviously it's changing the way that people do research, gather information, but as you just mentioned, trading operations, maybe not, and maybe for a good reason. Do you see, and open to anyone, do you see that being the next frontier, or is that an area that whether it's a human or a robot, we're going to act irrationally regardless?
Yeah, I think we're going to act rationally. I mean, markets are this collective opinion of everybody, right? And that's not going to change. We may have new actors in the market with AI. We did years ago when algorithmic trading first came out and trading systems first came out. They were new actors, but have they fundamentally changed how markets work? No, right? Markets are about providing liquidity, and that is the foundation. AI makes people more efficient. It's going to make people more productive. I think it will benefit larger institutions first before it cascades down to helping smaller and retail private investors. But I think that as Jerome was saying, markets are markets, and they will continue to operate the way they do.
To follow on that, Eugene, a really relevant trend right now in fintech is what is being called the degenerate economy. The degenerate economy is coined by one of my VCs at FinChat. It's the idea of the Las Vegasification of our world. Sports are on, bet on it. U.S. election, fair game. Dogecoin, to the moon. Spin the roulette wheel on your phone while on the toilet. Download our app. This is what's happening. How's this going to play out? Do you think that that's becoming the status quo for consumer-facing fintech apps?
No, I don't. I think that first Chart IQ
as a graphics library. It's used across a spectrum of applications, 250 applications across the planet, hundreds of millions of end users using Chart IQ, and we have some of these gaming apps that are using Chart IQ. So we've directly worked with them, and look, people are love taking risk, right? It's inherent in who we are as human beings. They want to take risks, they want to gamble, and this is an easy access point to do it. But fundamentally, there's a difference between investing and gambling, right? And that is that in investing, the mathematical advantage, you can put it into your favor. With gambling, you can't. So I don't think these things really change financial markets. I do think that they invite more people to participate, right? Which is a good thing. The more people that participate, the more liquidity that's ultimately created. But these gaming apps themselves don't create that liquidity. They are sort of a bit of a sideshow.
Yeah, I will be completely agree with you. I think the gamification is really to answer, to provide answers to new breed of investors, the younger ones that need something cooler, funkier than what in the financial industry we used to provide for, like the beginning of time, which everything was like PDF, dark, black and white stuff, 20 pages documents. They want something quick, very easy to understand. So that's the reason why we saw this trend. But ultimately, we come back to the classic. We have to do our due diligence, financial analysis, technical analysis, news and sentiment, fundamentals, where Jan is actively working on yourself. But that's not necessarily a huge trend.
Any other comments there on the degen economy?
Well, I don't have a comment directly on gamification, but there were a couple of interesting comments that I think are worth thinking about, which is there's this prevailing view that's very easy to subscribe to, that AI is in effect going to be this very friendly assistant, almost like, oh, it's the intern that can help everywhere. I think that's a temporary phase. I think that eventually AI will outgrow that phase, just like you start as an apprentice and then you become a master at something. So I think also what Jerome was saying, I'm not sure that's true, that you won't be able to get very predictive analytics out of AI, because if you believe that there are smart people extracting alpha from the market today, there's no reason why AI couldn't do that also. Doesn't mean that everybody will be given the tool, and so by definition, you can't have everybody making money from the same trades. But I do think that you will see systems evolve that are going to be far better at doing certain types of trades than humans are. It just logically seems to me that the progression we're seeing from all of the different games where unsupervised learning led to AI very quickly becoming expert, markets aren't going to be any different. Yes, they're very complex systems, but they're still exploitable. I mean, humans exploit them with much more limited intelligence. So I do think eventually AI will do the same.
Kind of like chess, poker, these solved games by AI.
Yeah, and I think usually the counter argument to those as well, but you have a very well defined set of rules, and so once you give the AI that, of course, it can ultimately do better. But actually, we've seen examples of it doing better in other cases where actually the set of rules was not as well specified. And just like humans, it try to do the best it can. Doesn't mean that it will be always right. It just means that it can be right often enough to actually be profitable, and that's ultimately what you're aiming for.
I wanted to add to that as well. So I agree with your point on that. I think that AI systems are essentially expert systems, and they don't necessarily have to work within a rule-based environment. They're very good at learning outside of the box, as it were. So we see already a lot of machine learning. You mentioned unsupervised learning, but there's various different techniques, that we see from deep learning to now AI using graph construction-based methods to map the domain that they're looking at. And we're seeing this acceleration of many different types of applications. So going back to the point about gamification, one of those things that we see is that, yes, like they open up the market for a lot of wide participants. And what you're going to actually want to see is you're going to see applications that are starting to churn out that are much more faster, efficient, with the use of AI tooling to help improve the quality of those applications and the experiences for those individuals.
Did anyone bet on the election? Anyone? You win? It makes money? Attaboy. Good man. Let's talk about data. It's looked at as a unique competitive advantage in our world, a source of new business for a lot of data providers with generative AI. How do you see the large and up and coming data providers, playing a role in this space? Maybe we'll start with you, Jan. Being a financial data aggregation and display of via AI.
Well, I think data itself has over time gotten commoditized. I think it's easier to get than ever. The problem I think we have is that there's so much of it that the infrastructure to actually exploit it and get insights from it has not kept up with this. So what I think there was a discussion earlier about how Leslie, I think you were talking about this, how one of the things that will stay the same is that AI will still be used and employed in the space of data analytics, which I think is correct. What I think is different is that unlike some of the methodologies we were using before, which were about just predictive analytics, it is now acting also as an intermediate between a human analyst and a variety of different engines that can actually run, manipulate, and analyze the data. And I think that is a huge, huge moment for data providers because it will unlock the wealth of insights that currently resides in the data. If you think about how the analysis works currently, many of those who can't just sit down and write a quick Python script in 5 minutes will effectively end up downloading a lot of the data into a spreadsheet and then analyzing it that way. That is extremely cumbersome. And so often, if you have a pretty good rule of thumb, you'll just resort to that. I think what will happen now when you can just articulate something and get it done in a second, many, many more decisions will be anchored in data analysis because it'll just be much easier to do. So that's what I think is, as they say, the more things change, the more they stay the same. I think that's sort of in that vein.
As a follow-up, what about in the way that the data providers source? Do you think that, of course, there's a way to extract insights from it, but anyone have any particularly hot takes on how it can actually be created, some of these assets?
I mean, I think one of the interesting things that we see and where Chart IQ excels is being able to pull data from different sources, right? And every firm has its own data output, right? And so, it's how do you take the commoditized data, right, and blend it together with your proprietary data, right? And, look, data is the fuel that's driving this. And what is your data governance policies? What is your QA behind that data? I think while, yes, it is getting broader, we see these massive moats of acquiring data that protect companies like S&P Global, like Bloomberg, like Reuters, because they have so much content, right? Like FactSet, right? There's so much content to get that access, right? But then how do you normalize it, provide it to a direct access to be pulled and used by these AI engines? And then, as I was saying, to blend it back with that fuel. We were chatting before, and I was even thinking about, oh, you have proprietary data in your system that people may be interested in seeing. And so you have this exhaust flow that comes out of it. And I want to blend that together with another form of analysis to arrive at my conclusion, tell my data story.
Yeah, I would agree with Jan and Eugene here. Ourselves at Trading Central, we have a huge amount of data we have to deal with and send to our clients. And we know that we're in a world of infobesity. There's way too much data. So there's more and more information and less meaning. So AI in this case is a fantastic tool to help you, to help an investor from retail to even a hedge fund manager to find insight, to cut through the noise and focus directly on what's meaningful. And that's where it's interesting because, well, so many data, it's crazy.
Yeah, on that point, I want to mention that Jan was correct in saying that there's a huge amount of data out there at the moment. What we should also consider as well is that actually, equally, there's a large amount of legacy systems in place with data that's associated with that. And then driving meaning from that is very, very tricky and very difficult, right? So the use of some of the AI methodology that we have right now is moving more into the space of what you're seeing with generative AI, where there's this exploratory capability to understand what your data is. But then there's also these new types of data that we're seeing as well, because traditionally we saw data as mainly big data, financial data, text, numbers and so forth. But now data consists of lots of things. It could be legal documents, could be contracts, right? And it could be software code and applications, right? So we already see some products where they're trying to utilize that to essentially predict what you may want to write for code or what document that you need to use and what you're going to write. So all this is context analysis, and we're moving more into AI-driven context.
Anyone in the crowd have an example of something that they've used at their company in the last year that has had one of those you show your colleague mind-blowing moments and actively deployed to customers? Anyone want to share? Great. Yeah, good. We need more coffee, guys. Come on. More coffee. Yeah. Yeah. Synthetic data. To recap the question, synthetic, I could hear bits and pieces of it. Yeah. Yeah.
I mean, people are using machine learning to generate synthetic data sets, right? Of data that is real world that they've trained upon. So we're kind of seeing that. And in terms of, for instance, for financial trading, especially in the automated market making and algo trading area, that's also quite lucrative for them to get data sets that are very unique to the particular market that they're looking at, so that they can stress test and model based upon that, and then try and apply that to real world market forces. So I guess that synthetic data is been around for a little while. The fact that it can be more AI driven rather than just being stochastically generated is probably the latest innovation that we're seeing at the moment.
I think to pick up on that, right, one of the things that, as I was saying, all these different data sets, I think synthetic data fits into that. It was said a moment ago of, that AI becomes this agent to discover data, right? And, up to now, we have these massive databases that have basically been locked up to the quants, and the data scientists have access. Well, now we have AI engines that empower many more people to harness the power of that data. And that's where we're also trying, from a visualization point of view, trying to empower end users, right? Everybody in this room, everybody in finance has an incredible understanding of data, right? Far beyond what the average person does. But very often people are limited in what they can actually see and touch and access and make decisions on. And that's where AI becomes incredibly powerful, because it provides that data scientist that we're all begging to talk to, but there's only one in this room, and we can't all talk to him at the same time.
I'm here.
Okay, I'm talking to you.
Question. You got this, man. You got this.
I think it's a good question. So, uh, obviously, when I was a lot younger, when I was probably a toddler, when they started looking at computerizing exchanges and making trading more automated, there was questions like, how could these systems be trusted? Reading about them. Um, you see humans still in that loop, right? Like the systems we use every day, we depend upon them, but there's human intervention in that. Now, with what you're mentioning about in respect of AI, in terms of AI generative models, AI optimizations, AI everything that you can imagine. Yeah, of course. Like you're still gonna have humans in the loop inside of that. There's people that have constructed the AI. There's people that are tuning it, constantly evaluating its results and progress. Nothing is truly left, to run by itself without the intervention of a human being to be the input and decide where it's going to go. We see that more often with algo traders, where you'd be hard pressed to see an algo that's running by itself for 10 years, for example, right? They take it offline, they evaluate it, see the results, put it back in. If it doesn't give you the results that you want, don't use it, change the book. So that's essentially.
Yeah, I remember back in the early 90s when I was first building trading models. I'm that old. And, I remember sort of the dream of like, okay, as we build these models, as they get more and more efficient, then we're going to all be able to go spend, time on the golf course, or for me, mountain biking, and let the system run itself. I haven't seen that. I don't think anybody here does that.
And also to answer your question, that the decoupling between the fundamentals of those companies and potentially a lot of trading activity on top, that already happens today every single day, right? So I don't think that that's a significant change from reality today. I think, overall market participants have different duration that they're looking to optimize for, whether it's the next 6 minutes or the next 6 years, right? So I think that there's always going to be opportunities if you're mismatching duration.
I want to add something to this, because actually it's a pretty fascinating question. If you did have a greater proportion of AI traders in the market, would that exacerbate, like in the long term? I think every markets can stay irrational longer than you can stay solvent. We've heard that before, but eventually they do correct. The question is, in the short term, with higher proportion of AI traders, does that exacerbate these deviations or not? And I guess principally that depends on whether or not you think that these deviations depend on certain behavioral properties that humans are subject to, but maybe AI might not be, right? Like we really like the power of story. We really do fall prey to sort of recency bias and so on. If you remove some of those elements, does that mean that actually AI trading could potentially, far from exacerbating, actually make sure that some of these deviations don't become as extreme? I don't know what the answer is, but it would seem that conceptually you could argue that it makes them better because it's able to absorb more information and be less subject to some of the biases that ultimately lead to irrational exuberance and so on.
Yeah, but it's historically we have seen also some examples like with the robo advisors built the same way, and we've seen some flash crash that were actually quite fascinating. That means that they might think exactly the same way. That means volatility might be bigger at some point. So, and markets remain a zero-sum game. So there's one winner, there's one loser, and that's.
I think robo-advising was to an extent like fake AI, because that was effectively just creating these frameworks that all of them were following, but at the end was just trying to effectively do some form of an efficient portfolio. So it's a lot more like portfolio insurance that you had back in the 80s than it was something that was truly trying to adjust. I think what we're looking at now and what we could be facing is dramatically more powerful than that framework. That's why I'm thinking that you don't have that positive reinforcing feedback. The system could actually reevaluate everything on a daily basis and then get out of the position, because
it's a fascinating question. I love it. Right. Because, I said before, right, the market is a sum of all of our emotions and opinions, and what drives markets but fear and greed. Right. And that's why the downside is often, particularly in the world of equities, is so sharp relative to the upside. Right. We climb the wall of worry. Right. And then we all get scared and we jump ship, and boom, volatility jumps way up. Right. But if you have an AI actor that's able to remove fear and emotion, Or does AI somehow end up learning that from the market itself, right? Because ultimately it's still reading human emotion. I don't know. It's a great question. I love it.
I'd like to thank everyone here for joining us this morning. We're gonna wrap up the panel now. You guys will all be here all day, so come say hi wherever we are today, and we'd love to meet you all. And it's always good when Benzinga runs their conference in a November that happens to be a bull market. So everyone will be in high spirits today, and thanks for coming, everyone.
Thank you. Let's give it up for our panelists. Thank you guys very much. I'll see what I can do about continuing the bull market every year around this time. That'd be great. That's my job. I think I get in trouble if I say that. Yep. All right, come on off, my friends, this way. We'll go right on to our next panel, my friends. Thank you. Next up, we've got embedded finance and more, the next chapter in payments and banking. Here to lead this panel is Nanthakumar Muthuswamy, co-founder and head of engineering at Uprise. We've got Rob Nardelli, director of commercial banking at DailyPay. Thiksha Gera, senior analyst, fintech and payments. And you just saw her. She's putting on her banking hat now. We have Sarah Biller. She's a co-founder of Fintech Sandbox, also a director and investor in Thread Bank. Let's give it up for our next panel, please. Thanks very much.
All right. Hi, everyone. Good morning.
Good morning.
Good morning.
Good morning.
Thanks for joining us here for talk about embedded finance and trends and challenges. I think we want to get started with as soon as possible because we have only 25 minutes to wrap up this session. Just start with embedded finance. I think most of you guys know what is embedded finance, but at least if you're not knowing about embedded finance, we can give a quick intro about that. What is embedded finance? Embedded finance is embedding financial solution into non-financial apps and platforms. So Megan, that's kind of very high level definition. Obviously, I wanted to get our panelists' opinions or their experience. What's their real time stories about the embedded finance? Maybe start with Rob.
Yeah, happy to. So how many people here, by show of hands, know what earned wage access is? All right, we got a couple. We got maybe a handful. Yeah, David, you better raise your hand. So what earned wage access is simply is giving a worker the ability to access their wages as they earn it in real time and not having to wait until regularly scheduled payday. And how we use embedded finance is we simply use the bank's tools and technologies to help power our product. So we use the clearinghouse for RTP, and we use Visa Direct, among others, for OCT or the push-to-card rail. So when folks hit that button, it's actually the embedded finance that's the magic to the solution to get those wages, earned wages, out to those folks who need it most, if and when they need access to it.
Yeah, great. Okay. Maybe Diksha, you have anything to say?
Yeah, so I have a more relatable story probably. How many of you get up in the morning and are super excited? Okay, I'm going to go to JP Morgan Chase today. Please show of hands. I'm pretty sure you work with Chase. So I moved to the US about 3.5 years ago. I was in Singapore and Hong Kong for well over a decade before that. And I worked with Bloomberg. They gave me a letter. I went to the branch to open an account. And the guy comes in and says, do you want a checkbook? Now, I actually smirked at him. And I went like, I literally looked at him and I'm like, yeah, I think I'm okay. Because in my mind, I had last used a checkbook when I was a student. And 2 days later, mind you, 2 days later, I went back and I asked him, can I please get a checkbook because I could not pay rent? That's how challenging it is from an outsider lens, perhaps, or maybe just by getting used to the way we are doing financial services in Asia over the last decade. Nobody wants to go and make banking another task to do in the day. And to me, that is embedded finance. Basically fulfilling the need for banking in the moment of that decision making or in the moment of that purchase decision or whatever activity it is that you need to use financial services for. So long answer, but that's my personal experience.
That sounds similar to mine, actually. I think maybe I can tell my experience as well with traditional banks. When I moved US 12 years ago, I opened an account in a credit union. Actually, I've been using this till today. And in between, my wife keep asking me to open another bank account because some of the challenges in transaction and so on. So I tried to open a bank account 1 year ago. To get an appointment, I have to, I think 2-3 times I have to postpone that, or I didn't get the appointment, and then finally I got the appointment 4th time, and then opened the account. So that's kind of some of the challenges with the traditional banks, but how that this embedded finance this now become it's helping to simplify some of the challenges actually. I think that's also leading to one more things about accessibility. That's exactly we kind of touched upon a little bit. Anything you want to talk about accessibility, Rob?
Yeah, and I think I did really appreciate that story from Thiksha. I'm going to follow her lead. When it comes to customer value and applicability, I think it's super important to tell a story. And we have a customer, or had a customer, current customer, who was on a date, went to the gas pump before dinner, and tried to pump gas in his tank with the date right there, shotgun. And he swipes his debit card and it rolls 000. You or I would have a credit card, we'd be out of this jam in a jiff. Deal with it next month. He didn't have that option. The option he did have was he opened his Daily Pay app and he saw the available balance that's due to him next Friday. A lot of good that's doing him here at the gas pump, let alone dinner after. And he hit the instant button. Within seconds, the money hit his account, swiped his card, filled his tank, got on his merry way. And there is a happy ending to this story. That couple, it was their first date. They are now married happily. And it makes you wonder what would have happened if he didn't have that option. I mean, it might have worked out, but it would have
who
been
says
tricky.
fintech is boring? We are better than a dating app, guys.
But I think as payment geeks, and if you're in this room, chances are you're a payment geek, so you know who you are. It's important for us, we see a bunch of numbers on an Excel spreadsheet and we get excited. But when you think about what the actual value is that your products are delivering to the customer, it's powerful.
Absolutely, yeah. I think definitely that enhancing access and access to the financial service is very, very important. That's kind of driving factor for embedded, how the embedded finance is evolving actually. I think we all know that embedded finance has many solutions, like payments is one of the solution actually, obviously, and then banking is another one, insurance and so on. And there are a lot of additional solutions keep coming. When maybe we can drill down to one of them, actually it's a BNPL, actually another solution. It's a buy now, pay later. You guys might have used it in many of the platforms. So yeah, we wanted to talk about that, how that's evolving, and anything more
Yeah,
about
so I think some of the secular trends that are driving embedded finance in general are what we've seen with e-commerce, right? Like our team basically expects e-commerce to grow from about 25% of retail to about 34% by 2030, and that is a secular trend that's happening everywhere. Within that as well, what we've seen is some business models have tested the time and headwinds that have come in the last 2-3 years. Buy now, pay later being one of them. So globally, it's about 5% of e-commerce right now, which is still very early days. But what was interesting that really stood out was the US, particularly as the leading edge of the market, there about 8-9% penetration, is it withstood the test of time and it withstood all the pressures that came along with the investment sentiment turning sour, how interest rates kind of moved, the liquidity environment turned around, and this business model kind of has stuck around. And the proof of the pudding in that is like the larger companies like PayPal, Apple, all these companies are coming in, the banks are coming in and basically revamping what they used to call as point of sale lending to something called as buy now, pay later now. So I think that is a very interesting phenomena that's happened. And if you just think about it, what is the essence of buy now, pay later? It's basically, even if you are borrowing, the decision or the actual transaction or whatever is happening in the back end is happening at the point of sale in that moment when you want to make that transaction. And there's a lot of financial innovation that has happened along the way, right? Like your ability to underwrite credit in that moment for that particular transaction rather than assessing Rob's entire credit history and figuring out whether they should be kind of lending him like a long credit line or not. It's basically, can someone buy this particular product at that point in time? So I think there's a lot of financial innovation that is happening across the industry, but it's these moments when you're able to prove and test, withstand the test of time is what is interesting about buy now, pay later.
How is that adoption within customers? This particular solution.
Yeah, so I said US, it's the leading edge. It's about 8-9% as of Jan to April this year. What is really fascinating is it's going beyond retail now. So you're talking about buy now, pay later, kind of going into services, from usual pay in 4, it's going into a longer duration credit product. So there's a lot more happening around there. I don't know, at some point, maybe you'll have a buy now, pay later to pay your taxes or your property tax or whatever. Who knows, right? So I think it's still early days, but it looks very promising.
Any additional innovation happens in that field, BNPL? Sorry, BNPL. Any additional innovations?
Yeah, I think it's again, it boils down to the fact how strong your machine learning and your models are able to kind of predict. The predictive analysis part of it is the most fascinating, but we've not heard much use of generative AI or something, at least on the lending front at the moment, but that's something to keep an eye out for.
Okay, definitely. And when we talk about embedded finance, there is one more important thing, or you cannot come across without hearing this word about payments, embedded payments, right? And behind the embedded payments, the real-time payments is definitely unavoidable, actually, because that's where I think the accessibility and then some of the inconveniences solved by these technologies. So maybe Rob, you can talk about the real-time payments, how that's really driving the embedded finance. Yeah.
Certainly. And just to touch on buy now, pay later in a transitional tone, right? Earned wage access is, the way we see it, a worker's last line of defense before they have to tap in to true loan-based products. And that's where, in terms of the instant payment, and we use, as mentioned before, real-time payments in the OCT or push-to-card rail, we get those payments out within seconds. To Thikshaw's point, you can't be, and I have a longer story about going to a bank and trying to make a domestic wire and how that took almost 24 hours, right? What would our poor customer be doing there out in the cold trying to fill his tank of gas, waiting for all that? And the counter argument we've heard is the faster the payment, the faster the fraud. I've heard that on panels. I've been on panels where that's come up. And the reality, as Thikshaw pointed out, is you need to do all your due diligence on the front end, because when your customer's ready for that payment and they need those funds, right? They need that money. They need it right now. And there has to be done beforehand. And that's what we do for our product. We underwrite the individuals, we underwrite the employer, and we do that before we even turn the thing on.
Okay, thank you. Any?
Yeah, I think real-time payments is another very interesting trend that is facilitating embedded finance, as Rob kind of pointed out too. If you just look at the adoption curve across markets, Asia, particularly India, Brazil, they are at the leading front of this. I think that adoption will definitely get accelerated. We'll probably see larger transaction amounts. There's a lot of support coming in from government-built infrastructure, which is giving them a head start in a way. So as I said, like UPI 2.0 was already in place when FedNow was proposed. So I think that acceleration will keep happening. Europe, we'll see probably some of those interventions come in again and also increase adoption of real-time payments. For the US, we are waiting and watching, and particularly because you already have existing infrastructure with the card networks, which basically reduces the reliance or the need for that real-time account-to-account transfer situation that we've kind of we're talking about in the other markets, where cards are not very dominant in a way. So that trend, I think, it's an interesting one to watch. Yeah, and I mean, one clear example that is what you probably will need for this curve to kind of get to leapfrog in the US probably is some big tech player coming in and providing like impetus for this cause, like I don't know, like maybe Apple Pay coming in and saying we'll facilitate account-to-account transfers or something like that in the real time. So the reason why I say that is because it's very hard to change consumer habits. And this part of the world, we are so entrenched in our cards that it's a difficult proposition. But just taking cue from what Visa, MasterCard are doing, there's definitely momentum. But will we kind of reach the India-Brazil level anytime soon? I'm not very sure. Like Fiserv did this amazing thing with Walmart, but yeah, we're watching.
And to put an exclamation point on that, in terms of the fastest growing use case for real-time payments, that's not legalized gambling. It's earned wage access. And if you look at the biggest consumers around this time last year, the data that we had available, Daily Pay, not the industry, the company, represented 1 in 10 real-time payments during that quarter last year. So you've got PayPal as the #1 consumer, and it's not Apple, it's not Google, it's Daily Pay, who's the #2 consumer of RTP. So there's plenty of room. And again, we're the global leader in the space. We cover about 15% or less of the American worker. So there's plenty of green fields in our use case.
Well, I can add to that. Visa actually mentioned Daily Pay in their earnings call, so definitely you're moving something there.
I wasn't going to do the shameless plug, but thank you, Thikshaw. It's great. It's great when your big brother calls you out, the CEO of Visa, on the earnings call, and about our renewed partnership, which now will also represent cross-border remittances, right? So folks that need access to their pay and want to send money home to their relatives, wherever they might be. That's our newest capability. And yes, we partnered with Visa, as Mr. McInerney represented on the earnings call.
Sounds good. Okay. I'm probably shifting your focus a little bit on the regulatory side. Actually, again, the same topic, payments, real-time payments. Again, Sarah, you might be expert in that area. So what do you think, like, the regulatory plays a major role in the real-time payments? Anything, any additional insights on that? Yeah.
Yeah, so I'm going to come to the discussion a little bit hot because I was asked to join the panel and put on my banker hat. And so I'm in full disclosure, an investor and a director in a BaaS bank based in Nashville, Tennessee. And I'm listening to and a Fintech innovators, and probably you saw, really love the infrastructure side with my conversation with Bill about Apex. In this case, where are we in the United States, ostensibly in this concept of open banking, the ability to actually embed different Fintech disciplines in non-traditional financial services players and leverage the charter of a bank. And I think where we're heading is into a period where we're going to lock horns with the regulators. We already have as bankers, as many of you know. Rule 1033 puts a tremendous onus on you as innovators in the fintech space, as well as us as bankers, to actually provide customers unfettered access to their transaction data, their most sensitive personal financial lives. That itself presents a challenge on top of an already very difficult environment for AML KYC, for cross-border transactions. We are well behind in the United States from UPI in India and other methods of identity. And so I think as we have these conversations today, one of the things I would implore you to do is if you seek to embed fintech solutions in any capability, you recognize that your banker who's going to contribute their rails, a little different with MasterCard and Visa. But if you're looking for a traditional bank partner to do any lending as a service, PaaS, which is payment as a service, be prepared to contemplate how you can actually adhere to a very rigorous AML KYC responsibility that your bank has. And I think each bank in the United States sees partnership, at least I know, I shouldn't say each bank, many banks see partnership with the fintech community as the next generation of deposit gathering and serving its customers. Main Street is no longer just that sidewalk, it's a digital environment. You want to work with individuals who are earning wages with the next generation of payments lending. But my view is the regulators have not caught up with the rest of us in that ability to strengthen our banking sector through embedded finance.
And what a timing to say that, Sarah. Like, definitely, I don't know if you followed, like, we had this episode post regulations where a lot of fintechs were facing issues because the banking end could not keep up, like the pace of the programs kind of took a hit because of the recent regulation announcements, and definitely more eyeballs on bank fintech partnerships now. So yeah, very, very valid point there.
Yeah, think about a community bank being asked to embed what Bill said this morning, 1 million accounts in a weekend. That's how you open that is just, it's mind boggling. I sit with a team and the resources you have to really be a partner and an accelerant for embedded finance. Our infrastructure has to catch up. Our regulators have to catch up. But it's a very positive future.
Yes. And when it comes to regulation for our product, as Sarah mentioned, right, when it's a new product, earned wage access did not exist a decade ago. You have to educate and be willing to work with those regulatory bodies. In particular, recent news that directly affects us is the great state of California giving us regulatory certainty in their state. And no state employs more workers than California. So we're excited to continue to work state by state and with federal regulators. It's really a matter of that educational piece. And then for us, and this is what we stand for, is we are on the side of the American worker, and we want to enable them to give them that flexibility and control to be able to pay their bills on time, to be able to fill their tanks with gas when they're on their first date. And if we're going to continue to work state by state and with those federal regulators, that's exactly what we plan on doing.
Great. Okay. I think slightly trying to shift the focus on the bank and fintech collaboration. That's probably the next phase in that. I know that embedded finance is like evolving, scaling up. So as we go further, actually, these banks and fintechs collaboration is unavoidable or have to happen. So in this phase, what are the challenges or the strategic changes that the fintechs needs to make in order to collaborate well with the banks, and maybe just talk about that. Yeah.
I think I would start by just a simple metaphor. We treat our fintech partners like a digital branch. So anything that we were trying to emulate is I acquired the bank with 3 other investors. It was a 100-year-old bank, and we bought the charter. And we had 2 branches, 2 bricks and mortar branches that had, frankly, fairly manual processes. We've digitized all those processes to enable our fintech strategy. But we have to treat you like a branch. We have to treat you with the same care that we do our own customers. And so as a fintech, I think be prepared to really help your teams, foremost, understand and be literate about those rules that the banks have responsibility for. There are very harsh regulatory penalties if you don't adhere to AML, KYC, Bank Secrecy Acts. But it should not be an impediment to your learning, but a partnership. And so I think the first thing is preparation for your team and how you're presenting yourself to your customer base recognizes that the way that the bank rules today are written They are evolving very quickly, but I think that's would be foremost in my mind is to really have your team think of the bank as a partner and not an impediment, but understand the meshing of the knitting together of the opportunity with the regulatory requirements.
So do you feel that banks are coming forward to work with fintechs? That's
Selectively. Yeah, I
selectively.
think we all know if you're in this room, you've seen about what's happened to banks who haven't been able to manage their
Right.
general ledger. FBO accounts are very challenging when you're opening 10,000 accounts in a weekend. You have to know where your customers' money is sitting. So I think you've got banks that are willing to do that and banks that have pulled out. But as regulatory clarity comes through, the state of California is really contemplating a future where banking is, as you said, in for the consumer again. And that's exciting.
Wouldn't that be nice?
Wouldn't that be nice?
So I think one thing that we've noticed as a trend is when the fintech industry, so to say, really kind of kickstarted, the concept was, oh, we're going to replace banks. We're going to change the way people bank. And it was a very revolutionary term in a way. That has evolved and changed to realizing that banks are really not going anywhere. And there are like a lot of reasons for whatever. I mean, we've kind of come on both ends, right? On tech evolution versus the banks kind of coming from where they are. There's a lot more need for partnership and for integrating those services. And there are a lot of new business models that are evolving as a part of that. And more so in the US, right? Like the diversity of the banking infrastructure here, the number of community banks and a long tail of smaller banks. There's just so much room for fintechs to kind of grow into that role. We've heard new business models evolve as, say, for example, the smaller banks or the community banks that don't have a credit card. Bulk of the credit cards issued are technically from all the New York banks, right? How can fintechs kind of help them overlay a layer of credit on top of that? So there's a lot of opportunity out there for partnerships. But to your point, Nanta, one thing that I think fintechs probably are already learning and will learn along the way, and we've seen it's not just the fintechs, it's just the dichotomy or the difference between the way tech companies think and the way a traditional financial institution think are very different. We've seen that with Apple, right? Like Apple Goldman partnership came in 2 years. It's just the DNA is different, right?
Yes.
So what we need to do is basically learn to coexist and work together.
Absolutely. Yeah.
And for our business, as the director of commercial banking, it's with great pride that I left the banking sector and basically bet my whole career that it would be not easier, because none of this is easy. Let's just be honest when it comes to fintech bank partnerships. But I thought the only way I can make meaningful innovation and drive that at a bank is to prove the concept at a fintech where you're not regulated by your own internal bank compliance, and then go back and partner with a bank. We've done this in 2 phases thus far, and I'll spoiler it for a third one potentially. And the first phase, as we mentioned before, is embedded finance, using the bank's tools in their toolkit to power our product and deliver that value within seconds. That's phase 1. Phase 2, we've partnered with several banks, and in particular PNC. PNC has white labeled our solution. It's called PNC Earned It, and they can market, brand it, sell it as their own to their own corporate and commercial clients, and then enabling their workers. And in particular with this solution, whenever you put a bank's name on a fintech product, it becomes a bank product and regulated as such. And we've done that working with our bank partner. We now have a bank compliant app, which is really our app. It's powered by DailyPay, but it's marketed, branded, sold as their own. This leads to, well, what could the third phase potentially be? And what if there was a world where DailyPay was embedded in a bank solution? I will leave it at that.
All right. Okay. I know 25 minutes is not enough to talk about this very interesting, very vast area of embedded finance. And I think we all want, excited about future of the embedded finance, and, the technology is going to play a major role in that, embedded finance going forward, particularly AI. and there are many other solutions coming in place, like financial advisory, from where my company is contributing to that actually. So I think we're all excited about the future of the embedded finance, and looking forward to it. Thanks all for being here and listening to us. Appreciate it. Have a great day. Yeah. Thanks everyone.
Thank you. Look forward to connecting with you.
For our panelists, thank you so much. Thank you, thank you, thank you. Another wonderful session. Thank you, guys. All right, I hope you guys are out there enjoying this. You here in person and those at home. We'll keep the party rolling here. Next up, I get to introduce Benzinga's own Managing Director Renato Leonard Chappelle, finding an edge, structuring trades, and managing risks in markets. Here to speak with Renato, we've got Brent Kachuba, founder of Spot Gamma, and Matthew Cashman, the principal, investor education, and one of the instructors at the Options Industry Council. Let's give it up for our next chat. Thank you very much. Renato, come on out, brother. Enjoy yourself. Have a great session.
Are they on? How's it going, everyone? Big crowd, right? Okay, so let me introduce myself real quick. My name is Renato. I'm the managing director at Benzinga. I mainly put together a lot of these events. I joined Benzinga in 2019. I've started as a writer and eventually, just kind of grew up with the company. And today I'm joined by Brent Kachuba and Matt Cashman. And we're going to talk about options, which is kind of an extension of a passion of mine, markets. And I actually used to work at Spot Gamma at one point. And so we'll kind of get into some of the things that they focus on right after a quick introduction. So Brent, you want to kick it off?
Thanks, Renato. My name is Brent Kachuba. I'm founder of Spot Gamma. We started in January of 2020, and we specialize in understanding how the options market is driving the underlying stock or asset that those options are based on.
Matt?
And my name is Matt Cashman. I'm the principal of investor education at OCC, which is the largest clearing corporation of options in the world. If you're trading options in the United States, at some point in its life cycle, it goes through the hands of OCC in either the clearing or the settlement or exercise and assignment process. My job is to basically teach people how options work. So
awesome. And so I've been in touch with Matt over the years, and we actually did a similar panel to this last year. A little bit of a smaller audience.
Indeed.
But one really cool thing about Matt is that he started in the pits, and he was actually trading options in the pits. So he has a really good understanding of how options work, and he's seen them evolve through time. And so my first question to Matt is, why may options be viewed as a superior way to manage risk or participate in directional movement?
That's a great question. Why use options is essentially what you're asking me. Why should we trade options? I think the first answer to that in some ways is that the volume that you're seeing now kind of speaks for itself, and that the market in some ways is voting with its wallet. The volume that you're seeing over the last 5 to 10 years has basically doubled. As reference, this year, OCC is going to clear somewhere north of 12 billion contracts, which is a massive number. When I was trading in 2008, it was an extremely volatile year, and I looked up at the end of the year and it was 3.7 billion contracts. So you can do the math there as to how much things have grown. But the word that I would use in support of options and optionality is flexibility in real terms. Using options provides you an incredible amount of flexibility as to how you actually express your opinion and the cost basis with which you use to express that opinion. They can be, you can do all kinds of things with options that you can't do with underlying products like stocks or indexes or commodities. If you're limited to the, just the long or short world of underlying products, that is the entirety of your position. You're either long or short. With optionality, you can do so many different things with the actual products that are so much more nuanced than that. So that's really my baseline use case for the product itself.
Sure. And so when you have a lot of those options trading, it can actually tell you a lot about potentially how participants are feeling about a certain, stock or underlying asset. Is that correct?
Yeah, absolutely. And the more you educate yourself as to how the options work, the better you're going to be at deciphering what some of those theoretical signals are outside of the noise of the rest of the marketplace. I mean, Brent is and Spot Gamma are exceptionally adept at being able to spot signal within the noise. But my main message is the more you educate yourself as how the options work, the better you're able to kind of theoretically read the tea leaves, as it were, to be able to see what that actually means for the underlying marketplace.
Sure. Now, Brent, I want to kind of move over to you. You've been in markets for a long time, and at what point did you start kind of realizing, hey, there's certain things that I can kind of pick out from the way this market is trading that tell me, how a market may behave, over a very maybe short, even longer term time horizons. At what point did that kind of come as a realization?
Yeah, it was sort of the late teens was when we were monitoring S&P 500 index options, and that's the biggest options complex it was back then. The dominant options complex it kind of still is, and you could see when I was trading for a fund that was only trading the S&P 500, you could see strikes that had big open interest. The market would move to those strikes and would hold there. And so, you'd start to look into this and figure out, hey, why does the market move to these strikes? What is the mechanism to drive the market to these areas where there's big pockets of options positions? And so that was really when it became obvious to me as a trader, kind of as a practitioner, looking at the volatility surface and looking at position on a daily basis. And then, so we spent January of 2020 to kind of January of 2021 telling people, hey, the options market's moving names, like in Tesla, for example, in early 2020. And then GameStop happened, and then suddenly everyone became a believer that, hey, options can really start to move these underlying stocks. And now the options volumes have only grown. They're growing by leaps and bounds, and you can see the impact of the options trading and hedging flows on a daily basis in a lot of these big names.
Nice. Matt, can you talk a little bit about what's kind of led to this increased participation in markets using options?
Yeah, I would love to say that it's due in large part to the OIC investor education desk teaching people how options work. I think that's part of it. But I really think, going back to what I said at the beginning, the flexibility that these products provide is something that I think the marketplace more broadly is just waking up to and understanding how they work and how they might be a vehicle to actually express how you think about the underlying marketplace. It's an exceptionally flexible way to express those opinions. And so I think it's just, to be honest with you, it's a maturation of the marketplace. And part of that is also the actual democratization of the information that we have at our fingertips now. Many times when people ask me this question, like, what is going on? Why is the volume exploding so much? Part of my answer inevitably has to be that, well, there's just more information available to the everyday user, to the everyday, retail, pro-tail, even the institutional user has so much more information at their fingertips because there's just so much more of it out there that's available. Brent and I and his partner Matt were at dinner talking about 15 years ago how it was basically impossible to get a good option feed from Bloomberg, of all places, right? It was, and the way that landscape has changed over the last decade is incredible, and I think that's really what's going on here, is that we have so much more access to the information. When you have more access to the information, you just understand what's happening better, the entire landscape in front of you.
Gotcha. And I now want to move over to Brent and talk a little bit about, okay, so you see this increased participation in markets. You gave a good example of GameStop. What exactly were you seeing in stocks like GameStop, Tesla, even NVIDIA to this day? And how does that inform your opinion or kind of idea as to how that individual name may trade over very short-term time horizons from there on?
The interesting thing about options is because you can see open interest, you can see where people are positioned, and then you can compare that against what we call the volatility surface. And when you look at the volatility surface, there's information embedded in that. So just like anything else, supply and demand, when there's more demand, the prices go up, and when there's more supply, prices go down. And so you can see when people are placing bets over not just a variety of prices, but also throughout time. And so as you watch that volatility shift and as positions shift, you can start to understand the expectations that people have. And what's also interesting now is that you see as options volumes have grown, and we believe the hedging flows associated with those options volumes grow, it starts to change the price distribution. So what I mean by that is, if you look at Tesla right after the election, the market is pricing in, let's say, a 5% move in Tesla since Trump won. But we sit there and go, no, the distribution or the possible volatility is going to be much higher than that because of all this options flow. And so the interesting thing is that we've gone from being able to sort of assess how people are positioned to now understanding how that flow is likely to drive the underlying movement. And obviously, for those that are watching, Tesla was up way more than 5% at the end of last week. It was up something like 25 or 30%. And so you can see this happen time and time again now, where the bigger the options market grows, the more flows come in, and the more people are focused on volatility and their view on the distribution of prices is not just sort of how the stock is just going to move, but actually the volatility of how the stock moves.
Gotcha. And so, you know, in recent years, a big thing has been a lot of conversation has happened around products that bake in options overlays into them to give participants exposure to underlying movement, whether that's up or down. How have you seen that potentially, you know, impacting markets? And do you think those are actually good tools to kind of give participants that exposure to options that they may actually desire?
So there's a couple of big things. Number one, there's two giant funds. JEPI is the most well-known fund out there that has 30 billion in assets, and that's call overriding, and that supplies the market with a lot of what we call positive gamma, which reduces volatility in the S&P 500. So you can see the fingerprints of that trade and the effects of that trade. But I have a question for you, Renato. Do you know how many ETFs hold NVIDIA stock?
I have no clue.
Anybody guess? Anybody? Nobody? 523. You blew me up with the 20,000 guess. I was looking for someone to say 5. Now, 523. And a lot of those hold options positions now. So you can find triple levered NVIDIA ETF. You can find call overriding ETF. You can find short dated call overriding NVIDIA ETF. There's the SMA. So what you end up having now is that ETFs are starting to build these options positions, and a lot of them are just systematic, right? They roll very consistently, and those are all starting to have effects in the market. And as assets go into these ETFs and these products, that makes the options complex bigger and the impact of those ETFs bigger. And so, you know, you can really see these fingerprints across the equity landscape, and it's really changing, I think, the price patterns in the market.
Gotcha. Matt, how do you think about educating people about these products that exist out there? You know, maybe people aren't able to kind of exert that, you know, have that attention or be able to trade those options themselves. And so how do you educate them on the products that maybe exist out there like this?
Yeah, that's a good question. I think number one, the thing that you have to say is, I think on the whole, undeniably, the access that people have to these products is probably a good thing. That it, again, democratizes the amount of information and the availability of the optionality to everyone. The other thing that I think is that, and I posted something on LinkedIn a long time ago about this, is that structured ETFs, most of the time, are really, they're not rocket science, right? They are kind of like, in its simplest form, they're like two pieces. One is generally a yield-bearing instrument, and then the other one is some sort of option trade. And what you're doing is taking the yield from whatever you did to generate yield, and you're using that and spending it or using it to lever some sort of options trade on it. That sometimes means you're buying puts and selling calls. Sometimes that means you're just selling calls or just buying puts. But it's important that people understand, when you look at something like that, that the actual trade itself is not really that complicated. But what is actually happening is that there are some sort of fees that are built into how these things are structured. And so the education about the optionality is really important, but the education about how much you're paying to get that optionality is also very important, because there are alternatives to do that. You can go do that in the, you know, in an index and do options on an index and get the same kind of thing. It's just not packaged up as neatly as it is when it comes as an ETF. Right. And so I think that's important as well. It's important that people understand the fees that they're paying to put the optionality on, essentially in a kind of secondary way. Right.
I would also just add that most of those ETFs on a total return basis are losers. So you'd better off just owning spiders, for example, as opposed to owning spiders and in the JEPI fund and selling calls against that position. But that doesn't stop people from just piling more assets into these kind of overriding ETFs as an example. So investor education is, I think, important there. As Matt says, you can do a lot better yourself in a lot of these cases, selling calls systematically.
Yeah, and so one of the things I think is the case is you have like the SPX, but then you have like the micro indexes. And if I'm not mistaken, you can have a spider's position, a SPY position, and then actually sell or trade options in that cash settled index, and it'd be offsetting too, right?
Yeah, and better tax treatment, 60/40 tax treatment,
Yeah.
all sorts of things, and no fees, no 2%.
Gotcha. So we're kind of running out of time here, but I want to ask each of you, what do you think? What has impressed you most in regards to options markets over the past year, and how does that inform your approach maybe going into next year?
I think the most impressive thing, to be honest, is the protracted amount of volume that we're seeing and the stickiness of the retail investor and how involved they are on a daily basis. It really, it's something that I thought might look like this and then it might dip down, and it has not done that at all. It only continues to grow.
Yeah, we see retail and traders getting much more sophisticated now and being able to take advantage of options in a much smarter way. And then the second thing is the liquidity of the options market is very impressive. Through all the bumps and bruises over the last 2 years, weird things happening in markets, the markets stay pretty tight outside of August 5th this past 2 months ago. But other than that, the liquidity is great and it's very robust, and that's pretty impressive.
Thank you guys so much.
Yeah, thanks.
Give them a round of applause. All right, next up, I want to bring up Sean from TickBlaze. Give him a round of applause. Yeah.
Morning, everybody.
So we've got a pretty good outline as to what we're going to talk about today, and if we go over it, it'll be okay. But Sean's actually got a pretty interesting setup out there. So do you want to tell us what's going on out there with the computers and so on?
Well, we're giving away free laptops, so if you guys come by the booth, just scan the code, and if Lady Luck's on your side, you're all set. No, we've got the booth set up down at the front entrance, and just looking to meet strategic people and excited to have those connections. Yeah.
And so tell me a little bit about what is your role? What do you focus on kind of like a day-to-day?
I'm more of a systems architect. So ultimately, I spend a lot of time in product. I spend a lot of time in the development side of the company, driving most of the sales and marketing, and mainly investor relations, working with a lot of our investors and strategic partners.
So tell me a little bit about what TickBlaze is, and what is it that you're kind of essentially launching at the Benzinga event today?
So precisely, we chose the Benzinga event strategically because we feel that Benzinga and most of the people here have a very common mission, and that institutional grade technology and resources should be made available to the entire industry, including the retail. And so TickBlaze was essentially built originally for institutions, quants, hedge funds, family offices. And with our teams and our several companies and experience in the trading technology side, we've expanded the product offering to be suitable for both the retail and the institutional side of the industry. And essentially, we're using this event as the official launchpad for us opening up the platform for the first time ever for retail clients.
Gotcha. Thank you. So, you obviously have tons of, we kind of talked about this in our prep call, but you have complexities and challenges that you spot across, whether that's retail market participants or those that are more maybe institutional and buy side or even run prop operations. So what would you say are some of those complexities and problems that you see?
Well, I think every good business needs to identify problems first before they can try to solve them. They need to understand them fully. In the trading space, let's talk traders first, right? Traders are on a constant hunt for profitability. Their only objective is to make money, and they're always challenged by complexities of changing markets, dynamic volatility, And really, they're on the hunt for strategies, education, and technology that's user-friendly and accessible that they can actually use to trade. Brokers, on the other hand, well, they're essentially looking for innovation. It's a constant battle for lower fees and user signups and trade activity, right? And you can only drop your fees so much before you have to really question whether you need to change your business models, right? We understand that user acquisition for brokers is primarily the primary focus for them because we want to get as many users into brokers as possible and get them actively trading live accounts. On the prop firm side of it, outside of the much anticipated regulatory changes that are coming, it's really about defragmenting the space. They're really in a fragmented environment, having to piece together so many multiple service providers just to start their company and start to scale their company. And we see that as too many cooks in the kitchen, so to speak, right? Like we want to defragment that, making it easier and actually more cost effective and to drop those costs for the prop firms. And the hedge fund side, the institutional side, the family offices, the portfolio managers, the quants, their main struggle is technology disadvantages. Unfortunately, the industry does not have platforms that are built strategically for their needs. Their needs are completely independent from the retail, and they're completely different than brokers or any of the other family offices. They need portfolio level infrastructure. And to this date, there hasn't been those types of offerings in the current marketplace. And that's why we're here. I mean, TickBlaze is designed to cater to each of those types of problems.
So tell me a little bit about how exactly you talk about defragmentation and so on. How exactly is TickBlaze solving some of those problems?
Well, we're an all-inclusive solution, right? And so ultimately our goal is to be able to have a one-stop operation so that people can come in, whether you're retail, whether you're broker, whether you're prop, whether you're institution. We have everything built in-house so that we can defragment that and have an all-inclusive technology offering that's scalable.
Gotcha. Now, tell me a little bit about in terms of, when I was out there and I'm kind of looking at the platforms and stuff like that, where I kind of want to go back to your background, when you were when you're thinking about building this technology and so on, or what does the discovery process look like when you're trying to understand what are exactly these problems and so on, especially from the TickBlaze perspective?
Well, it's a funny story because we started as, probably close to a decade ago, building schools, working heavily on the education side, the retail side. We've partnered with pretty much every prop firm or broker in the industry, every trading platform we've built applications into. So we understand their code base, we understand their product, we understand their disadvantages, their advantages, their pros and cons. We've seen it from an end user perspective first. So when TickBlaze became an opportunity and when we moved forward with the acquisition, it was really about seeing an opportunity that we could bring technology that didn't exist in the space and be able to innovate and be able to provide advantages that unfortunately are at a disadvantage right now. So, I mean, for us, because we can see the differences between all the products and we understand what the consumer uses and needs and what the partners and the businesses demand, we're able to cater to both the B2C and the B2B side, coming from experience and perspective rather than just starting a company and saying, hey, I want to do this. We actually worked in the industry for a decade, integrating to all of the other companies, so we understand it fully.
Gotcha. Okay, so one of the things, and so you kind of talked about it, and we had the prep call, is what opportunities exist for potential partners in this room to collaborate with your company and leverage TickBlaze?
Well, if we're going to work together, it really boils down to three core pillars, right? Before you would ever want to partner with anybody, I think you need to understand what we stand for as a company. First of all, is synergy, right? We have to be able to understand your needs and problems so that we can solve them. And that makes it make sense. The second one is it needs to be smooth, right? Everybody in here has had their fair share of friction in business, right? We don't need to create more of it. We want to make sure that you can come on, make it smooth to onboard the technology and integrate. We can deploy it quickly. And then that way it's a very enjoyable experience working with us. The last one is it needs to be profitable and scalable. And unfortunately, this is where I feel like so many companies get it wrong. Everybody builds their businesses to be able to create pricing structures that are suited to their only interests. When really I never understood that, right? Like, why wouldn't you want to build your pricing models that meet the demands of your partners so you can adapt into their infrastructure and business models and scale with them rather than forcing them down to your only path of interest, right? So TickBlaze has built different pricing structures and partnership structures for different laterals because we understand that brokers price their businesses different than a hedge fund or different than a family office or a prop firm. So we've built flexible pricing and dynamic scalability so that you can have a synergistic, smooth, and profitable partnership when you work with us.
Gotcha. And so how do you inform kind of the continuous development process, what informs that, and what do the conversations look like with those potential participants that are on that platform?
So let's dial it back a little bit, because one of the things that's interesting is that TickBlaze is a hybrid solution, right? And what that means is we're actually two platforms in one. We're built to service the full life cycle of the discretionary manual traders. And the reason we do this is because we can service the entire, do-it-yourself trader, the retail trader, the entire industry of that side. But we're also built to handle the institutions, the quants, the hedge funds, the family offices, the portfolio managers. And what that means is we can service B2C and B2B. So let's talk traders for a second. We've built pre-built strategies, advanced indicator suites, custom studies, all into the technology, so that we can provide resources that traders need immediately without having to figure out where they're going to buy their strategies, where they're going to trade, and how they're going to basically make money. Most importantly is that we want the technology to be very user-friendly, because the market's already difficult as it is. They don't need that extra complexity. So we can have a trader up and running in less than 5 minutes with live market built right into the technology. Now, for brokers, it's really about providing innovation for their clients, right? We can service more of a bigger audience for them without having multiple platforms that have to be pieced out to be able to do that. And we can drastically help user acquisition for our partners. We'll get into the community in just a second. The third thing is prop firms. Because we have an all-inclusive solution, we can basically help scale with dropping their costs and having everything built into the tech. But with funds, and anybody in here that's interested in looking at institutional need, we have technology that is years ahead of that as anything in the industry. And what that means is, imagine an environment where you could build 100 trading systems simultaneously, backtest them, deploy them, and trade them in a portfolio level infrastructure against 10,000 markets in less than 3 minutes. We can service that now. And there isn't technology in the industry that is built to do that. And we're proud to be able to pioneer that. Now, the key here is that TickBlaze is built to scale and adapt with our partners. We're broker neutral, we're multi-asset, and we're also multiple code language. TickBlaze is built for C# and Python development, which allows us to cater to a much larger development environment. And the biggest thing for me, and if you guys could do me a favor, if everybody can humor me for a second, and where's your cell phones? Can everybody just hold up your cell phone for a second? Like, play along for a second. It's important that you guys see this. I guarantee, I'll bet my company on it, that everybody in here has a social media and social network app installed on your phone. Am I wrong or am I right? Right? Well, we understand that technology is only 50% of the battle. So by having great tech, that's part of it. But we spent the exact same time building out the first ever open source infrastructure for a peer-to-peer social network. We've built basically the next Facebook and Instagram for traders and developers and institutional clients and partners that we work with. And we know that so that we can scale user acquisition and leverage all of that traffic for all of our partners. So we're not just a trading platform, we're actually an ecosystem, and frankly, we're the future.
Okay, gotcha. One thing that I think is really interesting is, you saw, and this is kind of from like the retail lens. When I joined Benzinga, it was probably 2019. That was really kind of like this eruption of like, interest in trading, and you had fees basically go to zero and so on. And so that brought in a lot of market participants, but, with very kind of short-term time horizons, right? How do you think about graduating those users to someone with more kind of a longer term, more sustainable approach using platforms like TickBlaze? What are the sorts of conversations you have, within your own company and with partners when you're trying to think about how do you graduate those users and equip them with the technology to basically own their financial future?
It really is about understanding the barrier to entry for all of your customers. So from the trader's perspective, it's a very costly industry, right? They need to spend thousands of dollars on tools and education and resources. And if we can provide all of that infrastructure built into the technology when it comes to strategies or indicators and algorithms and live classrooms and online education built in around the community, traders don't have to spend $10,000, $20,000 just to get to where they need to be. It's all built into the tech, right? On the business side, let's face it, like we all want to see success, but at the end of the day, when you go home, you're really thinking about how can I grow my company? Like, how can I actually get more users? How can I scale my clients? How can I add more value? And as a company, we put that at the forefront of our strategy. Like we want to look at what do our partners need? How can we help scale our partners? Because the way that we do that is providing value to their clients. And if we can do that through our technology and not just put our interests first, then realistically we become a technology provider that is putting our partners before our own and interests, and we see that as a very successful strategy.
When you're thinking about like, you know, technology, building this technology, we talked a little about earlier about how you inform that development process and so on. And so, you know, when those traders are getting onto that platform, at least, you know, particularly because Benzinga has always been focused on individual investors, how do you educate them on what it is that is on that platform to be able to use that all the capabilities that it may have?
Well, I think what we've learned over the years in business is that, you know, it's not so much getting them to buy your product, it's getting them to stay using it. And, you know, in SaaS, when you run a subscription-based company or a SaaS company, it's all about user experience in the first, you know, 3 touch points. You need to wow them quickly. You need to not waste their time, and you need to not confuse them, right? If you're a manual trader and you're a discretionary trader, and yes, we have algorithmic solutions, the last thing you want to be doing is trying to send them down the wrong path within your customer experience, right? So we really have segmentation built out into the product. So when you come in and you download a free trial of the tech, we automatically are finding out what are your interests, what are your goals, what are you looking to accomplish, where do you want to go? And by definition, we've built strategic nurture sequences in place so that we can cater all of the education strategically to the interests of the user, whether that's a trader, whether that's a partner, whether that's a developer. And it's critical because if you miss the mark in the first 5 minutes of them coming into your product, if they have a friction experience, you've lost that client.
Yeah, so that's what I was getting at, was trying to understand how that onboarding experience is different from maybe other technology and so on.
Yeah, for us, it's really about screening. I mean, we can get them in through marketing. That's one part of the battle, but it's about understanding your client quickly when they come in. And we ask strategic questions, we ask probing questions through the free trial process, and making sure that we meet them with a success specialist. We get them into the classrooms, we get into the community, and so forth. I mean, it really is about listening rather than just force feeding the features. It's really about understanding the pain points of your user. Yeah.
All right. Seems like we're running a little bit out of time, but thank you so much, Sean, for joining me today. And hopefully this is a successful launch.
Yeah, thank you guys for being here. Appreciate it. Thank you, Ronald. Thanks.
So my next guest is Rob Hoffman, and we've been in touch probably since 2019, my early days of Benzinga, as I was kind of talking about. But he is the CEO of Wealth Charts, a really interesting story. I'd like to welcome him on stage. Please give him a round of applause. How's it going, Rob?
Doing great. How about yourself?
I'm good, good. Hanging in there. So how long have we known each other? Probably since 2019?
Yeah, that's been a while.
Yeah, yeah. And so back in those days, I think Wealth Charts was, you know, kind of more so. When did Wealth Charts actually become a thing?
In 2019.
2019, okay. And since then, there's a lot more functionality. You have holes, whether it's whatever product you're trading, whether it's options and so on, screeners, you name it, and we'll kind of get into it today. But tell me a little bit about, you know, kind of going back in time. How did you get started in this market?
Well, it goes all the way back decades now into the educational financial school training side of the business. I went in and had become a better trader business. And the big challenge with that was it was great to build so many wonderful relationships. I mean, I had students coming to 40th birthday parties, 45th birthday parties, you know, coming for big special events. In fact, we had several students at our wedding to my lovely wife, Sarah. And so wonderful relationships. But the problem was that meant I was always on. I was, you know, in the business, you know, versus working on the business. And so that led to some challenges, but it all started with the educational side.
Yeah. Tell me a little bit about how, tell me about trading, because you are a trader, right? And so you understand these, you know, what you're building, for what people want, and how to build it in a way that really resonates with them. Is that right?
Yeah, well, as you know, I've won 33 real money trading competitions around the world. So I guess I really am passionate about trading. So what I do is even though that's my trading style, I have a certain trade style. I listen to my audience, And in every company that we built, it's all about, and even Sean touched on this in his presentation, it's about listening to the audience. That's a real huge thing. We're constantly doing surveys, getting feedback, having special private client events to understand what the audience needs. That's extremely important to us. And every brand that we'll talk about in this building scaling feature here, it's all about listening to the clients. So even though I feel like I know a lot that people can benefit from, hearing their thoughts and their needs is super important to the building scaling process.
Yeah. So I wonder if this resonates with you, but one of the things that got me into markets was kind of like the thrill of being a participant, right? Trading, there's things moving around, but what kept me in it was just kind of the complexity, the depth of it, actually understanding and learning about markets. When you're doing that, you're really appreciating it more, and it becomes much more sustainable, and you add longevity to your kind of career as a trader. At least that was in my opinion. But I'd like to kind of talk about how you have that trading experience. How does that kind of bake into the whole idea behind become a better trader? And what were some of the early challenges you had when you were trying to build that as a trader?
Yeah, so getting a following, maintaining the following, listening to the needs of such a diverse student base to provide them what they needed, those were certainly challenges. And I think really the biggest challenge was just it would all revolved around me. I didn't have an army of other educators and things of that nature. It was really about around me. That was one of the biggest challenges, that I was always in the business, not working on the business.
Okay. And how did you think about scaling that up and finding people who are aligned with your vision or your passion about markets to make this into what it is today?
Well, and this is a really important feature for everybody that's out there in the audience that has their own fintech business. What I did was I used all the relationships. I have so many relationships in the business, both on the retail client side, the institutional side, but also amongst my peers. And a lot of people, they say, and this is a really important piece I hope everybody takes away, they look at everybody as competitors. But in reality, working with colleagues in the space, like I was pointing out Sean here a few minutes ago, he at first blush, a lot of people would say it's competitive, but actually he's more on the algorithmic side and things like that. There's synergies between our companies. So what I did was I worked with people like Sean and other companies to actually build a big online trading and investing format, because lead generation, quality lead generation, is a really hard thing in all of our spaces. We're all paying a lot of money, and a lot more money than we did pre-COVID, to get quality leads into our ecosystems. And so what I did was I built a new ecosystem called the Wealth 365 Summit. And so this is a quarterly event that has 60 speakers over a 6-day event. And we do those. We just did one in October. We do them in January, April, July, and October of every year. I've done it for years. Benzinga has been featured on it, as some of the people in this room. So what happened is leveraging those wonderful quality relationships to find a new way to bring audiences to us, so kind of a built-in traffic, but with quality leads and quality education and content. There's a lot of education in the fintech space, but not necessarily all of it quality. There's a lot of leads we can all buy in the fintech space, but not a lot of it quality. As many of you in this room today can probably think of a couple of competitors that you'd also consider maybe be friends or colleagues, and leveraging those relationships. Hey, let's put on a show together. Let's do something special, and then we can drive traffic, to those events and give everybody a great experience. So that's what led to the next phase of Wealth 365 Summits being formed back about 8 years ago.
Yeah. So, I think that's one of the most natural ways. I mean, when Benzinga is putting events together, at least on the fintech side of things, when this event first started, it was kind of like a deal making. Well, at first it was to recognize people who were disrupting and creating interesting things, but then also to bring people together so they could deal make and so on. And so Benzinga, by that, by doing so, kind of became like this thought leader and so on, that people would just naturally gravitate toward for, being put together with other people for information and so on. But obviously, the company grows up and you kind of learn about, what different things people actually want, right? The business changes, right? When we started the digital assets event, it was very much focused on retail market participants, but we grew up to kind of bring together the people who are building those products for those retail market participants, so they have a better experience and they're much more engaged and they last longer as participants. So tell me a little bit about kind of Wealth 365 growing up, the challenges that you had with scaling it, how you thought about some of those challenges and solving them.
Yeah. So first of all, finding the right kind of peers and partners and relationships, because everybody wants to be in front of audiences, but will they provide the right content? And that's important because remember, I started with the educational side of the business. Many of you have a software platform that you want to share with your audiences. So just think about a difference of me having education, you having a fintech platform of some sort. So finding other people that also have fintech platforms and offer education in similar spaces that you're in, but that are quality and do a good job of it. It's hard. It's a lot easier to find a lot of people that want to be on your show than finding quality content and education. So that was one of the big challenges, finding people that would support the show, could provide their own traffic sources as well as the ones that we provided, providing good quality content versus I'm just going to come in there and jam my software down their throat and sell something. It's like, hey, let's educate them, let's make it a valuable experience. So those were a couple of key challenges, and trying to get the right people to come on. And at that time, there was an industry kind of thing going on where people are transitioning, kind of tiring of some of the physical events, and we're looking for an alternative. So we offered this online solution, but a lot of the wonderful long-term names in our space were not as tech savvy, and the technology was a little bit of a challenge to get them used to using the online technology, especially early on in our online shows.
Gotcha. And so the next thing I really want to talk about is kind of the wealth charts journey, right? So what kind of prompted that? And so obviously you built a really big network and audience with Wealth 365. And so, you have this idea, you build on this idea. How did you also think about leveraging that audience and that network to kind of now bring them into that ecosystem with wealth charts?
So Wealth Charts is basically a legacy play. For me and my family, I have my lovely wife Sarah and my son and my daughter Logan and Mackenzie, and my background was in technical analysis, and so I've always been very partial to chart and technical analysis trading. And so for me, it was kind of coming full circle from my teenage years when I was playing a lot of chess and would always look at the markets and think, several steps ahead, to think about, okay, hey, I think the market's doing this right now, but I think it's going to ebb and flow back to here. So I always enjoyed the markets, but I always came back to technical analysis for me. So, I've always used charts in every single one of those 33 competitions I'd won. I'd use charts for my analysis. And so it was kind of bringing it full circle, something that didn't require me to be in the business each day. Wealth 365, the first couple of years, it was my relationships that brought those people. Many of you, like I said, have your own fintech softwares here and that. So you have relationships with colleagues, competitors, and that's a great lead source to build these financial shows and that within your specific industries. So, but that requires you initially to get it up and running. Then after people get to know, like, and trust your staff, they'll start to work with them. And so now my staff handles all that for the big financial shows. But then Wealth Charts was the next evolution where it doesn't require me. Like right now, Wealth Charts is running just fine. And I'm here with you guys. I don't need to be here and doesn't need to be hands-on today. So Wealth Charts was meant to literally be a legacy play. We've had offers to buy it out, which is always comforting. We've rejected them all, but it's comforting to know that there's that opportunity for my kids, and my wife is younger than I am. So it's nice to have a legacy play for them. So Wealth Charts started as a legacy play, but it's become so much more because it's kind of a passion project, being that I'm so much into technical analysis and that.
Sure. And so you have charts on that platform, but you have much, much more, whether that's news, calendars, whatever, name it. But you also have tools, we talked about earlier, we had a panel, we were talking about options markets and so on, and there's just been so much increased participation in those markets. And so with that increased participation, there's a lot you can glean from that information. So talk a little bit about how Wealth Charts has grown up and how you're helping users kind of glean more information from some of these different markets and so on through the tools and the data that you're adding.
Yeah, so we have a lot of great data feeds. Benzinga, shameless plug, has a lot of great APIs that for all of you with your fintech platforms and that, you can see it's amazing the diverse capabilities that they have. But from my perspective, it really goes back to listening to the customer. We always think we know what the customer wants, but you really got to ask them, and then you got to get clarity on what they're looking for. So wealth charts, I mean, Renato, I remember over the last 5-6 years, you were writing articles on wealth charts, and every year, every couple of months, every 6 months, it was like, yeah, now we've added this, and this. You remember that? And so, and I know there was a broker that was in the audience a few minutes ago that we integrated with those brokerages, and so we have stocks, futures, options, different types of integrations, because people are like, well, look, I love your platform, but I really love this broker. Can we get them together? So we'd start integrating those platforms. People wanted to code their own indicators on our platform, so we listened. We built WealthScript, coding language. Everything we've done with wealth charts, pretty much 100% of the things that are on wealth charts were user driven. I can't emphasize that enough. We've been fortunate to win a lot of awards over the last several years since coming on, but it's really just because we're giving the audience what they want. That's really our secret to success with wealth charts, and it's been a great legacy play because doesn't need me to be in the business each day.
Yeah, one thing I was talking about earlier with Sean was, what does that discovery process look like? Trying to get that information. What is that demand from that customer? What does that discovery process look like on your end?
So we have several. We have an all-day open forum where people can log in throughout the day, Monday through Friday, 9 a.m. to 5 p.m. And they can come in, post suggestions, ask questions. So it's kind of a technical support and also open suggestion format. We have in the upper right-hand corner a little question mark box that allows people to submit questions as well. And I do a Meet the CEO event where people can come and just give me directly their feedback to tell me what new features that they're looking for in the business. And I can't tell you how invaluable it is, because what happens is I get to hear directly from people what they want. And also my team tracks every single request. And then it's basically, Pareto's principle, where are 80% of the requests coming from, right? 80% of the people want this, 20% want this. So let's go build this thing. We can cover 80% of our audience's needs in one particular development. So, having those constant touch points, plus your audience feels like they're part of something. They feel like they're part of a growth of something special. And they feel like they're actually like, I helped build it. I just had people up here today. And there's somebody in my audience sitting here right now who's been with me. I don't know, Stuart, do you mind if I mention it? I mean, you've been with me since the beginning. You're like, I remember when you were just this, and now you have all these wonderful things, right? So there, where it's all about listening to our students and listening to what their needs are, and taking that to heart, not just say we did it, but to actually develop it. And Renato, literally better than anybody. I mean, you've written so many articles over the years about what we've done, the evolution. When you month over month, quarter over quarter, that innovation cycle is intense.
Thank you so much, Rob. That was great.
Yeah. Great to be here with you. Yeah. Thank you.
All right. Round of applause, please.
Thank you.
Thank you, Rob, Renato. Great session, guys. Thank you as always. Really appreciate it. Guys, I want to pause for a second. I'd like to recognize Renato. He put together this entire agenda and the agenda downstairs. Let's give Renato a round of applause, please. Thank you. Thank you. I've never seen him turn that color before. That was great. All right, next up, from hype to utility, how crypto is redefining assets and ownership. Here to moderate this panel is Jonas Schoenberger from 1IO. Joining him is Mitchell Diramondo, co-founder and lead project manager at Steelwave. We've got Jay Jacobs, head of thematics and active equity ETFs at BlackRock. Alan Konevsky, EVP and Chief Legal and Corporate Affairs Officer at T0. And Ian Graham, SVP at Lockton. Let's give it up for our next session, please.
All right. Good morning, everyone. Thank you for joining us today. We're going to look beyond all that hype that's been going on, especially around Bitcoin since the re-election of Donald Trump. Obviously, he's being called the first crypto president stepping into the White House again. And I have a great panel for you ready. So why don't we start with a quick round of introductions? I go first. My name is Jonas. I represent 1IO, oversee all communications there. I'm a novelist as well, and I've written the first Web3 thriller, which is coming out on Friday. And we're gonna look at a couple of things that are going on in the space and really trying to deep dive into how we can move from hype to utility. So why don't you start, Mitch?
Yeah, my name is Mitch Diarmando. I'm with Steelwave Digital. Really what we are is Steelwave is a massive real estate development group. So I'm kind of bringing them into the future here. We're trying to bring our portfolio into the tokenization space. We're doing some strategic acquisition ideas, and we're pretty excited to be on the front lines of this new push. So.
Great.
Hi, Jay Jacobs with BlackRock. We are the world's largest asset manager, and through our iShares lineup of ETFs are really focused on enhancing access and improving financial outcomes for investors around the world. This year, we brought out our first 2 digital asset ETPs, IBIT, which is the Bitcoin ETP, and ETHA, which is Ethereum. IBIT has gone on to be the fastest growing exchange-traded product of all time, crossing $40 billion in 10 months.
Hi, I'm Alan Konevsky. I'm with T0. T0 is one of the earliest innovators with the use of blockchain in the capital markets. Our focus is to support this technology in various phases of primary and secondary liquidity in private markets, as well as other use cases. We're supported by a number of industry-leading participants, including the Intercontinental Exchange, and it's terrific to be here. Hopefully more utility than hype.
And Ian Graham, I'm at Lockton. Lockton is the world's largest privately held insurance broker. I lead our digital asset blockchain team here in the US, so we help clients understand all different types of insurance and exposures that they may have. And a big part of our job too is on educating insurance markets. There's a lot of misconceptions out there, so a big piece is making sure they are providing the capacity that our clients need.
Great, we're going to dive into that later as well. So Jay, the SEC previously approved 11 spot Bitcoin ETFs in January, followed by spot Ether ETFs in May. And since their introduction, spot Bitcoin ETFs have generated significant trading volumes exceeding 500 billion. And BlackRock's IBIT commands a dominant market share, accounting for nearly 2/3 of the activity going on there. And yesterday, the OCC announced its readiness to manage the clearance and settlement of options on spot Bitcoin exchange-traded funds. So with major players like BlackRock on the field, how do you think the markets around crypto are going to evolve in the future? What is there to come?
Sure. So, in a lot of ways, what the exchange-traded products have done, like IBIT, is just make Bitcoin more accessible to more investors around the world. For many, they had already been getting exposure to Bitcoin, buying it directly through exchanges, maybe buying futures, maybe buying stocks that are kind of tracking stocks for Bitcoin. But in many ways, those can be impure or less than desirable ways of getting exposure to Bitcoin. An exchange-traded product you can buy in a brokerage account. It can sit alongside your stocks and bonds and really just provides easy access for buying any exposure, whether it's the S&P 500 or a basket of bonds or now Bitcoin or Ethereum. And so this access vehicle has become very popular because it's simple, it's easy, and it's delivering people the exposure they want in a tax efficient and high quality wrapper. What I think is changing beyond just that, maybe that person that already owned Bitcoin that now is buying it through IBIT, is there's a whole world within traditional finance of people who maybe previously couldn't or didn't have the capability of getting exposure to digital assets prior to these products existing. You could think about kind of traditional asset owners, pension funds, endowments. You could think about financial advisors across the United States. For many of them, they just didn't have an easy way of getting exposure to these assets. Now they do. And so what that means for us at BlackRock is really starting an educational journey for a lot of these professional investors who haven't considered these assets before on simple building block items. What is Bitcoin? How does it fit in a portfolio? How does it compare to Ethereum? What does it mean to hold Bitcoin alongside stocks and bonds? So I think from our perspective, it's really we've now kind of provided that access through IBIT. It's about the educational journey of bringing traditional finance more into this world and more up to speed with how these assets work.
Great, thank you. So one of the things you said there is making Bitcoin more accessible, or the crypto space as a whole has a problem, in my opinion, with communications. Right? It's very, very, very complicated for traditional investors or for the common people out there trying to put their money into the space. So a question for all of you, whoever likes it, from your perspectives, what among, apart from communications, are the biggest challenges, whether regulatory, technological, or cultural, that are slowing at the moment the adoption of tokenization and the access to the market in markets like the US compared to regions like Dubai or Singapore?
I mean, for the real estate side, it's all regulation. We launched a fund probably about 12 months ago, and we wanted to put it in the US, but we just couldn't. So we ended up putting it in Bermuda. It's a traditional LP vehicle, but we give our investors the option to tokenize. So you're not really saying, hey, I want you to go tokenize your position. It's like, hey, we're giving you this option to get some secondary liquidity. And I think that's what's going to kind of warm up your institutional investors to this space. But again, they're not going to do it if there's no regulatory clarity. So as guardrails kind of come up, I think you're going to see a big adoption of that into the space.
Yeah, look, I think people love to blame regulation and politics, and to some extent, it's an external factor, and it's an easy windmill to focus on, and a lot of it is true. And we might be entering a phase now that's going to resemble, worst case, benign neglect compared to the last 4 years, where enforcement is going to step way down, except for true bad actor type situations. And you're going to see the market, at a minimum, continue to operate the way it has been, minus the pervasive threat of regulation by enforcement. You might see some rulemaking at the SEC and other agencies, particularly as they rediscover that there's a lot they can do with exemptive authority that doesn't require new legislation. You might also see some of the proposals that we've seen talked about on the Hill. And remember, crypto lobby had a lot to do with who is going to be there and who isn't going to be there when new Congress is seated and the new president is sworn in. You might see some of these ideas translate into legislation, whether it's going to be revolutionary legislation or more piecemeal, impacting stable coins, for example. That's a separate conversation. But worst case, you're going to have benign neglect, and the market can continue to develop in that environment pretty well. I think one of the bigger challenges, and it's not one that we can point a finger at somebody else for, is product innovation. And they're two separate questions, right? We've talked about new products that might make native digital assets more accessible to investing segments that before that haven't felt comfortable or weren't able to touch them from an infrastructure perspective. So you have ETF wrappers that make native digital assets available, and that's a terrific thing. There's a separate question about using blockchain technology. That's both the ledger and, importantly, smart contract automation to build assets. And that's the trick. That's the next challenge. And not to use them to build assets for their own sake. I mean, you always think of Steve Jobs, right? Consumers don't really care what the underlying rails are, what the guts are. They want features that make their lives easier. And so how do you build new financial products using this technology, the ledger piece of it, and smart contract automation in the way that is appealing to retail and institutions, and communicate it effectively, because we do have a lot of baggage, rightly or wrongly, that we have to deal with.
Absolutely. Yeah, go ahead.
Yeah, just real quick. I would agree with, obviously, the regulatory confusion and hostility in some instances. You mentioned communication as well. We just see it from our slice of connecting companies with insurance companies, but I imagine it's a problem with connecting digital asset companies, fintech companies with all sorts of capital markets and more traditional established players. I think investing the time and really making sure those counterparties really understand what you're doing, what you're not doing, that message is sort of positioned in the right way. It takes a lot of time, it takes a lot of investment, but that's where we've seen true partnerships between the more traditional insurance world with our clients really work. So I would echo
Great. Yeah, let's dive into the insurance side of things for a second. So, how is the insurance industry adapting to support tokenization, and what roles does insurance play in fostering trust and enabling growth in this space?
Yeah. So look, I mean, when I think about utility, I think about continued adoption and how, in our role, we can help the industry continue to evolve, grow, prosper, and just foster adoption. Um, Look, it's a slow-moving industry, and it's taken some time. But the market, the insurance market, to their credit, has really come a long way, and there are a lot of very creative, forward-thinking insurance companies out there and brokers like our team that are really trying to provide meaningful solutions, not off the shelf. This fits for a bank, so it's going to fit for you. But really, again, trying to dive into what is the actual liability, what are you actually doing, what are you not doing, why are things set up that way, and trying to drive meaningful solutions for the industry.
Great. So we see a lot of industries gathering in the digital asset space. I'd like to dive into the real estate part. Mitch, you said tokenization is a game changer in asset ownership, and it's about modernizing investment strategy for a new era. And real estate has been seen as a potential candidate for tokenization, but is also known for being traditional and slow as an industry. So what lessons can we draw from this sector's journey into tokenization, and what other asset classes might be next?
Yeah, I mean, I'm probably the youngest in my company by about 20 years. And when I started chatting with people about this, they were like, "What are you talking about?" But what we started to see is, we see blockchain as a game changer for asset ownership and transference. And I'm not saying, we're going to go tokenize a $100 million building tomorrow, but it's kind of like the CMBS days where you can slice up your capital stack and you start selling out LP slices of that and call it new forms of debt, new forms of, raising vehicles. But it opened up a lot of doors. And especially for groups like us, like, we have a lot of core assets and we don't really want to sell our core assets. So if we can tokenize out, give cash flows, but still keep those assets on our balance sheet, it's a big plus for us. And obviously the real estate space right now, if you're an owner, it's probably not the best time. If you're a buyer, pretty good time. In San Francisco, we're seeing what was $1,400 a square foot trade $200 a square foot right now. You're in a really good buying opportunity to really seed, some killer assets into this space. That's what we're trying to push right now.
I'll make an observation that real estate and a lot of other real world assets probably fall in that bucket as well. And I have twin vectors on blockchain technology. One is using the technology itself, whether it's a distributed ledger or whether it's smart contract automation, to introduce efficiencies into the asset itself. In the real estate space in particular, you're talking about title transfers, for example. We used to have a sister company called Medici Land Governance that was innovating outside of the US with tokenizing real estate titles. So it's a really balkanized system. It's opaque, it's expensive, and putting real estate on blockchain makes a lot of sense. Title insurance costs go way down, other efficiencies are introduced. The other vector on it is to use blockchain technology to innovate with securitization of these assets. That's the one thing that's important to keep in mind, is that tokenization in and of itself, in the United States at least, given how the law is, typically means also securitization for most of these assets. And so you are then innovating with use of distributed ledgers and smart contracts to support how these securities are structured and sold. Other countries, tokenization might mean something that actually provides you a less onerous way to securitize and fractionalize and raise capital against your assets. In the U.S., it's one and the same, and so those twin paths use technology to improve the asset itself and use technology to improve fractionalization and securitization. Twin and separate challenges, and sometimes they're commingled, but they really pose very, very separate and vast opportunities in the U.S. or abroad.
Anybody want to comment on that? All right, Mitch?
I mean, for us, we're seeing this as access to new capital, right? We've been dealing in your traditional players, big institutions, pension funds, slow to move. this is a new form of permanent capital to us, where if we can go, all right, let's go, buy Westfield Mall in San Francisco and make it into Chelsea Market, right? We don't have to go find a JV, go handhold everyone to do that. We could just bring it to open market and raise it. Now, I don't think that's going to happen, 12, 18, 24 months from now, but I do think that's the future of this space. And what that does is it allows international money to come into these private investments that they previously would not have been able to do, at least not at the minimums that, they can wrap their heads around.
I think on the broader trend here that's really interesting is, as you were just saying with tokenization, it's access to new capital. In some ways, tokenization can be seen as taking traditional assets and making it available to kind of assets that are more native to decentralized finance. In the ETF world, we took a decentralized finance asset like Bitcoin and Ethereum and brought it to traditional finance. So what you're seeing is kind of two directions of travel here, where both traditional assets and digital assets are looking for new pools of investors and really looking to diversify their asset base. So I just think it's kind of an interesting contrast to see these, kind of traditional to DeFi and DeFi to traditional.
And I'll just add, I think as we're all talking about sort of continued adoption, one of the major conversation points when we're talking with firms involved in tokenization, asset managers, we go into some very deep brainstorming discussions around, okay, what are the actual potential losses here? And this has helped get some of the insurance companies on board, actually, because the assets underlying tokens are usually very secure. I mean, we'll take real estate out of it for a second, but things like gold or T-bills or US dollars, I mean, those aren't really at risk. And so that's helped get some insurers, again, a true understanding of what is the actual loss that they would be looking at, or what's the client actually trying to insure. I mean, it's usually any sort of liability that an asset manager might have to their customers if customers weren't able to access the tokens, missed out on a trade. So it's almost a lost income liability from a tech failure, or if your platform is down. I bring this up just because I think it's been, it's been another conversation point of really getting at what the true risk is, what the true loss is, and that's helped, again, bring some more traditional insurers into the space.
Great, thank you. Mitch, you said players like BlackRock are beginning to recognize the potential of tokenization. We already touched on that, and signaling the dawn of what could easily become a $1 trillion market by 2030. Now, what do you think, apart from what we talked about already, needs to be done to really realize this?
I mean, I think we're still in the beginning stages of this, right? What I tell people coming into our fund, I go, look, the way it's traditionally set up, it's almost like having a TV with like 3 channels. What this does is it brings streaming to your TV. It's like it opens up so many different avenues to get it. And I think over time, you're going to see a lot of these archaic, LP ownership certificates or, syndicates morph into this and be brought onto chain just for efficiency. I mean, you could probably speak to that pretty heavily with what you got going on.
Yeah, great. My take on coming back to the from hype to utility thing, it's not just about money and finance, but it's also about the tech underneath as well. And Ellen, you said, like Steve Jobs said, when the technology becomes invisible, the people really want to use it. I don't need to know how my phone works to call my mom, right? So we talk about the shift from hype to utility, and crypto and digital assets can be a driver for digitalization. Also, we see it a lot in Europe, where the adoption of cryptocurrency leads to a broader digitalization in small and medium enterprises, especially as well. How is it in the U.S.? Would you say this is a true statement for the U.S. as well?
Yeah, look, I think it's a very fair point that crypto is the gateway drug to blockchain. That's true, and that's the good thing about it is, and it's sort of the paradox as well. On the one hand, it elevates the conversation about the utility of natively digital databases with natively digital assets that are self-regulated in an environment that is transparent, accessible, inclusive, cheaper, and faster. Again, some of the technology hasn't caught up to the maximalist vision yet, but that's the idea, and it elevated the conversation around that topic, and how in money, for example, we haven't really created public infrastructure for money since coinage and paper money was invented thousands of years ago, in coinage case, and paper money goes back, kind of to China, 1200s or so. You read kind of accounts of, Ibn Battuta and others who went back, so almost 1,000 years ago. That's how long public infrastructure for money has been around. So this is an opportunity for us to create different infrastructure layer, public infrastructure layer that then lets people interact with value ecosystems the same way that intranet has permitted people to interact with data and voice in a very direct, or far less intermediated way. And again, that's more inclusive, faster, cheaper, more transparent. The downside is, of course, that crypto, gateway drug for this, that's good. It's also brought with it a lot of baggage, rightly or wrongly, around some of the social and political topics that we worry about with respect to bad actors, money laundering, financial speculation, suitability. And so the trick is to box in the latter and to focus on the former, whether the former is being used to improve underlying assets, real estate, cars, art, revenues associated with entertainment products or athletes, or whether it's being used to innovate in the financial ecosystem to improve the security settlement cycle, to reduce the number of intermediaries, to take out other frictions. That's the idea. I think we're probably still stuck in the United States on boxing in the latter and kind of dealing with the baggage. And while there are a number of innovative projects that look to use technology to improve back office in a number of industries, security is one of them, real estate another, it's still early days on that, which is not a bad thing because the potential is infinite. I mean, you think about other infrastructure improvement projects in other industries, whether it's electronic trading, whether it's dematerialization of securities, whether it's similar processes that went on in real estate and other industries. And so that, it's a technology revolution, and that doesn't get talked enough about. People talk about speculative assets for better or for worse. People don't talk about that it's a technology revolution first, that, yes, requires native digital assets in order for the technology to run, but it's a technology revolution first.
Anybody want to add on that?
Yeah, I'll just add, I've talked mostly about sort of the off-chain insurance. Look, the insurance industry, like asset management or real estate, is ripe for efficiency process change as well. So this is early stages also, but there's a lot of paper, a lot of emails, a lot of documents that are all shared throughout the insurance process. And there's some very innovative things happening, I think, around policy issuance, quote issuance. I know this isn't the most thrilling thing to think about, but there is, there's a lot that blockchain technology can do from the process side. And then the most forward-looking insurers, there is actually on-chain insurance that are governed by smart contracts. So instead of, if you've ever had to work through, a claims process, whether it's business or with your auto or home insurance, things that promise the immediate payout if this event happens, all governed by smart contracts. Again, that's a very small piece of the market at this point, but I think there's major potential to revolutionize that, just like it's revolutionized other industries as well.
Great, thank you. Jay, the sole fact that BlackRock has moved into the space has established a lot of trust because it's actually very conservative company, right? So could you give us an outlook on what's to come? There's going to be a lot of new investors coming into the space. What's to come for 2025 and the following years?
Well, so I'd actually take a little bit of a step back and share a little bit of our journey with how we got comfortable with Bitcoin and Ethereum. So this is really a journey that we've been on for 5 or 6 years at this point. And what's changed over that time is several things. One is really there's just been a tremendous amount of client demand. We heard this from clients around the world, different types of clients, institutional clients, intermediary clients, that were asking for a better way to get exposure to digital assets like Bitcoin and Ethereum. So we certainly knew client demand was there. The second thing is we saw a lot of infrastructure improvement in digital assets over the last several years. So this is something that, as you see the $100 billion of venture capital that went into blockchain technologies over the last several years, has really professionalized the infrastructure. You've seen a lot of people and human capital move from TradFi into the DeFi world, bringing that expertise into upgrading the infrastructure. We've had progress in the regulatory front, such as the approvals for Bitcoin ETPs, making a little bit more regulatory clarity. And on top of that, from our perspective, we've really built out full integration with our partners like Coinbase, their technology into our technology stack. So this was a multi-year journey to get to this point, to get this level of comfort for Bitcoin and Ethereum products. I think as we look forward, there's still a lot of wood to chop with just Bitcoin and Ethereum from our perspective. So many investors are still just starting their journey in digital assets today. I know people are excited to jump ahead and say, what's next? What's next? For a lot of traditional finance, what's next is still Bitcoin. And that's what gets me, excited about, my work, my team's work, and more broadly across BlackRock is just how do we educate people on where Bitcoin fits in a portfolio? What's its unique characteristics? Why is this potentially beneficial for someone who doesn't have a diversifying asset that could behave well in an environment where you have persistent inflation or you have growing geopolitical fragmentation? So again, education is what's next more than, what I would consider kind of rapid product innovation.
Great, thank you. So for the closing remarks, I'd like to do the same question again. What's next for the tokenization space real quick? Ian, starting with you.
Yes, I think just back to what I was hitting on there. I do think down the road, things like on-chain smart contract covered insurance, that's probably years away. But from my perspective, it's continued pushing an expansion of real, meaningful insurance capacity that are helping our clients continue to focus on the things they need to focus on building, where they actually know they have that balance sheet protection. So just continued expansion of the market.
Great, thank you. Alan.
Yeah, I think you're going to see three vectors. One is you're going to see continued use of traditional financial technology to make native digital assets, Bitcoin and Ether and others, more accessible to the investing ecosystem. When you think about the underallocation into digital assets globally among financial advisors and high net worth portfolios and others, you're going to see more penetration to that using traditional financial tools, whether it's ETF technology or something else. That's number one. Number two, you're going to see continued improvements in the securities industry using blockchain technology, the ledger and the smart contract part of it to introduce greater efficiencies. We're going to dream a little smaller. Public equities markets are not going to be tokenized overnight, but we're going to dream a little smaller and innovate in private markets and public markets. And then number three, you're going to see the same thing in just other asset classes and other industries, whether it's real estate, other real world assets, where blockchain technology and smart contract automation in particular is going to take out some of the legacy processes and technologies.
Mitch, real quick.
I think it's going to be a new asset class coming in, right? These institutional scalable investment opportunities coming into the space where institutions want to put money towards it, right? An institution, it's hard for them to put 20 million in. They want to be putting, 200, 250, a billion. Scale is the biggest thing. So I think as you start to get more institutional grade assets coming into the market, you're going to start to see more institutional grade investments coming alongside.
All right, great, thank you. I'd like to thank, on behalf of the whole panel, Benzinga and especially Renato for having us. Thank you and have a good day.
Wonderful session. Thank you so much. Thank you, my friends. We really appreciate your time. This asset class is definitely one that we all have a lot to think about these days. Thank you, thank you, thank you. We're going to keep it rolling, my friends. The path to wealth, solutions for growth and security. Here to lead this discussion is Jay Woods, Chief Global Strategist at Freedom Capital Markets. Joining him are Brian Daly, co-founder and CEO of Ground Floor, Dan Raju, CEO at Tradier, and Michael Turpin, founder and CEO of Transform Group. Come on out, gents. Let's give them a round of applause, please. Thank you, thank you.
Is this thing on?
It is. All right, I'm going to sit down. Thank you guys for joining us. We're going to have just a nice little roundtable discussion, have some fun up here, and then hopefully we'll leave some time at the end to have some Q&A for anyone that has any questions. But what I want to do is just introduce our panelists and let them give you a quick overview of what they do, who they are, and a little elevator pitch. So we're going to go first. Let's just talk about the topic, because the topic is a little vague. The path to wealth. Yeah, who doesn't want to be on that? But solutions for growth and security. And what we want to focus is we have three different aspects of industry up here. And the one thing that we all can agree on is the way we run our businesses, the way we want to protect investors, and the way we want to educate them. So let me start with Brian here. Brian Daly, CEO of Ground Floor. Welcome, and tell the audience a little bit about yourself and the company.
Good to be with you guys. Thanks for showing up to the panel. We are the, I guess, earliest entrant and largest issuer of fractionalized first lien real estate investment debt. It's a high yield product that allows you to participate in real estate investment loans with as little as $1. And now we're fractionalizing that. You know, sort of what happened in the public markets, where you used to have to buy in round lots of 100 shares, and now you can buy a penny of pretty much any stock you want. The same thing is happening in alternatives. We serve almost 300,000 retail investors. We've done about $1.7 billion in volume on the platform. And the yields these days are sitting at about 12.5% in this kind of high yield product that I'm sure we'll get around talking about the real estate market and why that's a good thing.
All right, excellent. And our second speaker, Dan Raju, CEO of Tradier. Tell us a little bit about yourself and Tradier and what you guys are up to.
Yeah, thanks for having me here. I'm really enjoying it. I've been to this event many times before, so thank you so much for listening to me again, I guess. But you know, Tradier, we are one of the larger options brokers in the country. You know, we built a business on a very simple concept. Kind of wanted to be different than other brokers. Thought that, you know, if you truly give people good choice, good content, and transparent pricing, and don't engage in hyperbole in any big way, and keep the concept simple, you'll attract serious investors. So that was the concept we built the firm under, and we use technology to enable interaction with that. We were the first guys to build API and offer that as a platform. So today we do about more than 2% of the U.S. retail options market comes from us today. It's based on a very simple concept: is do one thing right and do the same thing right every time. And we have attracted us, and we are kind of happy that I see so many of our partners here. So I'm so glad that we were able to provide that service. And we work very hard every day. Try to do what we think we do better every day. So thank you so much. And that's what Tradier does. It's a brokerage purely meant for the active trader, both equities. Options is a big play of ours, and futures now more recently.
Okay, excellent. And that's right after what I like to trade myself. And our last speaker is also an author who has a book that comes out today. Michael Turpin, founder and CEO of Transform Group. Welcome, and tell us a little bit what you're working on. And we got to hear about the book as well.
Sure, thank you. So it's called Bitcoin Supercycle. It's out today. You can get it on Amazon and other places. And it's published by Skyhorse Publishing and distributed by Simon & Schuster. And I actually chose it to come out this time of year because what most traditional investors don't understand about Bitcoin is that it has cycles that are just as predictable, if not more so, than the stock market and real estate. And so I knew that we were going to hit an all-time high roughly in November, and that's why I published the book. There's something I call the 4 seasons of Bitcoin inside of the book, where Bitcoin spring is when the halving comes out, starts a new cycle. Bitcoin summer is the day, and this has happened every cycle, the day you pass the all-time high for the prior cycle. Last cycle was 73,000 and change. You go off like a rocket ship. It happened to $30, happened to $1,200, happened to 19,000, and it's happening right now.
Fascinating. So as you can see, we do have a diverse panel, but we want to bring it together. You know, we have real estate investment, options, equities, and crypto. So something near and dear to our heart, and for a diversified portfolio, we got the diversified panel. So I'm going to stay with Bitcoin, and I'm going to put the spotlight on you, Michael. And if you need water, guys, it is 2,000 degrees up here on this stage. We have water behind us, so just yell. before you pass out. We want to talk about some of the challenges we face, and nothing has been more exciting over the last few weeks than the crypto market. But what are some of the challenges you see coming forward? And some could be very good tailwinds for the crypto space. And how do you and your team, help investors overcome some of the challenges? And what are the strategies and technologies that you use or guide them to help them navigate some of the pitfalls that you may come across?
Sure. So there's never been a better time to invest in Bitcoin in terms of safety and security. Right now, we're up 130% for this last year and 600% for the last 2 years. I'll compare that with anybody else on the panel. And obviously crazy numbers if you go back a few years earlier. Again, the cycles is something that's confused the media. They love headlines. And so whenever it goes down, it's like everybody bought at the top and just lost at the bottom. And, retail, unfortunately, has had a tendency to do that. They panic sell near the top, and then they panic buy near the top, and then they panic sell once it starts going down. These are predictable cycles. The last 2 cycles, the crash for each cycle happened almost to the day a year after the top. So you can go and look at these cycles, which I explain in my book. In terms of helping investors, the book is a good place if you want to DIY. I'm also a partner in the Alpha Transform Holdings hedge fund, which is Alpha Liquid Fund. And a couple other funds, so I can talk about that. Again, there's a lot of opportunities in other parts of crypto, but the safest one is Bitcoin. I've had an allocation of about 50%, and I regret having at that low given to my friends who were 110%, and like Michael Saylor. So
excellent. And Dan, you have what, 280,000 users on your platform? Yeah, it's impressive. And 2.8% of all the options volume trades through Tradier. I'm bragging for them. We talked about this before. But one of the things when you talk equities options, it's a little faster. There are a lot of educational tools out there. But what are you doing to, one, educate your investor and, to help them navigate some of the pitfalls? Because a lot of people that trade aggressively blow up. What are the things that you do at Tradier to help that?
No, so the key transactional businesses like ours generally have a higher percentage of people can't help themselves but screw up. So I think what we have tried to do is we're tried in general to be very, very responsible. And the key to responsibility is content. And I say this because we have our own television or live show channel where we partner with CBOE and we partner with MAIX and some of the larger exchanges. We spend a lot of time, energy, and most importantly, content is not cheap, to educate people, right? On educating people on how to basically go ahead and understand what they're really doing. I think if you drive a good amount of education, and most importantly, understanding of the product, I think the upper section of the people, and you can make that section larger and larger, actually can accumulate wealth in that section. So we have taken a much more what we call as a responsible approach to and spend the time and money to actually educate people on that. So and in addition to education, the key is to have the product be understood as something that is simple and easy for them to scale up to. So the 2 aspects of really driving responsibility is to be responsible on the pricing and be extremely responsible on the content. I think both of that actually over time, trust me, mark my words, anybody who's trying to get into content marketing, I'll tell you one thing, you have to stay in it for long. It's not like you're going to see results in the first 4 months. You got to stay it for long. You don't understand how much value your 5 views on YouTube gets you. Don't underestimate the value of those 5 views or 10 views, and don't be lost in subscriber battles. Just putting all those battles aside, if you put good content out there that is responsible, I think people subscribe to that responsibility, and you should do everything to service them better. I think it creates a level of what we call maturity in the customer. And you end up getting a better customer too at the same time.
All right, I'm going to come back and pick on you with that 0 day to expiry. Doesn't sound like a long-term investor to me. We'll come back to that topic at the end. And Brian, you're more in the real estate game, and I like how you can fractionalize that. I'd like to hear a little bit more about the fractionalization and how you teach your investors that this is a longer-term play. So what are some of the hurdles, some of the pushback you get from people that are a little hesitant to jump in on the real estate side of things?
I mean, look, we started the company in 2013 in the wake of the 2012 Jobs Act with the insight that the next great mass market investment product after Bitcoin would be something in the alternative space. And we were early to that. We picked real estate because it's tangible. We picked residential real estate because it's familiar. And we ended up with a product that fills a white space in most people's portfolios, which is a very short-term debt holding with low volatility. And because it's short-term and high yield, we can adjust the yields as rates have moved. And that's turned out to be a very handy thing in this environment. When you're investing in alternatives, there are two big risks. One is concentration, and they're related. One is concentration, and the other is liquidity. So the product that we've commercialized and scaled now to about 1.7 billion, which I think makes us by far the largest fractionalized platform in real estate, or I think in any other space. The way we've solved that problem is fractionalization allows you to invest in the same way that a hedge fund or a private equity fund would invest in this category, which is in a diversified manner to build your own portfolio. You can, kind of like in options trading, you can sort of build your own strategy. Sort of like in Bitcoin, you can sort of, as I do, dollar cost average every day. You can invest across vintages on ground floor. And you can do that critically without allocating $25,000 to some stupidly concentrated commercial real estate crowdfunding deal, which is where a lot of people have ended up getting stuck and burned and losing a lot of capital, or getting stuck in some REIT, even if it's from Starwood or Blackstone or a name brand or Apollo, that ultimately is going to lock up your capital. So we're using technology and regulation to solve those problems, and I think that's why the product has taken off in the mass market.
All right, and I'm going to go back to you, Dan, with this next question, and then to Michael. We all know the pandemic really sped up and brought a whole new wave of investors to the market. We saw it. We saw it. And I got to keep the microphone here and not I'll point with this hand. We saw it in the crypto equity option space, and even in the real estate space. There were a lot of great opportunities there. We touched on this a little bit. Education for the long term. What are the tools on your platform? What educational things do you see that people tend to, gravitate towards, and then some of the things you try to educate them with? Because it's like talking to your kids. Like, they don't want to hear you give them advice, but if someone they respect your age gives them advice, then they'll listen to them. Are the users on your platform using the tools available, and what tools do you feel are the best to educate those investors? And Dan, right back to you.
No, I think the pandemic was an interesting time. I think it created a very interesting, what I call a situation in the market. What it did is, while at the time it actually brought in a lot of customers to the market, it actually created a hyper-tensive environment where there was a rapid graduation effect in the market, in the sense that people were basically, what would take an equity customer years to get into options, they were getting there on day 2. So I think it was an interesting thing that basically happened is, there was rapid graduation, just not graduation at number one. And at the same time, what has happened is, and you brought up the issue of zero DTs, and I call it as a byproduct of is mostly directional and short-term momentum trading, that habits get crept into the options market. As a result of it creates short-term expiration or short-term behavior. But I think the way we tried our best to navigate, the way we tried best, I'm sure there are probably better ways to do it, but I think the way we tried to navigate is, number one is we insisted quite a bit on service, because when they go to an app that provides zero commission and they say, oh, this is horrible, or whatever it is, and they try to move on to a slightly more, if not cost-wise, but from premium service, there is an expectation of reliance. So we kind of beefed up our customer service, gotten a lot of people who basically help them trade and educate them at the same time, ramped up our content business. And we also introduced to the platforms that we use. We are a unique business. Our business, almost 70% of the volume comes from third-party applications connected through our API. So we were able to work with the ecosystem and force education in every such step of the way to drive that effect. So that's how we kind of compensated what we believe is almost like, I mean, to just give you some perspective, pre-pandemic, I think Matt Cashman will give you better numbers than I can. But I think, you know, when we were looking at retail, it was like 8 to 10% of the US total volume. We do about 42 to 54 million contracts per day, and about 8% of that was retail. I think post-pandemic, I mean, right now we are like 40%, right? So such a massive improvement. And what's even more interesting is there are more single stock options trades than the number of shares traded in the market. So when you have that kind of hyperbole growth, I think we tried our best to basically be a responsible partner. It helped us while it helped us to basically go ahead and, you know, slow the market down, but we ended up with a better way to service a smaller chunk of people, and a lot of brokers that got tens and millions of accounts in that process. We did not do that, but at the end of the day, once the hype died down, you know, we are still left with those customers in a major way. So
gotcha. Now, Michael, with crypto, tends to be extremely volatile. If you haven't noticed, we trade 24/7. So middle of Saturday night, you could get an alert that we're seeing some significant moves. Now, I know you are more on the long-term side, but what do you say to those active participants to try to get them to see the bigger picture and to safeguard them where they're not just in and out constantly all day long?
Yeah, unless you want to have that as your career, being a algorithmic trader or whatever in crypto, you can still make a lot of money just using my system, which is, first of all, hodling, as they call it, has done very well over the years. If you bought 1,000 Bitcoin at the end of 2012 in the first halving, you would have paid $12,700, and today that 1,000 Bitcoin is worth $92 million. On the other hand, if you followed my system and my safest system, there's a couple of different options in the book. And you buy once near the high. You're not going to pick the exact high, and you then you sell near the high, and then you buy back a year later near the low. And I've got it within like 30%, right? And the highs have always been remarkably within a 37-day period. And so you can start looking to see, and you can dollar cost average, near the high and near the low. I wouldn't dollar cost average on the way down the third year, but you would have, for your $12,000 investment, instead of 92 million, you'd have a little over 5 billion, because you would have 64,000 Bitcoin at 92,000 apiece. So that's really and I think this year, every cycle you've seen less volatility. The first pre-halving cycle, you had 3,000x from the first purchase to the high, and then a 97% drop. The second cycle was 100 times profit, and then an 85% drop. The third cycle was 30x, and then an 83% drop. This last time was only a 75% drop after going up only 8x from the halving. This time I project we're going to be around 3 to 4 times, because the difference is the macro, which is going in our direction. And then the drop should only be about like 2/3, but it will be a drop. If you sell at 200,000, you can expect to get things back under 100, probably around 70 or 80 when the crash happens.
And when people think volatility, they don't think real estate too often, but we've lived through cycles where we've seen some extreme volatility. We've had a great run. Mortgage rates are high, but home prices are continuing to be elevated. I'll throw it to you. When I'm sure you discuss this frequently around the water cooler, what are the things you tell your investors about the potential volatility of the real estate market?
First of all, for most of us as individual investors, we're unaccustomed to buying credit, right? When we think of investing, we're thinking of investing in equity, whether that's startup equity or equity in via derivatives and options, stocks. Most people are unaccustomed to building a portfolio of credit. So the first thing we have to do is teach people why that's valuable. And in the pandemic, that became very obvious, right? The loans that we originate to real estate investors are typically 12-month term. That means we get to reset rates continuously. So when we see rates increasing, we can bump them up on the platform. I think before the pandemic, they were sitting at about 10% as a contract rate. And today they're at about 12.5, right? So as the prevailing rate environment increased, we increased rates. So investors earned higher returns. What we were surprised by is how loss ratios didn't increase. And that's because house prices have held up very, very well because of the dynamics of supply and demand. So educating people about how to be a credit investor, like educating people about being an options investor or being a Bitcoin investor, there's work there. And the best way that we find for people to learn is by using tools. I think there's a lot of opportunity for content marketing. We were talking about this earlier today. There's a big opportunity in content marketing to teach people about that, about being a credit investor. But there's nothing like showing how it works. Our most recent product leverages what we've learned over the last 10 years. It's called the Flywheel Portfolio. And it allows you to have about probably 10 to 20 times the amount of diversification with the same amount of money, and to generate a flywheel of cash returns that you can reinvest or not. That's, because it's so highly diversified, you can dial in and predict the yield pretty well. So for me as an investor, when I'm investing in Bitcoin or options, I look at this as the other end of the barbell. This is the reliable income and yield that allows me to go out on the risk curve and invest in, as most people want to do, invest in more esoteric, higher volatility, sort of larger, outcomes, out there that could be the 10x, 100x outcome on a leverage trade. And I think that we're seeing a lot of that behavior. Yeah.
Okay, and we're going to go one last question because the panel before us went a little long, so we're going to speed things up and get us back on time. But Michael, and I'll ask this to all three of you, what trends do you see to grow, the crypto space in your case? What are the trends you see accelerating? Do you see consolidation within the space, introduction of new coins? What do you think the next big things in your space are going to be? And your space is interesting because you have an administration that looks like they're going to really be a nice tailwind at your back.
I was going to say number one trend right now is the Trump trade, right? The Trump election. I mean, you saw that we broke the all-time high, which I projected was going to happen if Trump won the day of the election, as soon as it became obvious, and it shot up 25%. It's pretty much been holding in the low 90s. I project we'll be at 100,000 by the end of the year. I said that earlier. We could be by the end of Thanksgiving weekend at this rate. I think institutional comfort, now that the volatility is lower and the ETFs were a game changer, for the very first time ever, we ended up having a new all-time high for a cycle that happened after the capitulation. Some people got confused and said, "Oh, that means there's going to be a shorter cycle." No, you can't have the all-time high of this cycle happen before the happening. That was the all-time high of last cycle. And talking about real estate, I've taken advantage of that a few times to sell my Bitcoin when I'm trying to hold on, to buy it lower, and parked it in some real estate. I bought the Mike Tyson mansion from The Hangover, where he had his tigers, with $70,000 Bitcoin earlier this year. I bought my Miami penthouse with 60,000 Bitcoin in 2021. The main thing is to make sure you have enough cash when it crashes so you can buy back in. This last time at 15,000. Yeah. So we are already now, because I heard on the last panel them talking about, when digital assets are going to be something you can put not millions or tens of millions, but billions of dollars to work. That's already happening. The ETFs this past couple of weeks were going around $1 billion a day. They are now larger in their first year than the gold ETFs. So it's only a matter of time until we're larger than gold overall as an asset class. That makes $700,000 Bitcoin.
All right. I guess I can't brag that I bought a large Starbucks with my crypto winnings there. Unfortunately, I haven't been YOLO'd in. I'm very diversified. But let's go back to you, Dan. In the equity space, you guys have grown at a reasonable pace. How do you continue that growth? Where do you see the trends going forward?
I mean, thinking what Michael just said, 2025 is going to be interesting because I really think the regulatory environment will be forced to become a little bit clearer about its policy on crypto. I mean, we announced the launch of Crypto Mini about a year ago, and I put it on hold because the regulators basically told us to stay on hold. That's how simple. I think 2025 will be interesting from the regulatory aspect of crypto. I think that will be very interesting.
Perfect storm.
Right. I think it'll be interesting. But generally speaking, what I see in the market right now, number one, which I've based on data that we see, automation is very important. I certainly not placing a limit order or writing an algorithmic code, but something in between where people are going to use small automations to automate their trading habits. We see a tremendous growth in that. We ourselves have seen almost a 30% on micro automation of trades. I think that's going to be very, very huge area of growth. The second thing I see is all of us talk about the US markets as though all the people who hold the assets are all Americans or citizens of this country. I see a huge internationalization of the US investing market. There's a lot of money coming in outside. Now, what's interesting to watch is the geopolitical and that kind of pressure impact it has on local policies is going to be impacted by what happens outside the country. So two areas that I see tremendously that's happening. So I hope the regulatory environments get better, and those are the areas that I see are growing this year.
And Brian, to you, the growth and the trajectory, what do you see being the catalyst? And do you see the sector starting to really pick up speed as we head into this? We're in a bull market, so I think it continues. You?
I do. I love a good secular trend. The younger you are, the more likely it is that you are allocating relatively more of your portfolio over time into alternatives. The younger you are, the more earning potential you have over time. And so the market is moving in the direction of alternatives generally stated. The question is, which alternatives? I think real estate is by far the best alternative for most people. It's the one that most people recognize. It'll be the first to benefit from that trend. I think real estate debt has unique attributes to it in this type of environment that are going to be appealing to investors who perceive equities as overvalued or who are waiting for the next leg down of the Bitcoin super cycle, because you want cash flowing, low volatility alternatives to complement a lot of this volatility and opportunity in the market. I don't think the 25-year-old high income, not rich yet investor is going to go lock up the lion's share of his allocation alternatives in some private credit fund. Why the hell would you do that? Why would you pay the fees? Why would you take the lockup? Why would you give up control? No, they're going to invest in a better mousetrap to do that. And that's I think what's going to benefit us most over this next cycle.
Excellent. Well, I want to thank you. In the interest of time, we're going to move it to the next panel. But if you guys are going to be around hanging out, we have a book to promote as well. So please come up and talk to our speakers with any questions.
And also a conference for those who want to learn more. Puerto Rico Blockchain Week is the second week of December. We got a lot of speakers, including on tokenized real estate. It's tokenizedconference.com in San Juan, my hometown.
All right. Do you have any social handles you want to give to the audience?
I'm my name, at Michael Turpin. I do a weekly podcast called Not Financial Advice.
Okay, Dan?
All our handles are Tradier, so in any social platform you go to Tradier, you'll get it.
Gotcha.
And you can follow us on social at Ground Floor, typically groundfloor.com website, or me at Brian_Daly on Twitter.
There you go. Well, thank you very much for your time, and hopefully we can chat outside a little where it's a little cooler. It's very warm up here.
Thank you.
Thank you.
Thanks.
Thank
Jay.
you. Let's
Thank
give it
you.
up for our panelists. Thank you very much, gentlemen. We appreciate it. Guys, lunch is served downstairs and also just down the hall. Lunch is served. Feel free to go and grab lunch. We'll start promptly here and the photo stage below us at 1 p.m. Thanks very much.
Welcome back. We hope you enjoyed your lunch, generously sponsored by Tick Blaze and Apex Trader Funding. And now, please welcome back Patrick Lane.
All right, we're back. Hope everybody enjoyed lunch. Thank you, Tick Blaze. Thank you, Apex Trader Funding. We're going to keep this going. Some of our content, as you guys know, is aspirational. Some of it's educational. This next panel is bringing the swagger, so I've been told. The title is Strategies for Future-Proofing Your Fintech Defenses. On to moderate, we've got Jason Padone, CTO of Aspida. We've got Spencer Crane, Principal Solutions Architect at ID DataWeb. Dan Dabrowski, VP of Strategic Partnerships at Prove Identity. Christopher O'Brien, partner at Venable. And Damian Scavo, founder and CEO at StreetBeat. Let's give it up for our next panel. Thank you very much.
All right. Well, welcome everyone. We are bringing the swagger today. Good afternoon. Hopefully it was a good lunch. I'm Jason Padone. I'm CTO for Aspida. We are a insurtech company focused on annuities. We bring our digital swagger to a paper-driven industry. So I'd like to have my panel introduce themselves real quick before we get into it.
Sure. Hi, I'm Spencer Crane, Principal Solutions Architect at ID DataWeb. We're an orchestration platform for identity verification and authentication. So idea being there's lots of really great solutions to really specific problems. Problem is, how do you kind of get your hands on 15, 20 different solutions that you need to do what you need to do? So it's kind of where we specialize.
Hey everyone, Dan Dabrowski, partnerships at Prove Identity based out of here in Manhattan. We are an identity company that primarily looks at a person's phone number as a key attribute and a good proxy for their identity. We're able to look at a number of risk signals associated with that phone number and create a comprehensive picture of if that person is who they say they are. So we're heavily used by leading banks and financial institutions. Pleasure to be here today.
Hi, my name is Chris O'Brien. I'm a partner at Venable. We're a 850 lawyer national law firm. I'm in Los Angeles. And have been practicing in the crypto space since 2016, and I founded our crypto practice and chair it today.
Hi, Damian Scavo, founder of StreetBeat. 20 years in the industry. We are the first platform that is actually powering wealth manager and retail traders to invest, but with an AI copilot for investment. Thank you. Powering now 3,800 wealth managers worldwide.
Great. So we are here to talk about mostly cybersecurity, kind of risk management. Obviously, fintechs, insurtechs, we are target-rich environments, so to speak, right? So we are data-rich companies. Particularly, we have PII. We enable access to financial instruments. It's estimated globally this year there is approximately 9.5 trillion of cybercrime committed. It's $1 billion an hour. So we know the kind of threat landscape is constantly changing, right? It's a big issue that we're all facing in this industry. What new threats do we as the industry need to worry about as we approach 2025? And what are some things that we can do in the industry to proactively kind of prepare for them? Anybody want to take that?
I can certainly start. There's a countless number of different patterns and trends developing. One I'll just call out is you alluded to it. For a long time, identity security and identity verification was really just about checking that KYC box, right? Checking that compliance box. And for the last 15 years, we've really seen that evolve into a fraud concern, actual fraud concern beyond just checking that box, but protecting users, protecting organizations, and in tandem with that increase in fully remote interactions with higher account values, more self-service tools than ever before, fraudsters have risen to the occasion, and a market has risen to that to serve them, right? So the advent of things like fraud as a service tools, major platforms built, just around accelerating, fraud tactics, one of many things that we're thinking about, and what that really equates to is just the sheer volume sophistication of attacks is higher than they've ever been.
Yeah, and I'd add to that. So echoing on the point of how it's typically been a check the box exercise, what we've seen in real time, especially with fintechs, is you historically have a small fraud team that's shoved in the back broom closet, and no one really gives them the time of day because you're so focused on growth and account growth. So anything that helps user acquisition is good. Anything that could potentially slow down user acquisition is bad. But I think we've seen a tidal shift in that thinking in the last several years. Obviously, there was a big number of account write-downs at PayPal. Even when Elon Musk was buying Twitter, now X, he went back and renegotiated the deal when he found out how many of these accounts are actually real. So I think that there's a little bit more veracity going through these account numbers, and as a result, the real-world behaviors that we're seeing is a convergence of authentication and fraud controls with front of the house onboarding, and there's a lot more collaboration going on there. So the next threat is always the thing that beats whatever tool you have in place today, or whatever your competitor has in place today. So increased collaboration in the industry is critical.
So I'm hearing kind of trust in user identity and user authentication is really more critical than ever. So in that space, what are some kind of advanced tools and technologies can fintechs kind of employ to really build that trust in kind of that space of identity proofing? What are some techniques, dare I say, is there some AI applications that we see emerging in 2025 in this space?
I can take this one. So first of all, a question to the audience. How many of you used AI today to do anything at all? How many of you, can you raise the hand? Oh, wow. How many of you use AI to code, to write some software code? Okay, some. Well, what is happening this year is that for the first time, when you give an AI the possibility to code, it actually code pretty well. It's expected to improve a lot next year. So what happens is that a lot of software in the future will actually create software on the fly based on what the customer is asking. So this creates a lot of new complexity. In our case, in Streetbit, we have an agentic architecture. Probably many of you by now know what an agent architecture is. But basically, it's a bunch of, imagine, different AI that speak to each other. And when a customer has a need, this architecture create about, on average, in our case, 2,000 lines of code in few seconds that are necessary to fulfill the request that has never been asked before. Usually, half of the things that the customer require never was asked before. So what happened is that this creates a lot of complexity relating to compliance, a lot of complexity related to security, because new code is right on the fly and then it's deleted. Okay, so you need to work very hard, and this will become a big topic in the next 5-10 years to verify that the code that the AI is writing on the fly is actually compliant, is actually safe, does actually what is intended, and doesn't what is not intended. So there is a lot that need to be created. I think there is a lot of space for security startups to actually prove the software that is dynamically created on the fly by this type of AIs that are in production. We are following about 170 billions AUM right now with this technology. And these agents are writing software on the fly. So it's a really, really important topic. And this the only way in which future will be created in the future. It will be software that creates software. So people create the software that creates software. So it's a exponential complexity.
Yeah, that's it's wild to think that this is reality, right? This is actually happening. I think Google just also announced recently their latest earnings call. I think 20% of their new code is AI generated, right? And that's just a start. And just think of that. That's we started probably a quarter ago at 0%, and now one of the largest tech company in the world. It's 20%. It's wild. So it kind of leads me to, a lot of these AI solutions are third-party solutions, right? They're not in-house built. There's maybe very few that are in-house built. I'm sure they're out there, but most companies, fintechs, companies large and small, are largely leveraging third-party solutions, whether it be Anthropic or they're using ChatGPT, OpenAI. So it brings to light kind of the importance of third-party risk management, right? So how does that change our thinking, or maybe elevate the importance of third-party risk management in this space now that AI is really being leveraged really across the board by organizations both large and small?
Shall I take that one too?
Yeah,
Okay,
absolutely.
so yeah, this is actually a very complex topic because you have multiple AI software writing software on the fly, and you have them answering directly to a financial advisor or a retail trader. Robinhood recently acquired PlutoFi, which will start to provide, and public.com. Is there anybody from public.com? Public.com already has deployed this type of technology to millions of people. And with Streetbit, we have been doing that for a while now. And it creates a lot of complexity in the interaction. And you definitely need more intelligence to orchestrate all these automatic checks of all the parts, because there is PII information flowing directly from the user, from the wealth manager. There is regulatory constraints that are changing. And actually in AI is missing a lot of stuff right now. In blockchain is missing a lot of stuff. And it's already Wild West if you think about an AI robo-advisor that writes software to stock trading on the fly. Imagine an AI robo-advisor that writes software to crypto trading on the fly. Like it's the far west of the far west, basically. So it's really, really the beginning. And there is a lot of opportunity for anybody that wants to start business in that space because it's still unexplored territory. Yeah.
Yeah, and I'd add to that, just from my own experience, going back several years, there was a company that was basically reselling telephony data to whoever would buy it, right? And so there was this big Vice article about how this bounty hunter could buy geolocation data on the reporter's ex-wife and actually go find that person, right? So that kicked off a series of events, at least with telco data, in terms of right to use, who's allowed to use this data and for what purpose. And it's become a huge third-party risk management operation in terms of acquiring consent, onboarding customers, and their use cases for data. So I think that we'll see misbehavior continue to drive trends that is pushed down from the suppliers of that data themselves. But I'm not sure that we should actually wait for that to happen again, right? So I think that being proactive and having a clean look at what data is being used, what programs are being run, who's actually originating it, how is this being used downstream, and having firm controls for that is absolutely critical to the overall trust in the ecosystem.
One thing maybe just to kind of wrap that in a different perspective is like the surface area that we have to deal with, the number of users coming from different situations in different industries and in different applications, it's growing exponentially, and we don't want to get in the way of stopping that. But then the question becomes, how do we expand controls as quickly? And like a really good example of where the industry keeps up and doesn't keep up. So most folks today have really good controls on on the website, native application side, as far as the consumer logging in, right? Most folks are putting in place mandatory second factor authentication. There's lots of very, very strong solutions. But a good example of where that isn't the case is call center. And so a good example of this, a lot of people don't think about it, but fraudsters are incredibly intelligent. They will pivot to whatever's not being protected. So as this surface area continues to evolve, the question becomes, what's the next solution? What's the next product that's out there that does this new additional iterative thing that I need to do? And how do I get my hands on it? And I think there's a lot of great solutions out there. The question is just, what is the cost of procuring, integrating, and cycling through those as the market changes, as fraud changes, as preference changes? And so that's where like a really, really agile framework for pulling in and pulling out the necessary, whether it's fraud, email, device, session risks, whatever it may be, that's really where that comes into play. Is you have to be able to move as fast as the fraudsters are moving and as fast as engineering is moving.
Chris?
Yeah, Jason, I'm here from the legal department to say I'm very scared by what you're talking about. It's always wonderful to talk about the promise of the expansion of AI and so forth, but what about the risks? What about who do we sue? Who's going to sue us if we're using third party and third parties using AI?
Yeah, it's going to be incredibly complex, right? As we kind of evolve in this new AI-driven world. I think we were talking backstage about some very interesting scenarios that might be reality here in the next, could be 12 months, could be 5 years, we don't know. But certainly, to your point about agility, right? I think we all need to be agile in how we approach third-party risk management as these technologies become more mainstream. It's certainly something to watch, and I think we don't have all the answers, what we're saying. But I do think as leaders, we need to kind of keep a close watch on it and see how things evolve. Just real quick, I'm going to do a poll here on stage. We didn't plan this, but AI, as far as cybersecurity landscape is concerned, threat or opportunity? Spencer?
It's like anything else, it's an arms race, right?
Yeah.
One of the, I think, the unfortunate things to realize is that we are not the only innovators, right? A lot of the time, fraudsters are the innovators, and we're the regulators in that regard. So yeah, I think just as fast, a good example of this, right? Phone porting, as old a tactic as any, right? I'm going to, fake authority to control your phone, take ownership of it. What do you do when the authorization letter to complete that action is generative AI based? Okay, I'll call in, I'll voice authenticate you. What do you do when that voice is a deep fake? What do you do when a biometric can be deep faked in real time and pass liveness checks? There are solutions, there are products that are all evolving and trying to out innovate all of these new fraud tactics. I think you can't look at it one way or the other. You have to constantly watching, what is available to counter this thing, and what is the next thing that I need to counter ahead of time, because otherwise, you're gonna get burned.
Yeah, Dan?
Yeah, I would echo that, but I would say short term, it's more of a threat than anything. When we talk about how did we start to introduce identity solutions in the market, as folks did more things digitally, we said, how do we eliminate threat vectors that create scale, right? And how do we funnel the threat vectors that are more analog, so that at least if we get got a lot less, right? And so that's the way that we started thinking about things. But I think with AI, to Spencer's point, that completely blows it up out of the water. And something that would have been analog before is easy to replicate at scale now. And I think that we as an industry aren't prepared for that yet.
Chris?
Well, I come at this more from a regulatory and public policy point of view. It's both. The question is the balance.
Yeah.
And I think we'll get into this on the panel, but part of the question is actors coming in from the side, like governments regulating this and the federal government regulating this, is going to answer a lot of those questions outside of the technology.
Debbie?
Yeah, so I think it's a sandwich in the sense of we have an opportunity for sure. And right now, if somebody want to try, they can download the Streetbeat app and say, hey, I want to create a portfolio that invests in crypto, in bonds, in cash equivalent, and he will build it on the fly. It will take a minute. And then if I am a wealth manager, I can say, hey, what should I do today? And the AI will tell me, oh, you should contact these people. This bond expired, so he's sitting on cash, this other. And it will make 40% of a wealth manager automatic. But it's also a risk, because fraudulent people will gonna leverage it to do harm, of course. That risk, however, generate another opportunity. So it's a sandwich, opportunity, risk, opportunity, in my opinion. And but let's also keep in mind that AGI, it's probably 2025 by what we know right now, or at least for the first time in human history, we know what we need to build AGI, which never happened before. And by AGI, I mean artificial general intelligence, intelligence that can do everything that you could do in front of a computer, more or less, okay? And by the way, they already released both Anthropic and in sneak preview Google, a software that can literally take over the computer, an AI, and use the computer for you, move mouse, type, open things, etc. So if you combine all these, you can see opportunity, risk, opportunity again, because incredible things will gonna happen. You will have infinite amount of people working for you in front of a computer, speaking every language, able to use any software, any API, writing code. On the other risk, also the malevolent people will have it. So you need to start to build for it, because right now some software use, I don't know, accelerometer of a phone like you guys, Prof. That's pretty solid defense, because you need somebody to shake it up. Robots are still far away, but if you don't have that type of protection, for example, then how do you know if it was a person? That thing is moving the mouse, right? So that's
So sandwich. I like that analogy. It's a dangerously delicious sandwich. I think that's what our that's our conclusion. So to transition to another topic, what we know is going to happen here is the kind of the regulatory evolution of crypto, right? We have a new administration coming in. We know there's going to be a lot of changes, re-regulation. It's going to have significant implications, what we think, for security and compliance. So, what does this, what we anticipate, and what does this shift bring to the industry, specifically around cybersecurity and risk management and compliance for what we think are going to be changing regulations?
Well, I mean, I'll tackle it from a high level. I've listened to some of the panels today, the crypto panels, and people have been remarkably mild about trying to predict the change. I don't think I'm making news, but maybe I am here at the conference. It's going to be really substantial change, and it's going to be change in favor of the industry, what the industry wants, and the industry has cross-cutting priorities and desires, but it's going to be less regulation by enforcement. We're going to see different regulators immediately, a different approach, and then I believe, and don't come back in a year and tell me I was wrong. These are just predictions, but I think we'll see major regulation come through Congress with bipartisan support, and in Trump 2.0, the crypto favorable Trump 2.0 administration, it'll get signed, and we'll see more activity in the space. We'll see regulations, new regulations. We can argue about whether it's a re-regulation or the first time regulation, but it will be more favorable to issuers, more favorable to platforms, more favorable to exchanges, and we'll see more crypto activity, which probably means we'll see more fraudulent activity and more criminal activity as well, just because that's baked in. And so you guys will all be fully employed.
I was going to say, maybe you can answer this, Spencer. Like, what role does identity management kind of play in providing a defense over what appears to be, right, evolving and probably growing industry over the next 4 years? Or what can we do as an industry to kind of protect ourselves and also our customers from this?
I think there's a couple really big cultural shifts and cultural waves you can ride in regards to crypto becoming more mainstream and kind of be back on the rise again. So like, let's think about a couple of them, right? We have forever known that, especially with consumer identity, the consumer is the real regulator of what we can and can't do, right? What will they tolerate? What's too much friction? What's the right amount of friction? What's the right amount of privacy? What's too much privacy? We have, with crypto, an industry of folks who are security conscious, privacy conscious folks who, in a big way, have changed the narrative, right? Folks are becoming more comfortable with the give and take of data for security. I think what we're going to see is a few more product specific trends, perhaps the concept of a federated identity, right, where I verify myself once and I bring that identity with me, right? Kind of this privacy first approach, this concept of utilizing the least amount of friction possible to verify a user, and the concept of pushing and educating consumers to turn on or even mandate second factor authentication, all the things that come with that. I think that's the real opportunity. Like with crypto specifically, that's its own extremely target rich environment. And a lot of those organizations in some ways have led the pack, especially when it comes to kind of retail financial services. But now is the opportunity to kind of take from that industry and use it to kind of educate and kind of push your own security posture forward.
Dan, you have anything to add there?
Yeah, I would say that we typically see the best controls are the ones that are done in layers. And with that, there's opportunity to be mindful of privacy as part of it and be mindful of the amount of friction that you're actually putting an individual through. So by having a strong layered approach, you can look at the appropriate in context risk signals given the nature of whatever transaction's occurring, whether that's a login attempt, whether it's signing up for a new account, whether it's transferring funds, whether it's buying, selling. So, I think we'll see continued growth towards, very comprehensive layering of security controls.
Do we feel like as that our end consumer is not only becoming more aware, but it almost evolving to the point where it's an expectation that these controls are in place?
It can be a competitive advantage now. I mean, I think the 2022 stat was 1/4 of all households experience an account takeover. That is enough that it is now in the public eye. People are aware that their accounts can be threatened and they can ruin their life, even in the short term. And so I think right now, more than ever, is the opportunity to stop thinking about especially identity security and anti-fraud prevention as a friction for the user. Start treating it as a competitive advantage. How can I onboard you faster than my competitor? How can I keep your account more secure than my competitor? These are things that we need to start changing the narrative around.
And I'd say turning inward on that as well. We've learned so much in consumer identity, right? Onboarding consumers, authenticating consumers. But when you look at 85% of data breaches, what's happening? It's because of lax controls for identity and access management of people accessing your internal systems. So I see a convergence of these two fields where a lot of those best practices from the consumer side are now being married into the internal identity access management controls. And it needs to happen because weak authentication on the internal controls means that your entire data set and your entire posture as a company is at risk.
So Chris, I'm going to lean on your legal swagger a bit here. So you mentioned that, you feel like, and I agree, I think the regulatory environment is going to change, be pro-industry. I guess what efforts or what role do you see in these the new policymakers that are about to come into office? What role should they be playing in kind of shaping our industry going forward, specifically around cybersecurity, risk management regulation, and do we feel like we're going to get more clarity or less clarity on what the regulatory environment will look like?
I think that the environment will be clearer as how that cuts into cybersecurity and identity and privacy, not so clear, because I don't think those issues have led the parade. It's been more on the question of whether cryptographic tokens are securities or not. Are they regulated by the SEC or not? Do you have to register them with the SEC or be exempt from registration? Are the exchanges liable for what the issuers say? Those kinds of issues have led the pack. But the industry should be lining up with the folks on the stage, right? The industry doesn't want to see fraud. The industry doesn't want to see criminal activity. There's always that borderland where this function might impinge on the growth of the business, right? You guys see that all the time. You were talking about that at the very beginning, Dan. How that finds its way into regulations unclear to me. I don't know that there'll be a push for privacy or security in the regulation or the rulemaking that we're going to see. But I do know that the industry should want more security. It should want, because if a customer comes in, they lose money, they're going to exit the space, right? If their money gets stolen, they're going to exit the space. Nobody wants that. No legitimate actor wants that. But I think that's going to have less to do with regulation and more to do with people getting out ahead of the fraudsters and developing products and protocols, what these guys do.
Great. So we're kind of coming up on time here. I want to give folks just a 10-second opportunity to kind of give some last-minute words of wisdom to our great audience here. Spencer?
This industry is not unfamiliar with orchestration. Identity security is just another orchestration problem. And the sooner you start thinking about that and start to kind of understand that buy and build decision, your users and your organization is going to be a lot better off.
Yeah, I'd say dive into what you've seen in other industries, right? So healthcare, insurance, financial services.
the same tactics are going to be brought back to you, and be ready.
Chris?
Pay attention to what's going on in Washington, D.C. I can't think of an election that had a bigger impact on a single industry than this election is going to have on crypto. I've searched my database. I can't find anything that's an analog. So we'll all watch that play out. It'll be fascinating.
Damien?
Yeah, so in 2030, most of us will have a copilot that help us to manage our money. Will be much smarter than the average person. Will know everything that is going on in real time with the market. And the big guys will gonna build it for themselves, Goldman Sachs, JP Morgan, UBS. The other one, I hope to build it with you guys. Okay.
Well, we hope you enjoyed the swagger we brought to the stage today. Thanks for your time and attention.
Thank you.
All right. Thank you very much. Thank you, gentlemen. I've never seen so much swagger on one stage. Well done. Well done. Thank you very much. Moving right along, my friends, we'll keep it rolling. The evolution of the retail investor. The evolution of the retail investor. A fireside chat with the CEO and co-founder of eToro, Yoni Azia, and Benjamin Schiller, managing editor at CoinDesk. Let's give it up for our next fireside. Come on out, gents.
Everybody. All right, I'm Ben Schiller from CoinDesk, publication in crypto, and I'm joined here by Yoni Azia from eToro. So just very quickly, what does eToro do?
eToro is the world's largest social investment network. We have 35 million registered users worldwide that can basically talk about the markets, open a brokerage account with us to trade stocks from 20 different capital markets, crypto assets, derivatives, options trading, and stocks now in New York as well. And on the network, you can actually see all of our customers' track record performance, and you can automatically copy the most successful investors on the platform.
Great. So we're going to talk about the evolution of the retail investor. I'm just interested in this kind of cultural and generational shift from older investors like us, I guess, to the kind of new Gen Y and Gen Z and even Gen A now. How are those kind of generational shifts playing in the behavior of retail investors today?
I think what we see is really a difference in risk appetite or appetite. I think like older generations, without generalizing too much, but thought of like dividend yield. Then we had like Gen X looking, or even baby boomers look at PE multiples. Then we're going to Gen X thinking about growth, and Gen Y with tech stocks and a bit of crypto, but thinking of how do I invest in companies I love and I love their products. And I think Gen Z is like, eventually Doge is going to be the currency in Mars, so why not buy Doge?
Well, that's what they say. So I'm interested in this kind of impact of crypto on investing generally. A number of aspects of crypto investors, like they do their own research. They tend to be less responsive to centralized authority, even journalists. How does that affect how traditional finance views these new types of investors, do you think?
So we've been in crypto since 2011 in eToro, and we're the first in Europe to launch Bitcoin in 2013. So this is now our sort of fourth crypto rally, hopefully going now into another super cycle. In 2017, we started the year with 2% of our customers owning crypto, and we ended with 90% of our customers trading crypto. So I think crypto is a generational asset class. I think most Gen Yers and Gen Zers want to own crypto. A lot of people want to own only crypto. They call me crypto conservative because I think it should be a part of your entire portfolio, which also include this old thing called stocks and the capital markets. But I think it's sort of a gateway trade. I think it's simply much easier for people to get into crypto instead of stocks. And we see like a lot of people on eToro who came to eToro to buy Bitcoin or Doge or ETH, and then gradually educating them to understand also the value of the stock markets and investing in companies and understanding how to learn about really managing a portfolio.
but the particular behavior of crypto investors and the attitude and the culture of crypto, how is that impacting behavior, would you say, day to day? I mean,
I think again, it's all about like sort of risk taking, and over time also people who made money by taking huge amounts of risks and making like, I just met a friend of mine with his kids, and he did 25% returns this year, and they're like, we did already 50, and then they started talking to me about crypto, and they're like, but we don't want to invest in Bitcoin because it's too slow. We want something that'll go like 300, 400, 500% a year. And I think that risk appetite is changing market dynamics. I actually think what we've seen in 2021 with the meme stock rally is sort of it's bringing like the crypto risk appetite investors into the stock markets, and again, people taking that risk changes market dynamics, but it also provides liquidity for more riskier assets, smaller caps. So you have more volatility, more opportunity, but also more liquidity in those markets.
Right. And it's also said that retail investors in crypto are more likely to get their information from other investors rather than from centralized authorities like banks or like journalists. Do you think that will affect how investors move in the future, make decisions in the future?
Sure, but we've definitely seen in eToro that people rely sort of on information from others, right? That the purpose of looking at others, looking at their track records, etc. But I think now, retail investors are relying on the huge amounts of information out there on the internet, both for stocks and for crypto. I don't think a lot of retail investors are reading sort of old research reports of 40 pages on a stock from a bank, right? They're reading tweets and analysis on X or on StockTwits and reading reports from ChatGPT or an LLM researching for them what's happening in the stock.
Right. And I just wanted to ask you about the election and how that might affect how eToro does business here in the US with crypto. Is that going to open up your business to more retail investors here? Because I know you kind of took a step back as well a few years ago, and are you going to be coming back in now?
Sure. So I think we had a lot of sort of uncertainty on the crypto markets in the US. The vast majority of eToro's business is outside the US still. A huge presence in Europe and the UK, which actually already regulated crypto into financial regulation. And here, obviously, there was a lot of uncertainty, or even the opposite. There was clear certainty that the regime didn't want significant retail exposure into crypto. And I think that changes. I mean, I was at the audience when Trump was at Nashville, and I've never seen such a crypto-friendly, I'd say, environment from Musk doing a government agency called Doge to Howard Lutnick, to a lot of the people who surround now the new administration are very crypto savvy and crypto bullish.
When that was an incredible event, I was there as well in the audience. To have a president or ex-president there with the Bitcoin people, it felt like history in the making, really. Talk about this notion of dumb money, and people have talked kind of rather dismissively, particularly in crypto, this kind of dumb investor. Do you think that kind of retail investor is now smarter because he or she is more informed than they used to be? What do you think about this notion of the dumb money versus the smart money? Is that changing, do you think?
I think it's completely wrong. I think we see it on our platform. Our 3,200 popular investors that are being copied on eToro generate double-digit returns, and a lot of them beat the S&P 500 indices. When I show people track record of our top popular investor in eToro generated 29% returns average in a year for the past 10 years. So these are like hedge fund level returns of our top retail investors in the platform. I think this narrative is coming from the people who want to manage the retail's money and don't want them to manage their own money. I think it's very clear that with all of the information out there, retail investors can become successful investors by making decisions on their own or on eToro by copying others. And we see their track record over time, and they're getting better and better. So I definitely think to generate double-digit returns consistently over time is not simple, but it's doable for retail investors if they devote the time and attention.
So with the kind of democratization of information and tooling and AI, do you think we're going to see a sort of flattening out of the playing field there, and the end of this notion of the retail investor on one side and the institutional investor on the other?
I think retail investors, with the tools and information that they're getting, and now AI is going to be a game changer in providing better tools, both from like an analysis point of view. You don't need 5 people with spreadsheets to analyze what's happening in financial statements. It's all real time. You can ask like specific KPIs comparison to the point where it's getting to become very effective. You can actually ask GPT, what I want to invest in this sector, just give me a stock, what stock is better, and they'll provide very good answers. We're looking now at things that were historically very complicated, like options trading strategies, and how can you actually generate potential structures that historically were issued by banks for you to say, like, I want to do 20% a year yield from basically selling options, and I want to structure that over the next 4 years. Just give me the chain. I'll just give you here, click the trade. So I think, and those capabilities in the past, you'd have to have like a room of analysts with software of structuring like a structured product. Suddenly people who have, okay, something blew up. It's my product team, like, no, stop. So I think all of the tools that used to be very difficult, oh, that's one better, that used to be very difficult for retail investors to access, and large hedge funds were doing them. I think all of these tools are coming to retail investors. Just as an example, we're now launching a long short smart portfolio in eToro, which is market neutral, right? So in the past, these were things that were available only to hedge funds, certain threshold, but now with our ability to use AI to actually generate the strategies of market neutral strategies, to update them every day, we can actually bring those type of products directly to consumers. And I think that significantly levels the playing field between retail investors and the most professional institutional investors and hedge funds in the world.
Just a couple more questions. So about particularly memes. So that's a big thing in crypto. People investing in meme coins or kind of meme entities. How do you feel the kind of the memification of finance is playing out in crypto, and how will that affect retail investing in the broader market, do you think?
So again, and I'm starting to feel old, as the oldest of Gen Y. I have to admit, I originally didn't get meme crypto at all. But what sort of led me into our first meme coin trading on eToro, which was Doge, was like, okay, if Elon Musk's behind this, it's interesting. And that was like, we launched, I think, a week before it was on Saturday Night Live, and we saw like, I think it was like huge amounts of volume of Doge that week. So I think it's interesting. It's, again, in my view, more from the point of view of the capital markets and long-term investing. I don't understand the value of meme coins, of Pepe and others. I do understand now Doge, because it's going to be the currency in Mars, but I don't understand Pepe yet, but maybe because I haven't read enough. But from a trading perspective, if you just think of the skill of a trader, which is something completely different than investing, or the way my son articulated to me, what's the problem? You just buy it when it's low and you sell it when it's high, and you make money, and you do it again and again and again. And that's trading, right? Core trading. You can actually make money in sort of zero-sum games, and some people have the talent to do it. So do I think it has long-term intrinsic value? I don't, or I don't understand most of it. Do people actually make money on it? Yes. Do other people on the other side probably also lose money for it? Yes, it's a zero-sum game, but that's the game of just speculative trading.
Right. I mean, people tend to be dismissive about meme coins. They say it's a fad. They say it's a freak show. They say they don't understand why these coins are making so much money. But do you think they will actually impact kind of more mainstream finance? Do you think for instance, companies might put out memes in order to attract attention from investors like that?
I think everything happening in crypto is impacting the stock markets. We've had all of the large exchanges in the world, from from Nasdaq to NICE to LSE, Euronext. Everybody wants the flow of retail investors. So crypto is a gateway trade, which I think is like 200, 300 million people trading crypto. They're learning how to trade, right? They're learning how to speculate about the markets. Some of that speculation can translate to logical long-term investments like digital gold as Bitcoin and digital oil or natural gas and with ETH and Solana. And some of it is just pure speculation, but you have that in the markets as well. You have penny stocks and you have people who love to trade penny stocks, and that's a part of the market. But when such a huge amount of people around the world are learning how to trade, how to speculate, how to take risk, and sometimes the most important lesson early on when you start your life as a trader investor, learn how to lose money gracefully. I think all of that impacts the market because a lot of them are going to move eventually from crypto to the stock markets, and they're going to take a lot of the lesson learned in crypto into the stock markets. Again, that's my view, although some of them are saying it's only crypto. But again, my view is eventually everything becomes digital assets, and once stocks trade 24/7 and are as easy and fun to trade as crypto, I think we'll see this entire generation shift to stocks as well. And again, it's going to bring a lot of liquidity, a lot of volatility, and in some aspects, a lot of like fun and interesting memes and stories to the market as well.
Excellent. Thank you very much. I think we're out of time. Perfect timing. Thank you, Yoni, and thank you, Benzinga. Thank you.
Thank you. Really appreciate it. Thank you, guys. What a wonderful session. We really appreciate it. I'm going to keep us rolling, my friends. Next up, compelling narratives and technologies to better engage audiences. Here to lead our discussion is Sarah Smith, Chief Growth Officer from Ticker. We've got Katie Perry, marketing strategist and host of After Earnings, Abdul Zoheb, founder and CEO of Sensa Market, Michael Bazzello, head of product and engineering at StockTwits, and Trent Hare, CEO of Bull Rush. Let's give it up for our next panel, please. Thank you. Have a great session. Thank you. Bye. Have fun.
All right, this thing on. Hey, everybody. This is my first panel moderation session. So if I could get some support from the audience, little whoop, we're awake. Lunch was good, feeling good. All right, cool. Thank you. And patience as I work my way through this. But I have amazing panelists who are going to chat with us today. Because we only have 30 minutes, I thought I would kind of tee up a question for everyone, allow them to introduce themselves, answer the question, and maybe give us like a really cool practical piece of advice from their industry. So we're going to start with Katie. Tell us, what are some of the key trends you're seeing in how retail investors and traders are engaging in the markets today compared to a few years ago?
Cool. Well, to quickly introduce myself, my name is Katie Perry. If you came here for the artist, you came to the wrong place. I am the head of marketing at Stakeholder Labs, which is an IR software company. We also co-produce a podcast with Morning Brew called After Earnings, where we interview public company executives. Before this, I was at public.com, which is a retail investing app, and I was the first head of marketing there. I was there about 4 years through all of the meme stock craziness. So I've had a front row seat to these changing behaviors. And yeah, I think it's what we've all seen and experienced in our own day-to-day of just the normalization and the mainstreamification of trading and investing. I know when I started working in this industry a few years ago, none of my friends were doing active investing. Maybe they had mutual funds or 401ks, but it was really a niche thing. And all of a sudden, in the last few years, I'm getting girlfriends sending me, "Hey, check out this stock I found, and it's awesome." And so I think the biggest thing is just for platforms. I think the takeaway is don't assume you make an ass out of you and me. Don't assume that the thing you built for historically is who the new audience could be. I think it's changing a lot. So if you typically build for traders or a certain demo, you can think about what's out there because there's a lot of interest beyond the growth pockets that you've already leveraged. And we're seeing this across a lot of things. It's not just about people downloading apps and trading. It's also people are really into the research side. Obviously they're on Reddit, but there's all these Gen AI tools they're using. They're listening.
They're on stock.
Oh, they're on stock twits all the time.
Plug.
Yeah, and so they're listening to earnings calls, which I know you'll touch on. And so yeah, thinking outside of who your current users are, and obviously you're going to build for them, but there's a whole world of people out there getting into this, and there's new opportunities to reach those people.
Amazing. Thank you. All right. Let's start with Abdul then. As the financial landscape continues to evolve, what do you see as the biggest challenges in attracting and retaining the next gen of market participants?
Sure. Thank you, Sarah. I'm going to just quickly take a minute to introduce Abdul Zohair from sensormarket.com. So again, we are a fintech platform. We work with institutional users and retail users. We are pretty much first in the market to have 100 plus pre-built option strategies, making it easier, intuitive, and connecting with the brokerage firm like Trader Brokerage, TradeStation, and execute the trade. Thank you, Dan. All right. So that's a quick introduction, but I'm going to lay out, I think, to your answering a question, right? I want to start with one of the code, right? In the world of fintech, we are not just disrupting industries, we are reimagining the possibilities. I think this has been going around, the code has been going for a few years. The exact pinpoint of when exactly it started is unknown, but it kind of deeply resonates now with what we face today. The financial landscape, like we were talking about, is changing or evolving faster than ever because of the new generation which is coming in. And these are the new generation who have been brought up with like instant data, personalization, and they always want that seamless experience. They also been fed with lot of overwhelming financial data and lot of data. So they're looking at a tool and a technology where they can kind of trust on that. It has to be seamless experience for it. So that's where they are tending towards the next generation of market participants, which is pretty much Gen Z, right? They're not just demanding for tools, but what they want is empowerment. With technology that doesn't work, but naturally it becomes an extension of the financial journey. One other thing which really goes well, Mark Weinzer puts this very nicely. The most successful technology is invisible. It becomes woven into the fabrics of everyday life. I think that's kind of the striking balance as a platform company where we strike towards, where we want to like engage the new generation of participants and user base, right? I'm going to come back and answer a few follow-ups over there, but again, just to like kind of like summarize over here, right? Again, the financial world is at a crossroad. We can overwhelm with a lot of data, or we can empower with the tools which makes them feel intuitive, intelligent, and seamless, which is pretty much like invisible. It should be right there for them.
Beautiful. You could leave anyone, if you could leave the audience with a quick kind of like note of advice, what would you give them as far as what you've learned? Yeah, with retail traders.
I don't know, like again, it depends on the generation, right? Where they want to come. Everybody is looking for that seamless interaction. The technology and the tool is just like your helping hand, but the data is there. But how do you make that meaningful data is where we as a platform company has to step up and get there. Even AI is there, data is there. I know we can talk about AI probably in the next question, but how do we make that meaningful insight? It could be for a new user, it could be for an intermediate user, or somebody from institutional hedge fund managing like 30 million funds. It's the time is of an essence. Like you bring all the data and then you take them 2 steps forward. The AI is not going to do it, but you are creating that experience and the technology right there at the fingertips.
Awesome. Thank you. All right, Mike. The use of AI and data analytics is becoming more prevalent in financial services. How can these technologies be leveraged to empower retail investors to make more informed and confident decisions?
What's AI? I've not heard of this term.
I don't know. Does anybody know what AI is? Raise your hand.
No, I'm just kidding. So my name is Mike Bazzello. I'm head of product and engineering at StockTwits. If you're not familiar, we're one of the largest social networks for investors and traders. We're approaching 10 million registered users. We do hundreds of thousands of messages a day. So I'm going to come at it from a community angle. I think there's tons of applications on AI. You guys have probably heard all day long and for the last year. I look at it from like a connection perspective. So if I think about AI and community, I'll give you an analogy, right? So we're having this conversation up on the stage, all sharing insights here. Somebody's going to walk through that door late. We're not going to shame them, but they're going to come in unprepared. They don't know what's going on in this conversation. All this, conversation has happened without them understanding. So are they likely to participate if there are questions at the end? Probably not. So from StockTwit's perspective, what we think is really interesting is being able to summarize the conversation for our users. And in turn, what we think is you're really kind of allowing them to belong in the room, right? And that's what AI is doing. It's kind of even the playing field again by giving people the ability to belong and find connection. So practical application of this is on StockTwits. If you go to the Tesla stream, there could be thousands of messages in the last hour. If I go to that stream, that real-time conversation, I'm going to have a hard time digesting it. What if we can use AI to extract the most important pieces of that conversation, make it very easy to digest? Then you're more likely to get involved and engage. So from our perspective, again, there's a lot of applications, but we're really excited about that ability to get somebody engaged through the conversation.
Love it. What's like a practical piece of advice you think you could give as a takeaway for the audience?
I guess practical would be go to where your users are and what they're doing. So I think from our perspective, you should be trying to deliver value to your users in a way that they would expect it versus forcing something upon them. So at StockTwits, that's creating content that's very digestible, engaging, and then through that, adding in clean data and insights just makes it very easy for somebody to get involved. So I think you just got to know who you are and your DNA and, double down on that. And that's something we've learned at StockTwits over the last 15 years.
Very cool. Thank you. All right, Trent. Many platforms have found success in building vibrant online communities around investing and trading. What strategies have you found most effective in fostering meaningful engagement among your user base?
Yeah, that's a really good question. One thing I think I'm pretty well versed on. So for those that don't know, Bull Rush is the first ever paid entry trading competition platform where users from around the world compete in daily trading competitions, trivia competitions, and other challenges for cash prizes. Our entire platform is just a gamified platform. It is literally built to drive user engagement. And so what we do is we drive user engagement through those competitions and then give them a place to go and have that conversation and have that Discord. So currently we drive users into the Discord platform. And what we see a lot of is a lot of interactions, probably similar to StockTwits, where people are coming in, they're sharing trade ideas. There's a lot of banter. I'm sure we all play fantasy sports, or a lot of us do, where you play with your high school buddies, you're talking crap back and forth with them. We see a lot of that inside of our community. And so to drive the engagement on our side, what we specifically do is give them that reason to start that conversation, whether it is our daily trivia question, whether they're discussing, hey, how difficult is this, or how easy it was to do it, whether it's a competition where they're, trying to compete to be the highest and, you miss out just on that prize and the person in front of you is talking smack back down to you. And then of course you go and you ask them, hey, how did you win? How did you actually beat me in this competition? And they'll share the trade ideas. So we see a lot of exchanges of information that way as well.
Love it. How about a practical piece of advice?
Yeah, so I would say gamify it. I think Katie mentioned, her friends are now asking her, hey, about the stock, since COVID. And the way that people learn these days is a lot different than the way that probably our parents grew up learning. And the type of investor that is out there, the trader, is a much different. No longer do we have the person that just paid $75 to enter a stock and they're buying and holding forever. They're much more engaged. They want to be in and out of the market every day. And so giving them a gamified reason to come back and continue to trade would be the approach that I would take.
Love it.
Can I add something?
Yeah.
Building on that, I think there's a lot to learn from consumer apps. So I think sometimes in your industry, you tend to look to peers. Oh, what are they doing? What are they doing? And historically in fintech, that's happened. And I think what you're seeing is, I think it was 1957 when the S&P was started, 5% of people held stocks. And now 60% do. It's like a totally different demo. Everyone has a fintech app on their phone. And so if you're looking for inspiration, whether it's content or features, UX, looking to other platforms outside of fintech could be very helpful because it's not like it used to be with the screens and the monitors, and that's the only way people are engaging with this stuff. They're doing it while they're at drinks with their friends or over the weekend from their phone. So I think there's actually a lot to learn outside this industry, and it may be good to look there for inspiration too.
So I'm curious, Michael, like ours, it's 80% of our user base is actually on mobile phones. What are StockTwits?
Ours is like 65% mobile. Actually, most of our audience comes through web, but the most engaged users are our iOS, Android app by far. It's like crazy engagement on app.
Yeah, and I think it's just how we grew up. We all have phones these days, and so it's natural. We're not going to be sitting at a computer screen all day, to your point, Katie.
Yeah. Trent, tell us a little bit more about what you're doing to drive ongoing engagement. You're giving me some practical examples earlier that I thought were really cool. So I'd love for you to share those.
Yeah, good question. So again, it's all gamified. So experience points, promotional credits. One of the ones that we talked about specifically was our daily trivia question, where we want people to come back in every single day into our platform. And so the way that we do that is we put a daily trivia question that they come in and answer. It's always related around trading. And then if they get 20 of those correct a month, we then go and put them into one of the paid entry competitions. And so it just gives people the reason to come back in our platform. And then, of course, it sparks that dialogue in our chat communities where people are talking specifically about that question and how difficult it was or how easy it was to answer.
And can I add something too? So we didn't meet each other before, and we're moving into gamification too on StockTwits. Slightly different, not paid, but more from like a social capital perspective. So we'll allow our users to predict on the platform. You can see the best traders are, how much they're up, and in turn, those become creators for StockTwits, right? Where I want to follow Trent to figure out, what's he trading or what's he doing. So the premise is very similar. I think we're like looking to leverage our communities slightly different, but it's the same idea.
We have the same thing. So we have certificates. So if you win it or place top 3 in a competition, you get a certificate. What we see a lot is those users go on social media and they go share those certificates, which obviously is free marketing for us. And so to your point, they're brand ambassadors, even though if they don't know it.
And it's never ending too. So like, it's just like DraftKings or you play fantasy sports, like every week there's a new winner and that means new creators. And that's a really good thing.
Love it. Yeah. And Mike, tell us a little bit more about what you're seeing when you're hosting your post-earnings virtual sessions. So, retail investors are actually tuning in to learn more about what public companies are up to and forecasting and all the things. So tell us what you're seeing.
How many people have listened to a conference call recently?
Wah, wah.
Pretty small percentage, right? How many people would think a typical millennium audience, that's millennials are on our platform, would listen to conference calls? Not many. However, retail does have an appetite for it. We recently partnered with Quarter and launched live earnings calls on our platform that you can listen to, chat, share your sentiment, get analysis during it. And we've hosted about 5,000 calls, have had 400,000 listeners, and people listen for an average of 7 minutes. So retail really wants to be engaged, and they're engaged differently than we thought. And that's back to your point that it doesn't look the same as it used to look. People are willing to do new things, and they just want to be involved in the market, and they're interested in doing their due diligence and congregating around something very specific. So for us, it's been a really fun product to launch.
Very cool. Yeah, tell us more about how your tech and Stakeholder Labs is kind of going out there, doing all the listening and bringing it back so it's in a digestible format for.
Yeah, on the back of what you were saying, I think the companies are kind of getting that and they're spicing up their earnings calls. So they're not all bad. I don't know if you guys heard the Palantir one. Alex Karp was like a maniac, and he was just like dropping like bangers. It was like the most out of pocket.
People love that. They absolutely, it makes them more in love with the company.
And it was a good earnings call. Like he started with like a mic drop and he was like, I don't even know why we're even here. We did so good. That's obviously an eccentric example, but I know Duolingo had their earnings call. A big piece of their product that they rolled out was this AI coach named Lily. They actually had Lily read part of their earnings call and like her personality. So at Stakeholder Labs, we're working with companies that are leaning in like this, and basically we build tech that allows them to measure their shareholders, understand their behaviors, understand who they are, and understand the best way to reach them. I think the other big thing we're seeing, and there was actually a Wall Street Journal article about this that came out today, was that These companies are going direct to investor, and they're also thinking about AI and how they're using it within their IR teams. So things like, okay, can I use AI to predict what certain communities of investors might ask? You could plug an AI tool into Reddit conversations about a ticker and understand what retail's saying and anticipate that. So I think there's a lot of progress happening, which is good to see on the side of public companies that are really getting that this audience is watching this stuff like TV shows sometimes.
Yeah, love
And they're meaningful. I think like retail was just not taken serious for so long, and that's what I look at as the biggest benefit from like the COVID GameStop years is retail's not going anywhere, and they are impactful and meaningful. So yeah, I'm very excited by what you're saying too.
Yeah, Abdul, how about anything to layer in from your perspective on AI or
Pretty cool. Yeah, right. Again, from the retail perspective, right? Same thing, right? With the new generation, like bringing that fintech influencers, right? Things like this group chat is working really well. So other things, just like for the retail, personalized recommendation and education. How do you want to bring that? The new generation Gen Z is growing up with a lot of data, but they want to kind of like play around real time. They want to have that templates ready, be engaged, ask the questions. So integrating that chat along with like what we have with the pre-built algorithms, right? You're playing with those algorithms, you're visualizing your profit loss potential, especially the option strategies, right? Where things get complicated. But there's a lot of retail customers who's kind of like jumping in, who wants to do trade, but they don't know what is the maximum loss looks like. What could be that potential or the break even. So bringing in that chat with an AI, with the pre-built strategy, with the algorithms are the things which kind of like helping our retail customers. Again, it could be a newbie starting out right for education to learn about the strategies to kind of executing the trade, or it could be somebody who's like expert user, but he wants the data real time. He wants to go with the flow and engage this audience as well to bake that into a meaningful data that the hedge fund manager in this particular case, if I have to refer, right, like which we had worked with, makes the data more meaningful and then kind of like place a trade.
Right. Love it. Mike, tell us any misconceptions out there about the retail investor. I'm sure you see a lot on StockTwits and
Oh, I mean, some are true, right? I think like the YOLO traders are real, and honestly, there's nothing wrong with that, right? Like I don't think there's anything wrong with being like, hey, I want to turn my 500 into 500,000. But I think the misconceptions are that they're not sophisticated or they're not leveling up every year. What we see is the more tools you give them, they want to use them if they're easy to use.
Right.
So again, I think they're quite sophisticated. And again, it's like anything, there's tiers of it, right? Like the top 1% are like crazy good, and then bunch in the middle, and then there's the newcomers coming in. But we just don't want people to burn out, right? So we think it's really important to give them tools so they don't just burn out. They come in and they churn, right? You want to empower them. So
hey Trent, you came out of the gates blazing with growing your user base. Tell us how you did that and maybe some practical kind of takeaways from that process.
Yeah, thanks for that. Thankfully, we have a good marketing team. So it was not me that grew that. But yeah, so to your point, we launched 4 months ago and we put 31,000 users on the platform, and we get anywhere from 1,500 to 2,000 daily active users currently. What we did was we took a good approach in the sense that we partnered with a lot of influencers in the space where we got them to go and help promote our services in exchange for either paying them directly or giving them free entry into the paid competitions. And we did that combined with our paid marketing, which we, tend to focus on Meta. But at the root of it, we gave them a product that they actually wanted. So very good user experience. I think we talked backstage where we've already retooled our marketing message once, and we retooled our dashboard, our front end another time, to really make sure that it's a easy to use platform that people can come in, they can understand right away, that keeps them wanting to come back every single day. And so it's not just about getting them in there, it's about keeping them active and wanting to come back.
Very cool. Katie, so you do a lot of awesome interviews on your podcast. Tell us a little bit about maybe anything you gathered from your interactions with CEOs out there on their perspective of retail.
Ooh. Yeah, so there's a lot of examples. Oh, I'll back up. So Stakeholder Labs co-produces a podcast called After Earnings. It is what it sounds like. Executives go on an earnings call, and then they'll come on the podcast and talk to us for 30, 45 minutes. And you'll really get the nuance behind some of the moves they made. Why was the cash this way, or what was this line item, and they can really dig into those updates and announcements. But the part I love about them is you kind of get to know the executives as people. So a couple examples that just stand out. One would be the CEO of Elf Beauty, cosmetics brand. They've had 23 consecutive quarters of 20% growth. Like, they're absolutely ripping. And this guy's knowledge of the product SKUs was insane. Like, I was like, ingest, like, what's your skincare routine? And he just rattled off like 17 things. And those are the things you get in like hearing from the executives. There was another example, I believe it was Kava, and the CEO was saying that for 2 years before they IPO'd, they were doing earnings internally, like even with mock calls to like prep themselves. Another example would be the Monday.com CFO. We chatted after, and he's talking about how he really preps for these podcasts, and he put a lot of time into it. And it's like that kind of insight you get from hearing directly from the executives, that it might not be the reason you decide to invest in something, but there's these intangible moments where you're like, I like that person, or oh, this person really knows their product. And I think that's the most interesting thing you get when your executives are out there more. And I think we're used to seeing CEOs out there, especially the same CEOs. I know Mark Zuckerberg glow up and he's wearing these crazy clothes and everyone looks at that one. But there's also like a lot of CFOs that are on the circuit now. Yeah. And I almost think that part of being a CFO these days is you kind of have to be out there. And for investors, I think it's interesting to pay attention to like the story behind the story. Right. And that's what we try to uncover on the show. Love it. And you can listen to all the episodes at afterearnings.com.
Perfect.
And Katie, is so interesting. Elf, when they did their earnings call, they had like banging music at the beginning, and everybody on StockTwits was like, "This is fucking awesome! Like, I love this." And I think though the companies that are figuring out how to like hook their claws in retail and make them like dedicated, hardcore, investors in them is a big deal. So
yeah,
like, that's super
NVIDIA
interesting.
has, actually watch parties. Have you guys read about this? Thoughts on that? The next generation of investors, is it kind of like going to see your favorite band? Like, our earnings call is going to be like,
Absolutely. Yeah, absolutely. Like, NVIDIA Day for us is like a huge thing. Our content team, we just blow it out of the water, gear, everything. It's like the most important thing happening. This is like going to be crazy tomorrow. So.
Yeah. Hear a lot of themes about just like humanizing the process. And when, people talk about retail investors, it feels like they're talking about everyday people, which they are, right? So I always find it interesting, kind of like dig into the minds, because it's always institution. But we are all retail investors. 1 in 3 Americans is a retail investor. They're choosing to buy the brands that they love and own. So I'm curious, this can be for anyone. What's your favorite stock to own, and what are your thoughts on, and why did you choose to invest in that company from a retail perspective?
Goat coin. You guys familiar with goat coin?
Oh my gosh, goats again.
No, explain.
No, I'm just kidding. Not financial advice. I just mean like, if anybody knows anything about like the crazy crypto world, pumped out fun.
Yeah. My brother told me to buy Floki Inu, which is a Dogecoin.
There you go, Floki. Love Floki.
And now Floki's up 500%. That's not advice either. My brother's an idiot, but apparently not. Yeah, I need to think more about what mine is.
Well, the crypto side of things is interesting because you were elaborating on this, but I thought was really interesting is that like all of the buzz around crypto has really lent itself to this narrative around retail investing too. So tell us more about your mindset on that and what you've seen.
Yeah, no, that's true. So before crypto really entered the space, you see every other industry really gamifying what they do. Kids these days learn how to type via a game. Fortune 500 companies use games inside their corporate learning and education. Duolingo, like every single app has some sort of gaming element embedded into it. But we didn't really ever see that in the investing or trading community until cryptos came into the space. And then cryptos, I would say, were the first ones to start with the leaderboard functionality, where you have the best crypto traders, and then you want to go and be at the top of that leaderboard so you can get some, social clout. And so overall, just the gamification side of things. And I think that industry is going to continue, whether it's StockTwits going into gamified, whether it's Bull Rush doing into paid entry competitions and gamifying it. I think crypto just jump started that for the rest of us, and we are now, chasing to play catch up on our side of the industry.
gamers became traders. Like it's
That's exactly
so
what it is.
natural.
I mean, everybody, probably in this room has played a video game at some point in their life. And if you grew up in the 80s or 90s, chances are you played either, Nintendo or Sega Genesis, and it just is carried on to this day.
Love it.
So, Michael, tell me more. Like the earnings call in the community, the fintech, right? Especially the influencers coming in. It was a big hit. What's coming up next?
It's competition. It's gamification for us. It's huge. Yeah,
next.
we're gonna
When is that getting launched?
very soon. No, early next year. Early next year. Yeah, I'm gonna start the trend, but yeah, early next year.
Love it. You heard it here first. All right, with 30 seconds left, any last thoughts? Anyone?
Does anyone have a stock they want to shout out?
No, everyone totally dodged
I
that.
feel like nobody wants to give financial advice so we don't get in trouble
I
from
feel
our
like
lawyers.
I have one, but I
My
actually
compliance
haven't-
officer shaking his head like,
Hey,
nah.
tell us.
Who's shaking their head? About
My compliance officer.
Oh, your
sitting right down
compliance.
there
Oh, not mine.
and
Okay.
telling me not to do.
I like this. I like the stocks of like companies that like it's something you don't think of every day, and it's not like the Nvidia. It's like something really boring, like waste management. Like I don't know what that genre is called, but like I like a John Deere.
Called garbage.
I like.
Waste management.
Oh, I mean, again, I haven't looked at the chart. But yeah, I recently learned that Utz Pretzels is publicly traded. Like this is why it's fun to get into this stuff because all of these random brands have public businesses.
Yep. Agree. All right. I think that's it. Thanks, you guys. Thanks so much for your
Thanks, guys.
time.
Thanks, everybody.
Let's give it up for our panel. Thank you so much. I definitely want some Utz pretzels now. Thank you for that. Thanks, guys. Very much appreciate it. Thank you. Thank you. All right, my friends, we're going to keep it rolling. I have the distinct pleasure now of welcoming out one of Benzinga's own. I think this is the first time he's moderated a session here at this event. I could be wrong, but we'll see. This is Andrew Lebos, SVP of Data Licensing. Andrew, why don't you come on out? Let's give Andrew a round of applause, please. Licensing team, are you here? Licensing, there we go. Let's make sure and heckle Andrew a little bit while he's up here. Andrew, great to see you, buddy. Yep. All right, next up, Vitaly Kudinov, SVP of Sales and BizDev at DevExperts. Evan Berryman, VP Strategy and Operations at Lightspeed. Steve Orr, founder and CEO of Quasar Markets. And Sarah McKenna, CEO of Sequentum. Come on out, my friends. Let's give them a round of applause, please. Oh, you can do better than that. Come on. There we go. Get up in there.
All right. Thanks, everyone. As mentioned, I'm Andrew Lebos, the SVP of Licensing at Benzinga. Let's do a quick round of intros.
Hi, my name is Vitaly. I work at DevExperts. DevExperts is a software company, so we build trading platforms. We also have a market data division, and we build software for brokers. Our recent development is AI chatbot that simplifies and improves the customer care operations. So we'll talk about it.
My name is Evan Berryman. I work for Lightspeed Financial Services Group. We are an introducing broker-dealer for active and sophisticated retail traders, specifically that trade equities and options.
I'm Stephen Orr, better known on Wall Street as Big Beat, and I'm the CEO and founder of Quasar Markets.
I'm Sarah McKenna. I'm with Sequentum. We have a web scraping platform and an all-in-one data platform for ingesting, transforming, structuring, and delivering your data.
Awesome. Thank you all. So we're here today to talk about unlocking value through data and cutting-edge technologies. The space has changed a lot. Everyone and their mom is trying to build a brokerage. It seems like there's a new brokerage every single day. Evan, I know Lightspeed has been doing this for many years. How do you see Lightspeed fitting into this new brokerage landscape?
Yeah, it's a really good question. With the explosion of broker-dealers, specifically since the pandemic, that's kind of gotten everybody in the markets of all different skill levels. The way we see ourselves fitting in is knowing what we do well and focusing on that. I think that consumers in any business understand when you're trying to be something that you're not. And our current customers expect a certain level from us, from our technology suite to our service to the partners that we work with. And so we do a really good job from an organization, top down, bottom up, making sure that we know what our vision is, know what our customers want, and delivering on that vision.
Nice. Thank you. Vitaly, I know that you guys serve a lot of brokerages and you have a lot of data. And so I guess we'll foray into the data discussion. How are you collecting, storing, using this data in an effective way?
Right, so let's separate the data that is public by default, which is market data and news, etc., and the data that the broker has in their own platform. So the data that the broker owns, like their client data, trades, etc., this is their data, right? So we never share it with anyone else. But we build tools for the broker to analyze this data and to work with it. As for the public data, well, there is a storage, I think 5, 6, 7 petabytes of information because we collect every tick data starting 2010, I think. For the daily aggregations, we go to the full history back to 1970. And at some point, we just realized that, okay, this data, even if we pack it well, it takes time to extract. So we started building data lakes on top of the original storage to access the data in a more efficient way. So it's available for quants, it's available for buy-side, sell-side firms, and the API layer. So at some point, we've built an API layer that can be hosted on our premises in the cloud or on customer premises, say in colocation in a data center. So we improved the transport layer to the stage where it doesn't matter whether you're using front-end technology like web browser or mobile application or back-end technology. You are using the same API and you get the fastest access to the historical data. Finally, AI, it changed the rules of the game because we were working with structured data. Structured data is like SQL databases or some other storage, but still you need to create a query to get the data. AI doesn't require you to formulate the query. You speak the natural language and AI provides you the answer. So we're now converting this huge amount of data that we have, also the private data that the broker owns, into the format that AI can consume. So we basically train AI on this data and provide answers to users, even sometimes the answers that users don't expect to get. So this is the power of AI.
Nice. Yeah, AI is changing the game. Steve, I know you work a little bit with AI. I heard you you spoke on it recently, and won some awards as well.
4 now so far. I guess.
4 awards. Nice. How are you using AI?
Yeah, I mean, look, I've been talking about AI for over 12 years, and I think the key to AI is hiring the best and biggest squirrel you have and give the biggest wheel to keep pushing that along, right? I mean, when talking about AI is about one thing and one thing only. It's about data and how to structure that data and how to get that data actually in a way that the user actually understands it, right? We're in the world of fintech. I've been doing this for 30 years plus, and I can tell you that what the new retail users are using it, they don't sometimes understand what the answer is. What is price to equity ratios? What is a Sharpe ratio? They don't understand that. But I think AI is doing 3 things. And I think the first thing that AI is really doing for it is getting the data fast. When people ask me all the time, and when the other day on Schwab, I was asked this question, Steve, what's the best stock to buy? And I heard earlier, in AI, it's the companies that have data. Think about like Salesforce and Facebook and Google. Why? Because they're the companies that have all of the data. What we're looking for in the next level of all of this is letting the AI structure structured data. So data that's already structured, think about like Fred or Edgar or database that we already use. Instead of just hitting an API and going after all the time and hitting up that API all the time, what I'm saying is why don't you just download all the data? You can have it in your own storage systems. MongoDB would love you. They have Atlas right now, Atlas Prime. And there's ways of doing that faster. The third thing I think is making the data palpable so it's easy to understand. And I think you said it right, Tully, is answering questions that they didn't even know to ask. Giving them an answer. Why, if someone's chewing gum in Japan, is that changing gold prices in Australia, right? Why? I don't know, but the machine does. And I think those are the 3 main things that AI does and does well.
AI is huge. We work with the brokerages, and a lot of times they're squirmish about tools that use AI in any way. We've had to build some human layers to the products that we use with AI, and so Sarah, I feel like you kind of figured that out. How do we trust this data and this AI usage?
Right, very good question. Right, we have a lot of AI startups that are building on top of our platform, and our tagline is trust and data. And here's how we think about it. So first of all, the only way that you're going to trust the data that's feeding your AI and your analytics and your decision making is if you have total transparency. So we make sure that every stakeholder in the process has a view into exactly what's happened. Right, we cut our teeth. We have an all-in-one data platform, but we really cut our teeth on web data, which is notoriously untrustworthy. And we're obsessed with trust, reliability, compliance, quality, right? So how do we do it? We basically have taken the software principles from agile software development and applied it to data processing. So we look at, how do you define your acceptance criteria, right? We have data validation, monitoring every step of the way. Anything going wrong with that data that's falling outside of expectations, you can set 80 plus monitors for a single field in a column or a row of data that's coming across. Not only that, but we have all kinds of tolerances that you can configure to make sure that it's not too noisy. So just your data quality monitors, like we don't think of data observability as something that's outside your data process platform. Ours is inside. We have it integrated every step of the way. But not just that, but we have audit trails that are showing every change that's happened in that agent, who did what, when, why, changes to inputs. So a lot of our customers are SEC governed. Their compliance teams want to know, for example, that they're not automating a CAPTCHA, right? That's a particularly sensitive aspect, right? Our platform actually is low code. So you're composing your automation with tried and true reusable building blocks of automation. And this makes it the audit trail that much easier, because you have a human readable definition of exactly what's in that agent. And you know what happened, when, by who, where, what time, at any given time. We store those audit trails for as long as our clients want retention. And the last thing I will say is, as obsessed, you can tell that we're very obsessed with this, right? We expect things to go wrong, right? Things do go wrong. Like, for example, we had a customer come to us recently and say, we're so sorry. We've been running this scrape with you guys. I'm talking, like tens of millions of requests per day for years. And they said, we're really sorry, but we didn't tell you. We also need this other data point. Can you do anything for us? And we were able to go back, because we're so obsessed with auditing. We also cache every page that we've pulled down from. We were able to go back, and 3 days later, 3 years of data was transformed, and they had the point that they wanted. And they know they can trust it because we have the platform architected and the team operation defined to be able to do these things so quickly.
We should definitely talk after this for some of our processes. I don't know if Tommy's in the room, but we could use some of that audit trail, especially working with hedge funds and quants. So they probably love that. The institutional world probably loves the audit trail. We talk about trust with retail. Evan, it's quite a bit of pressure to have people's money on your platform. They're trusting that the data on your platform is accurate and execution is done correctly. How do you guys instill trust in your users?
Yeah, I think specifically in the retail trading space, the first component of this is, and it alludes to what I talked to earlier, delivering on expectations. Lightspeed's really known for its execution speeds, platform uptimes. We're really known for our technology in the retail space. So it's delivering on those expectations, right? Like, people have an expectation when they open an account with us, what their experience is going to be like. So really, it's building that trust through experience is the first element. And the second part of it is integrity in our leadership team. So our leadership team at Lightspeed, from the C-suite and our compliance team as well, we're never looking to convey anything, promissory or misleading, or try to convey to the public that trading is easy and it's a guaranteed way to make money. We understand with retail traders specifically that it's a lot for an individual investor to put capital on the line. And so, not only do we try to provide them with a good experience with our technology, in terms of advertising, website, partnerships that, we try to make sure that they align with us in terms of character and integrity and how they view trading, it's difficult. And yeah, I think that really just delivering on expectations and understanding your customer and making sure that they understand that you care and that you are trying to give them all the tools that they need to reach their financial goals, whatever they may be. That's how you deliver on trust as a retail broker dealer.
You sold me. I might switch my primary brokerage. Vitaly, so on the same vein of trust, I heard you guys have a really cool chatbot feature that is using AI. How do you ensure that there's no hallucinations, that people can trust the conversations which are critical for users, that they're in the right direction and saying the right thing?
Right. So we started with low-hanging fruits, not with LLMs even, because AI it's actually bigger than just LLM than ChatGPT, and we started working with it like 7 years ago when there was no LLM available in the market. So first thing that we did, we improved the communication channels between the end client and the broker. So even if it's a chat widget in the web browser, it's connected to the trading platform, and if the user allows, it takes the data from the trading platform, like my account, my positions, cash balance, etc. So it can answer questions that a human usually answers the question, but there is no place for hallucination because we're not training this AI on some external data. We just provide the data in a best format for the user, and we provide this immediately. The user doesn't need to wait for account manager to take a phone, right, or to answer in the chat. So that was one thing. Second is multi-language. So instead of hiring people who speak different languages, now we're just using auto translation, even for audio that is recorded, because you can talk to the CI using your natural language. You can send the audio messages and receive the text in your language. Finally, we added more communication channels like, okay, this is the website where you can communicate, but can you do it in WhatsApp? Yes, of course. Can you do it in Telegram? Yes. Discord? Of course. So actually, you can use your favorite communication channel to talk to your broker and even to extract the data from your trading account or even place trades if you want. So that didn't even require LLM to do all of that. And that was already like a huge win because brokers who are using our chatbot, they saved on like human personnel. They still need people because chatbot doesn't answer all the questions, and some questions are complicated. And the more complicated is the inquiry, the less effective is the AI today. So we still route those questions to humans, and they still help answering them, and then they can take control of the client screen, have a video call, etc. But it really improves the performance of the whole scenario because what you can automate, you automate, like KYC onboarding. That's doable, very easy, right? But you're right. If you just allow LLM to control that, that's a dead end because yeah, it hallucinates. So you cannot just connect chatbot like ChatGPT and talk to your end user. That's not compliant. That will not work.
Sorry, someone got a phone call.
Not my fault.
Okay, so just to tie that together, so you are just using the data from the brokerage. You're not allowing for any hallucination because it's only what is provided. Vitaly, right? Okay, so Steve, you're using LLMs, right? Okay, and how are you avoiding the potential of hallucinations?
Yeah, that's a great question. I mean, I have been a trader for 33 years, so compliance and FINRA regulations and SEC, I've seen it growing. I mean, people always ask me all the time. I learned on graph paper and pen technical analysis, right? So I wanted to make sure that our system was compliant from day one and not the other way around, not letting AI. So in order to do that, what we did was we said, okay, we know that any AI, doesn't matter if it's Strawberry or AWS's AI or Gemini, they all hallucinate, every one of them, right? So how do I keep that from happening? And that's very simple. We actually went and attached the actual LLMs to the actual databases. So think of it like Fred and Edgar, and not let the machine get outside of that database. So, and we also wanted to make it in a way that allowed people to make those connections themselves. I think you said about the personal level of it. So let's think of it like this. We also put weather and sports and all the kind of things that as a user, as traders, we do all kinds of things, right? We don't just trade all day long. It was boring if we did that. Trust me, I've lived for 33 years. What we wanted to find out was connections. So if I added Fred, which is, the databases for most economic data for the United States, and attached that to baseball, well, what's the connection of a right-handed pitcher for on the Houston Astros and the market moves tomorrow? Well, I don't know the answer to that, but the AI does, and it doesn't hallucinate. It actually pulls from those actual databases. And the key to that is not just scraping through APIs. If you're just doing that, then it's going to fail. What we wanted to do, we partnered with WebMob and Kiwi Tech, that were the original partners for SEC of pulling down the actual 10Ks and 10Qs. So if you're going to Fred and you're going to Edgar all the time through APIs, you're wasting energy, first of all. But second of all, you're going to get the data, but it's going to be slow. What if all that data is sitting in your MongoDB and sitting in your backend already ready to go and already PDF and set there? People always ask, like I said earlier, you got to have the data. You got to own it. You can't just be a company that says, well, I think I'm going to go scrape the weather today, right? I'm going to actually go talk to the weatherman. I'm going to find out. And then the problem also was on top of that was that most chat GPTs and LLMs end in November of last year, or they end in March. They're moving up a little bit better. We wanted to add closed captioning TV. We wanted to add actual news. We actually added Twitter feeds. We added stock to it. Shiv Sharma, thank you, man. Look, all of those databases that we use, instead of letting the machine hallucinate and make up stuff, we said, you know what? I think I just want to talk to stock to it. So I want to get all their database, and we suck it down and put it in our backend and say, okay, we're going to use it and let the machine pull from that actual data. On top of that, we did compliance by setting exactly where it came from. So you can actually click on the link and say, this is where the actual data came from. And as a compliant guy, we put a timestamp on it. That's how old I am. We made timestamps. So we were already FINRA regulated from the day get-go. We wanted to make sure that was covered.
Gotcha. You should use Benzinga newsfeed as one of your sources.
Let's talk, Andrew.
Sarah, so I kind of want to tie it together for the audience, and frankly, we might use you guys too. So, so I understand the power of scraping and producing these data sets. How are you integrating AI, and how are you talked about ensuring that it's compliant and trustworthy? But I'd love to hear how functionally you're using AI.
Yeah, so again, we're obsessed with trust. We don't trust that the AI is always going to get it right. And we have been using AI for long before ChatGPT came out. We basically, will wrap commands around the AI. So whether it's language translation or keyword extraction or whatever it is that we're using, if it's LLMs in particular, we will probably ask the same question multiple different ways. And we will also generate sort of the oracle, the system of truth, for any model updates, right? So we're very careful when we're creating intelligent agents. We're basically making, an entire deployment life cycle around them to make sure that every new version of that model that comes out is tested and proven that it is actually working to the same level of quality on similar data. And then we have all of this data validation success criteria that we wrap around it to make sure that it's getting the right answers. So we in our own way, even though our tagline is trust in data, we're sort of don't trust, and that's sort of our default position. And we spend a lot of time when we're building intelligent agents on our platform to make sure that we are really, really assessing that output. But yeah, we're using everything. We're using LLMs. We're using all kinds of AI services from different companies, and we're really, really appreciating the incredible strides that we're able to integrate into our platform from AI.
Totally. It sounds like everybody's using AI in a certain way, and people are saying you either use it or you're going to fail. I guess.
And Andrew, one of the things about AI in general is that we're going the next level of AI agents, right? So that's where the machine makes its own decisions. And we're going to have AI agents talking to AI agents. So if there's any non-trust anywhere in the system, it's going to completely break down, right? So you've set this AI agent to buy Apple stock at 223 and to sell it at 225, and this AI agent is talking to this AI agent and saying, okay, but I also want to buy the options behind it, but this is the wrong data. And then all of a sudden, then it starts buying. This is a
I
massive
still
problem.
laugh at the story of the Facebook chatbots that started speaking their own language.
Google and Alexa going at each other. Yeah.
That's funny. No, for sure. All right, so we have 5 minutes left. Why don't we just do 1 minute each? Talk about, as it was supposed to be about data and tech, and we talked a lot about AI. Let's talk about what we're most excited about, a new feature on our platform, a new technology that we've integrated. We'll just go down the line. Is that cool? You want to start?
Okay, so I'm most excited with our new web widget library that our dev team introduced. So they build a widget in a couple of days, like production ready. And since they're using the same API layer, it doesn't cost them anything to just invent new widgets and build them. So this is what I'm still like walking around and thinking, why did it take so long to get into it? Finally, we're there.
Yeah, I think that most brokers that are coming out, you know, in the first question are all trying to be mobile facing, like as the foundation of their business. And one thing that I'm excited about that we've rolled out at Lightspeed, actually went live last month, is a product called Lightspeed Connect. So we now offer API trading at Lightspeed. And it really, although we understand that trading is difficult, you know, a lot of these larger broker dealers actually really underestimate how sophisticated retail traders can be and the tools that they can utilize and how much data they're willing to ingest and the strategies they're willing to implement. And so now through Lightspeed Connect, you have to have a very limited development background and you can automate your trading strategies. So now it's not mobile facing, it's not desktop facing. You can go to work, go about your day, and your trading strategies are working for you. You can back test them. And also, it gives us the ability to work with some of the amazing fintech partners that you see out there today to be able to plug into their UI, but execute trades to Lightspeed's brokerage firm through the back end. So we're meeting clients exactly where they're at on technology they're comfortable using.
And limiting me to one thing, Andrew, is kind of tough because we have a lot of cool things. I think the first thing that we're really excited about is the education platform that we put on. I love my education at Benzinga. We helped build that. And I'll tell you that I think that's the biggest key to retail traders today is actually learning about what's really going on. The second thing for me, obviously, is being able to translate it in every language on the planet. We're at 42 now. We should be all 92 in the next week or two. And not using Google Translate, where I actually have all the back engines on the backside, and the machines actually translate based on what country you're in. So if you're in Saudi Arabia, the machine automatically goes from right to left, or if in Japan they don't like the way we like our layouts, it automatically transfers that way too. And I think the coolest thing for me, and we've already built out as well, is the AR VR side of things. Because I think in the future we're not going to be using our cell phones. We're already doing this nowadays. It's the next level of this. So I have an Oculus, I have an Apple Vision Pro, I've got all the fun toys, but that's how we're going to trade in the future. Because I've been doing this a long time, and I can tell you, I got 24 screens around my office. You ever seen it? And I'll tell you, we're going to get rid of all of those. We're going to be having wearables, glasses. We're going to have our watches, and that's how we're going to trade in the future. And we've already built that side of it already. It's like Minority Report. I can literally move one screen to another one, or modules around. We'll put Lightspeed in the system, and we'll have traders over here, and we'll have trading view and charts. It already works already. So if you want to, anybody wants to go to Quasar Markets, go ahead and play around and mess it up for me. I appreciate that.
We are also equally excited about all of these things. So our platform, we just released in the cloud. It's pay as you go. We have democratized access to data and AI. You are able to create intelligent agents now with very little upfront investment in time or installation or IT staff or whatever it is that's blocking you from getting started. It's a low-code platform, and we are incredibly excited to participate in this new revolution, whether it's powering wearables or whatever it is. We have a lot of startups building on our platform, and we look forward to seeing all of the use cases that come out and harness this bright future.
Agreed. Thank you all for your time. This was fun, and I hope you guys learned something. Come say hi and ask questions afterwards, but I appreciate you all, and enjoy the event.
Thanks, Andrew.
Thank you.
Thank you.
Let's give it up. Thank you. Thank you so much. Sarah, great to see you. Steve, Evan, Vitali, thank you so much. And my friends, one more round of applause for Andrew Levos. Thank you. Appreciate it, brother. All right, next up, Bridging Divides, Connecting Wall Street with Main Street. Great panel we have for you. Moderating is Brandis DeSimone, VP and Head of America's Data Sales at NASDAQ. We also have Sam Knopfzinger, a GM at Public, Dan Pipitone, CEO and co-founder at TradeZero, Yoshi Yokokawa, co-founder and CEO of Alpaca, and Eric Kruger, CEO of the Americas at GTN. Let's give it up for this next panel, please. Thank you. Thank you, thank you. Have a great session.
Well, hello. How are we all feeling? It's that time.
A little hot.
We need to do
A little hot in
like
here.
a stretch. Isn't this when you're supposed to do like a 7th inning stretch at this time? Is that what we're gonna do? Thanks for joining us. The topic that we're gonna talk about a little bit today is mainly focused on retail, but I feel really lucky because I feel like I'm out with my friends. I've known a lot of these guys for a long, long time now, and it's really fun to be on stage with them talking about something that's really near and dear to NASDAQ's heart. You know, we run the matching engines that trade, a significant amount of the equity markets in the US. And, we can see it firsthand that trading has significantly changed over the course of the last decade. And where the majority of the markets were really playing in the institutional space, we've now seen a huge transformation in retail becoming about half of the US equity volume through the exchanges. So retail is here to stay. I think we've learned that through the past couple of panels. We've talked about this a bit. But we at NASDAQ are seeing it firsthand through the actual engines themselves. Retail is here. It's half the market. It is a huge participant, and it has the power to really actually sway the market at this point. And that's what we're going to talk about today. So to do something a little bit different, I'm going to ask that each of the panelists actually introduce themselves, what they do, where they came from, very briefly, starting with Sam.
Sure. GM of brokerage and crypto at public.com. We're a investing platform where you can invest in all types of different assets, whether it's stocks, bonds, options, crypto, ETFs, all sorts of stuff. I was at SoFi for a while before then, so spent about a decade in the retail space, and definitely a lot has changed. So looking forward to chatting about it.
I'm Dan Pipitone, CEO and co-founder of TradeZero Holding Corp. I have been in the active trading space pretty much my whole professional career. Started a firm called Noble Trading in '99 and sold it to Lightspeed in 2010. And we launched TradeZero in 2015. We're a multinational broker with presence in US, Canada, and the Bahamas, offering both commission and commission-free access to the US equities and options markets.
Hi, my name is Yoshi, founder, CEO of Alpaca. At Alpaca, we are basically FINRA, SEC, DTCC member, clearing custody brokerage firm. We currently work with about 200 broker dealers in 35 different countries. Same as Dan, we are multi-licensed companies, licenses in United States, Bahamas, and Japan. So I started my career at Lehman Brothers. So I did all the subprime mortgage-backed securities and asset-backed securities. So I'm excited that a lot of derivatives are coming back to the market. So that's who I am.
Hello, everyone. I'm Eric. I'm CEO of GTN in the Americas. We power 400 retail broker-dealers around the globe with our trading technology, APIs, execution and clearing capabilities. Before joining GTN, I ran the retail trading platform in Denmark for Saxo Bank. I was there for 4 years. And then before that, most of my career was on the institutional side, where I was at Barclays Capital in London for 12 years, and then Merrill Lynch in the US for 10. And it's nice to be here.
Great. Thanks, guys. So I think we're going to continue with your careers. You started off on Wall Street, and now we've moved to Main Street. And that's the topic of this panel today. So, when we were chatting a bit, the four of us on Friday afternoon about all this, Eric had some really interesting sentiments to say about what you've seen in that transformation from Wall Street to Main Street. So can you start to share a little bit about that, what you've seen over the course of your career and specifically at GTN?
Yep, sure. It was actually, you know, I haven't been down in this area in a very long time, but I started my career in this complex with Merrill Lynch in 1998. And one of the benefits we received as employees is we received, I'll put it in quotes, discounted stock trading of $100 per trade. So my first trade at a university was I bought $1,000 worth of Microsoft, paid 10% commission on the way in. Luckily, it doubled that year. I quickly sold it, spent all the money in Cancun with my friends. And if you fast forward to today, that same person out of university starting their trading and investing journey, they can buy Microsoft or a fractional share of Microsoft on their mobile device with advanced charts and news and research for free. Or they can build a diversified portfolio of ETFs, through a robo-advisor as well. So I know in this industry, we really like that term democratize. Everybody is sort of democratizing something. I'm sure we have that word on our platform, on our website somewhere. But I think it's true over the past 20 years, trading and investing really has become democratized for Main Street and the end retail investor. And I think that's a great thing. And I think the fact that friction to get started has been removed, paired with a 15-year bull market in the US, as you mentioned, has driven retail volumes to be half of the market. And I think as long as that continues, I think we'll see retail traders to be a very large percentage of the US market. And I think that's good for society. And I think we're happy to be a part of that change.
That's fantastic. Completely agree with all those sentiments. And I think as we've had to kind of transform technology and the way that we serve these retail investors, we've had to build apps a little bit differently because they trade differently than Wall Street does, right? So Sam, can you talk a little bit about what, Public has grown and come to be in this era? So how has that looked for you guys?
Sure. It's definitely, I think, a 24/7 game now. A lot of assets just trade, Monday to Friday, but folks are still, waking up on Saturday and Sunday and wanting something to do, wanting something to look at. And I think without having, a bunch of different ways for them to access the markets, 24/7, whether it's through your app or, through other things that you can provide for them, I think that's, really kind of the goal here. We have, whether it's price alerts, bringing people back to the app, making them stay informed, whether it's using AI to say, not just, hey, what was this earnings announcement, 3 months ago, what's driving the stock this week? What was driving the stock, last week? And having these really, really high touch points and speed to market, I think is, also really important. I think what NASDAQ, really helps us do, a lot is just, everyone wants real-time pricing, right? Even 15 seconds delayed is, not applicable for most of these folks. They grew up with, real-time news, things at their fingertips. They want it now, they want it accurate, and they want to be able to take action, whenever they can. I think another thing that, we're seeing is where do these folks go for their advice, their news? They're not going to CNBC, right? They're not even going to wallstreetjournal.com. They're going to TikTok. They're looking at, their friends. They're looking at influencers. And so, for us, we've actually reached out to a lot of these, these influencers and these influencers because that's where people get their information. And if you're not stepping up and meeting these folks, where they're getting their news, then, they're never going to think about you, at all.
So let's take that one step further. They're getting their news through all these random, possibly untrustworthy sources. And then they come back to your application. So I think I'll toss this either to you, Sam, or Dan. How do you ensure that when they come back to your platform, they're educated and they're making a smart decision?
I think from the educational standpoint, it's working with known and trusted educators to provide sort of, listen, we deal with a lot of sophisticated and active traders, but that's not to say that they know everything. And so by partnering up with educators that are unbiased, that aren't making recommendations specifically, but that are teaching strategies and tips on how to manage risk, most importantly, how to choose stocks based on tried and true criteria, and doing things to get in front of folks that is not construed as advice, but is really educational, leveraging the tools and the access that our platform offers.
I think on the flip side to that, we can't be too paternalistic, right? We can't control what these folks are going to do. We have to let them within, measured guardrails, right, make mistakes because that's the only way people learn. And I think what we've seen over the past 3 to 4 years is really a maturation of the retail sector. They're not just punting Tesla stock and GameStop anymore. Sure, they may have done that a couple of years ago. They lost a little bit of money. Right now, they're buying ETFs. Right now, they're doing some covered call strategies. And so, without having lost a bit of money, having made those mistakes, right, they're not able to learn. And then when they actually have a bit more money and are able to make more responsible decisions, but that's what we're seeing. So sure, you come in 18, 19, 20, and that's admittedly what a lot of kids are doing these days. They have a lot of risky bets, but by the time they're mid 20s and 30s and 40s, they're actually really relatively responsible investors. So I do think it's helpful to, yes, instill guardrails, but allow them to make some mistakes.
One thing we're thinking about in our co-branded white label solutions is how to really personalize that education and deliver it to clients at the right moment when they need it. So if you think about all the trading data we have on the end retail client, we can see what they've traded historically, we can see their current holdings, we can see what's in their watch list, we can see where they go within the platform, right? And based on that activity, we can create a bunch of default personas. And then for each of those personas, create very tailored education and content to deliver to them. So the platform starts becoming much, much more personalized. So like as an example, if my mother was going to become a trader and get dropped into the platform, we shouldn't be feeding her advanced option strategies, right? My mom's not going to do that. I hope not. So we're thinking again on how to tailor that. Another thing to think about is for end retail investors, there tends to be these areas where they tend to trip up, not using limits, not using stop losses, maybe increasing their trade frequency after a loss. These are indicators and things that can be trained and taught. So if we see that behavior in our platform, we want to drive specific education to those retail traders, about how they can trade a bit smarter. It's not just about creating an education area of the platform that's 10 clicks away. It's about delivering that content where and when they need it.
Yeah, I think I'll toss it over to Yoshi now. I mean, as you mentioned in your introduction, you're globally expanding, but you also have to expand products as well, right? I mean, as the retail base is becoming smarter, more sophisticated, they want more sophisticated products to trade. They want to go to different countries and trade them. So can you talk a little bit about how you've had to pivot and grow?
I think thinking about this Wall Street and the Main Street and the rise of the the Main Street and retails are coming up. I think it's really comes down, in my opinion, is really the cost, because the cost is, if you think about the one account lifetime value of the customer of the Wall Street is really high. So you can pay a lot of money to acquire customers. Hence, everyone's doing top down sales. And in order to make this Main Street customers to make sense, lifetime value of the customer is super low, which means that you can't really pay for to acquire those customers, and you can't really pay for maintain those customers, which means you need to have all the operating costs to be super, super low. And in order to do that, you can't be relying on the other technology vendors, which means you have to be really internalizing everything you do, so that you can actually provide this super low cost customer acquisition cost. Hence, you can get a lot of users. That's a very, very low LTV. And thinking about those things, right? Going global, we work with 35 different countries. The wallet size is super small. For example, clients in Indonesia or even Nigeria, super small. But how we make the business make sense out of it is we push our basically unit economics really low. Of course, our OpEx has to be very, very low. But I think that's really the key. And then the only way to do that is really to internalize, create new technology and system infrastructure that can cut down all the unnecessary costs. And so that's something that we've been always focusing on in terms of product enhancements, because I think our job is to be an infrastructure. We're API first company, so it's all about which modules can be used separately by whoever the companies want to use it. So in order to do that, we have to make sure that each component of those details are well flexibly available by any companies who want to use it. So that's how I guess we focus about product enhancements.
All right, let's make this a little bit fun. They don't know this is coming, so we'll surprise everybody. We'll start with Sam. We're gonna do 2 rounds. First question, 1 answer per person, so we'll go fast. What's the one asset class that you find to be so interesting you either are adding it now or you want to add it to your platform? What's the dream?
We've got most things, but one of our newest asset classes to add to the platform is fixed income. And I think fixed income is one of the obviously largest asset classes in the world, right? Bigger than the stock market. You can't find it in most retail apps, right? It's really easy, right? You go to Times Square. You ask 9 out of 10 people, hey, buy a Tesla. They open up their app. 2 seconds later, right? $5 a Tesla. You ask someone on same thing on Times Square, hey, can you open up your phone and buy a treasury bill? You're going to get blank stares, right? 99 out of 100 times. And I think that is finally changing as interest rates start to become more attractive. I think over the past couple of years, we've had the cash wars. Finally, retail I think understands what a treasury bill is. I think we finally come up that curve a little bit. But access to this huge part of the market, I think, is still remiss for a lot of folks. And I think that fixed income is a very compelling asset for essentially anybody, whether you're 25 and looking for some place to put your money aside from your bank, or whether you're 35 and you're looking to have a diversified portfolio, or you're closer to retirement age and looking to create your own kind of portfolio of fixed income instruments. And so I think we're in the early days of fixed income, and I really hope in 5 years we go to Times Square and everyone can buy a T-bill within 5 seconds. But it's certainly not quite there yet.
Dan, what are your users asking for?
So we do equities and options currently. Futures for us is just the next natural progression. From a retail perspective, from a Main Street perspective, I think it offers a lot of it's a product that can really speak to retail. You have the exchanges who've created first the minis and now the micro products that are real specifically geared towards the retail trader. But not only that, as we talk about international, they trade 24 hours a day, and for us, especially here in the U.S., actually, there is for people who want to trade actively, there is no governors around like pattern day trading rules and such, where with fairly low account balances, people can really participate in a meaningful way in the mini micro products on the future side. So it's something that we're really excited about for next year.
Yeah, I think from our side, creating yield generating products continue to be super important. That can be like FDIC sweep, money market sweep, even fixed income. But I think I actually had one question that I wanted to ask to Sam, the public, because I see that you start offering the corporate bonds, right? Triple B grade. Of course, it sets up 7% to 8%. I come from Lehman fixed income, so I feel this journey of how it came from treasuries and corporates and securitization, down the low, and then thinking about this Main Street and Wall Street. Is that Main Street really ready to have exposure to that risk assets? Even the Wall Street, triple B bonds is pretty risky, right? What do you think about that public forum? Sorry, is this funny? I just wanted to.
No, totally.
I thought it was
do it. Let's do it. Let's
right?
go.
We have a cryptocurrency you can buy called Bonk.
Yeah, but the bonds is yield generating, right? So that's what I think about, because it's fixed income.
It's a fair question.
Principle.
And I think if you look at the suite of products that we've launched, the first one was Treasury bills, right? AAA rated, guaranteed by the government. Second one was FDIC insured, right? High yield cash account. What else can you offer, right? In the AAA rated, how many more cash products do you need? And so I think what we decided was, hey, retail still doesn't really understand bonds that much, right? Triple B bonds and right are still pretty safe, right? 2 to 3%, default rates. 70 to 90% recovery.
That's what
rates.
we thought about at Lehman Brothers. So
listen, if we go back to 08, I think we're all in a bit of trouble.
I was just talking about this because I thought it was a fun topic to talk about. I wonder
it's a great
what
topic.
everyone
I think that's
thinks
just
about
part of the education, right? And I think that's why on our platform we try and educate you. Hey, here are the different options, and here are the different risks, for these different options. And obviously, this one has a risk of default, has a higher interest rate risk, and things like that. And I think that's where the education comes into play. And what we found is people like to diversify their yield, and so they don't just pick one of these 3 products, right? They have a bunch of money in their high yield cash account. They got some money in the treasury bill product, and they've got a smaller portion, in this kind of boosted yield product as well. But I think really it's about offering solutions to retail investors that they might not know even exist.
So, sorry, I'm probably going to come back to you on this, so apologies. But the way I think about this is we already offer pretty much every asset class. So for us, it's not about offering a new asset class. But I think what it really boils down to is taking the existing asset classes and somehow making them more digestible and consumable for the end retail client, right? And I sort of am passionate about this space, so I play around with everybody's platforms, and I played around with Public as one of them. And when I saw, I think their product on this bond account is a great example, right? Because bonds are pretty boring, right? But to the end retail client, now that it's become fashionable again with interest rates going up, if you just drop them into like a bond filter and say, hey, go pick your bonds from this list of 600 with different yields and different yields to maturities, they get analysis paralysis. It's confusing. And I think what Public did well is they took a pretty boring product, packaged it very well, made it very easy to understand for the end retail client. You can have debates what level of bonds is, if you have triple Bs or not. But I think it's a great example of, I think, where this industry will continue to push towards. It's about taking existing products, like what people did with equities and fractionalizing them, or bonds and fractionalizing them, and making those legacy products more easy to understand and digest for the end retail client. And I think that trend continues.
Yeah, just to prove that point, we'd had bonds on the platform for 8 months before we launched the bond account. You could have bought all these bonds on your own. We had very, very little uptake, right? Bonds are complicated. You go there, there's a bunch of different numbers on there, a bunch of math, bunch of yields. What is this? I don't know. I don't understand it. Let me go away. When we launched the bond account, the first day we launched it, we had 8% of all bond trades in the United States on that very first day, right? So just putting these into a slightly more understandable structure, saying, hey, don't worry about buying and selling bonds. Worry about depositing and earning yield, right? That's something people understand. They don't wake up every day and say, hey, let me go buy some bonds. They wake up every day and say, hey, how do I find the most attractive yield out there for myself? And so I think it's not just offering the underlying asset classes, but providing the solutions with those asset classes that really I think is kind of the next level of retail investing. So it's kind of this semi-homemade approach to it. They're still not going to Morgan Stanley, right? They're still not paying 2%, right? Like their parents and their grandparents did. But they might want a little help, right? They might want that semi-homemade approach, not just those bare assets, underneath. Let me build myself, but let me build a set of solutions that achieve my overall goals.
We're going to leave it there with the bonds. You sure?
I just think, as I said, I think that trend of innovating. Again, if you're running a retail platform today, can you really compete on price? No, price has gone to zero everywhere. Are you going to compete on offering a new asset class? Probably not. Everybody roughly offers the same things. To gain share and to stand out in a very crowded and competitive market, it's going to have to be about product innovation, right? And it's one of the benefits, I think, for Main Street is all these providers looking to gain an edge, looking to gain market share. It's going to continue to create new products that will help that end retail investor.
I think when we think about innovation, we have to always think about the history as well, right? Because when you start pushing, which means we're wanting more yield, we want more products, that becomes basically pushing the limits, and that what happens the bust cycle, boom and bust cycle is basically that. So I think of course, Sam, I completely understand. I just threw the question because I thought it was interesting. But I believe what you're doing is super interesting and cool. But at the same time, I always ask myself, because we are the ones who's building the product sets, so that all those different providers will be able to do those asset classes. How much of the push should we be doing to these Main Street investors? Because if we are to start pushing so much, the thing that we've seen even at the crypto sector could happen into this more traditional sector. I think that's a real risk that to me I always think about, because I think we are really we have to be responsible as a custodian and settlement, and then of course it comes from my experience as well, how price dropped from the AAA to double B in 20 days, right? And Lehman collapsed. So I did see everything, went through that, so it's real to me. So that's how I kind of think about it, how much of the risk taking that we should be pushing in the Main Street.
Well, it's part of the job, though, right? Is we have to balance innovation.
Yes, exactly.
with
That's why
risk, and
I
that's
think about that a lot.
why we're
Yeah.
sitting here today. It's the best part of the job. All right, let's move out. Let's talk about Main Street for a moment. Where is Main Street? Is it in Springfield?
I
So,
think
so okay. If Main Street is Springfield in the U.S., wherever Springfield may be, where is Main Street next? So, Dan, where are we going to find the next Main Street out of the United States in order to start to really continue to tackle retail investing globally? Where is the next Main Street?
typically, I think we do think about places like Springfield or the South or the Midwest or even the West Coast. Folks that are not around the financial hubs of the United States. But for us, we've seen really that Main Street has kind of expanded beyond the borders. And I think folks outside of the country, Canada, Europe, Asia, really have a thirst and desire for accessing our capital markets. In my opinion, it's the gold standard. And with retail investing, I think a big part of the growth that we've seen in retail investing is not just happening here. It's folks outside of the country wanting to trade Tesla, wanting to participate with NVIDIA, and those companies that they've become very familiar and accustomed to interacting with on a daily basis, and being able to invest in those in an easy and approachable platform. So I think Main Street is really, the definition for us has expanded sort of beyond our borders in a real meaningful way.
Anyone else want to comment on where Main Street is now? I know, Eric, you gave us a great stat on Friday about your global investment.
So, one of our differentiators at GTN is, we offer access to 90 equity markets globally, pretty much every asset class. And as a result of that, we engage with about 400 retail broker dealers around the globe. If I was going to pull them to the side and double click on their volumes, even though they're based abroad, probably 90% of the trading volume is into the US market. So the typical user pattern is that foreign retail investor, yes, he wants to buy a few local names in his local currency, but just as you mentioned, he wants to own Apple, Amazon, Netflix, Tesla, etc. And I think as long as US continues to have this outperformance that it's had for the past 15 years, right? If you line up EFA or EM against the S&P, the S&P has destroyed international markets. And as a result of that, it's caused a large sucking sound of foreign capital into the US. So I think as long as the US continues to outperform international markets and we don't have a reversion to the mean, I think we'll continue to see a massive inflow of foreign retail investors into the US market.
Yeah, we deal with the similar kind of stats as well. Like we work with basically the Robinhood, I would use the word, but like copycat in country A, country B, country C, country D, and then they offer US stocks and then local asset classes. And then of course, a lot of them go to the US, because of the obvious reason. And I think it's going to continue.
The other thing I would say to that is that retail is not dumb money anymore, right? I think and one of the things they've done very, very well is not follow Fama French, right? They're not investing in small cap value stocks. They have been the ones investing in big growth companies, and those have certainly outperformed. And so I think put a lot of retail investors up against any active managers, and they wouldn't do too shoddy, especially if you add their crypto holdings in it as well. So I think it's just another I think a lot of folks that aren't from this space still kind of see retail as this big one big dumb group. But it's, I think, far from that, and there's a lot of sophistication in this, and those folks are looking for 24/7 trading, looking for sophisticated tools. They're looking for as fast to market as possible. And really, I think we're building towards them, and institution is now copying resale as opposed to the other way around.
So we are literally at time. We had all these aspirations of talking about 22/5 trading and AI and post-election sentiment, and that's not going to happen today. But I want to thank you guys. I mean, at NASDAQ, we are the home of the corporate listing. And what matters is that investors, are able to fuel capital into these corporates so they can create jobs and create the technology and innovation that we rely on today. And it's folks like you that are helping us do that by keeping retail invested and continuing to innovate, but also protect the investor. So we are very grateful for everything that you're doing and the responsibility on your shoulders and the activity in the market today. So thanks everyone.
Thank you, guys.
Thank you. Thank you. And thank you. Let's give it up for our panelists. Thank you very much, my friends. We will keep this thing rolling right along. Thank you. Brandis, great job. Thanks so much. Thank you. All right, next up, from pitch to payday, a blueprint for securing funding. Moderating this session, we've got Jared Fink, CEO of Cosmic Wire. We've got Pierce Crosby, GM at TradingView and founder of Merchant 7. Johnson Yang, partner at General Catalyst. Ethan Austin, founding partner at Outside VC. And Adam Nash, co-founder and CEO of Daffy. Come on out, panelists. Let's give them a round of applause, please. Thank you.
All right. Hello, everybody. My name is Jared Fink. Welcome to this panel from Pitch to Payday. And thank you, Benzinga, for hosting this. I'm the founder of Cosmic Wire. I personally have gone through the entire process of raising a company from nothing that I was bootstrapping. I'm going to go through some introductions here and then share a little bit of my backstory and get into some questions. But I'm just going to pass it down and do some intros, and then we can dive right in. So you want to go ahead, Pierce?
Sure. Hi, guys. So I'm Pierce. I'm general manager for TradingView. As was mentioned, I didn't realize, also the founder of Merchant 7. We've definitely gone through a cycle at TradingView, for those who don't know, now a $4 billion company. But when I joined, we were about an $80 million company. So it's definitely been a wild ride, and happy to talk about that. And then before that, working at StockTwits, obviously a very different trajectory, still a fantastic business and kind of a value play for the long term.
Hi, everybody. This is Johnson Yang. I am a career venture investor for the last 8 years. In my first job at Insight Partners earlier in my career, I had the good fortune of investing in Pierce's company. In the last 5 years, I've been on the team at General Catalyst, based in New York, where I lead a lot of our fintech investments. I'm so excited to be here.
I'm Ethan Austin. I'm the founding partner of a small fintech firm called Outside VC. Before that, I ran Techstars programs for a number of years, launched Techstars LA. Before that, I was a founder, probably pitched and got rejected by General Catalyst at some point, but have gone through fundraisers that were good, bad, and ugly. Have seen all sides of it. So,
Adam Nash. I'm the co-founder and CEO of Daffy, which is a modern platform for giving. A lot of people know me from previous roles as well. I was head of product at LinkedIn through the IPO. I was the CEO of Wealthfront for a number of years, and I've worked at a number of other companies, etc. Also, a very active angel investor in about 140 different companies. Did some brief tours in venture capital at firms like Atlas Venture and Greylock Partners. And in my spare time, I teach a class on personal finance at Stanford.
Thanks. And my name is Jared Fink. I've been in the entertainment industry for the last 20 years or so at all the different labels, Sony, Warner, Universal, as a ghostwriter, an artist, and a producer, and then heavily on the other side with publishing, licensing, and sync. So really focusing on IP management, trademark, copyright law, PRO systems, collection. My tech background, I started in early 2000. I was at Nokia down in Mountain View and a bunch of other companies, as we all were if you were down there at that time. A lot of sys engineering, SAP, Intuit, things like that. And then in between there, I was going to med school. I was actually in my residency program when I got my record deal. So I've always been kind of floating the line between entertainment and tech, being very versed. And I architected all of the technology that was inside of the company I built, which was a result of my entire entertainment career being turned off like a light switch during COVID, which anyone that was in the music industry felt. And so this panel for me is a very personal one because I've lived through it. This was the first time I ever tried to raise money. We raised $30 million last summer at a pre-money valuation of 125 for a company that was pre-revenue. So it was a momentous effort with basically putting myself into a meat grinder, as I'm sure you guys know. And now we just secured our Seed Plus round at a $250 million valuation. And things have been moving progressively, but this was undoubtedly the biggest learning experience of my life. And I think I'll start with you, Pierce, with the first question here. And this one specifically was something that took me a while to get. But there are technical founders and there are visionary founders, but usually they are not the same person. And when I was trying to describe, everything that we had built, which was another interesting approach because we had patented and built all of our tech before we even went out to raise, because I thought that was how you should do this. Which apparently I didn't realize that tech's a roadmap world. But I'd love to hear the difference between the storytelling aspect of the founder versus the technical acumen that backs up the technology.
Yeah, we can't have one without the other. And oftentimes people think you can have just one. But without a good story, it doesn't matter how fantastic your tech is. So the backstory, I'm not a founder of TradingView, but basically came on board as kind of the overall, voice, vision, and kind of brand to kind of make TradingView more of a household name. The founders are technical and honestly some of the most brilliant technicians I think I've ever seen, and have managed to build a company of 900 people strong, kind of spread across the world. What's really interesting is that even though they had such a fantastic asset and obviously some existing investors, it was very challenging to move them out of kind of like a first gear, second gear, and to really get it humming into kind of this brand vision and story. And so we really did spend a lot of time thinking about kind of, we're not just a product for like chartists or chart folks, but actually a product for everyday investors and honestly pretty much everybody who has any money invested. And that kind of small switch but important switch basically really ginned up a much different audience from an investor standpoint. Whereas previously people thought we were just a very small kind of technical product and for very like nerdy technicians. All of a sudden it's like, oh, this is like a very advanced version of Robinhood. And that kind of simple switch all of a sudden changed everybody's mindset around, like, obviously everybody had seen the Robinhood story. And so it was very easy for them to kind of key into these other macros that were happening in kind of the larger environment. And that just kind of backed into the fact that in 2021, we had a meme stock mania. Robinhood's multiples went up, tenfold, if not 20-fold. And all of a sudden, everybody's looking at TradingView thinking like, okay, well, if Robinhood has gone up as much as this, and these guys are actually building all the technology that folks like Robinhood are using in the market, what does that say about them from a story perspective? We successfully then went out and raised $300 million from Tiger, Head of Sophia, and some other folks. And really, it's just a simple narrative shift. We really didn't do anything more than we'd already really built. But as soon as people started to realize the scale of that, it was a totally different ballgame. So it was a really fantastic experience, but super, super important to have both story as well as technical, for sure.
And I like how you talked about keeping things simple, because that was another lesson that we learned from crafting, 110-page decks down to 6-page decks. And we started referring it to as the in and out model, where you have two things on the menu. And so, Ethan, I'd like to talk to you about, crafting the deck, what you think needs to be in the deck, how much that DNA of like the expertise of the people that are surrounding the founder matters, with the vision, what needs to be in that deck, and what are you looking for?
I always tell people to keep the decks as short as possible. I mean, at least the teaser deck that you're sending along, you're assuming someone's going to be reading that in an Uber on their phone. And if you look at DocSend, they're probably spending 1 minute, 27 seconds on it, if you're lucky. So a lot of people design a deck thinking someone will read it for 10 minutes and there's enough information that's in it for 10 minutes. I say design a deck that's really designed for 1 minute 27. So keep it to the shortest points possible. And I always say drop the sexiest things you have. Everyone thinks you have to have this standard deck template that, Sequoia came up with 10 years ago. And there's a lot of slides in there that don't speak to your strong suits. And so people put them in because they think that's the template they need to use. I say just put in the 5 points that are like your sexiest points. And if someone's interested, they'll take the meeting. I usually say the shorter, the better, with whether that's a deck, whether that's an intro. So I don't think there's a standard template. It's what is the material you're working with, and use that material to craft your story. And if every point is like, oh, wow, it gets better and better and better, and each one progresses, and they're done in 1 minute and 27 seconds, that's the good deck for you. There's no universal good deck, in my opinion. It's just, what is the thing that's going to grab someone's attention really quick? And don't be afraid to name drop. Investors they're not looking to understand every single thing about your business. in your company from the minute 27 they're going to look at it. Include all the heuristics and kind of lame things that feel kind of lame to oh, I went to Harvard Business School. Drop that. Anything that's kind of going to get someone's attention, put that in the deck. It's just to get the first meeting. Then sell them on your story. Sell them on the why. Sell them on why you're doing this and your origin story and everything else once you have the 45 minutes to an hour to do that. But if you have a minute 27, just put the sexy stuff in.
Yeah, that was a hard lesson from all the failed decks. I have drives of failed decks, and part of that came too from, I think, the people that you're surrounding yourself with. Like as a startup, and if you're in this kind of like beginning stage, it is absolutely one of the most trying things that you'll ever go through. Every day is basically a litany of failures that you're navigating, trying to find a way through, and that's really what kind of builds that core team DNA. And with that, I felt, and I started leaning heavily on getting in, supporters and advocates from the outside that could come in and understand the vision, that had that kind of reputable relationship in the space already, so people would pay more attention, because it's a new thing to go and try to convince someone about a new technology, but it's an entirely different thing to also be introducing yourself with a new technology, with a new idea that is just hard to equate to unless you have something analogous that you can relate to. So Johnson, I was curious from your vantage point, especially with like Series A and you're doing later stage funding, like how important is it that those founder kind of regimen or people in that original iteration are still there, or if they're dropping off, or when you're seeing kind of the new crop come in or fall out from that startup land?
Yeah, there's not really any hard and fast rules. I would take a step back and simplify my investment framework, which is investments is about one, understanding the company fundamentals, the financials and the metrics, but then two, understanding the narrative of that founder and that company in the market and what they're planning to do with it. The reality is like at the earliest stages of investing, companies have no financial or data fundamentals or very little. So it's all about the drive of the founder, why that person, he or she, is uniquely suited to solve this huge problem and eventually sort of own a market or create a market. We do see circumstances as companies get older where the founder who started the company is not the right person to go the next 5 years. And, there's positive and negative sort of reactions to that from investors. But I think at the end of the day, at the earliest stage, it's all about founders. And then the later and later you get closer to a potential IPO, the fundamentals start to be more scrutinized. And you're sort of asking, does this company have the right team around the ship to guide them into maybe the public markets or into a position where they'll sustain for the next decade plus? And so there's typical VC speak. There's no simple answer. It depends. There's nuance, but I think that's the truth.
That's probably the most honest answer I've ever heard about this. And I heard that, we're I don't know, 3 or 4 board meetings now past kind of our initial investment, and it was all of our first investors. The most important thing that I heard from them is, we're investing in you, the founder, the CEO. That's the vision, because you don't have any technicals, and there is no EBITDA, right? There's nothing there.
We've even made investments at General Catalyst where sometimes we see a deck with a founder and we're like, I don't even know if that idea in that market makes a ton of sense, but I will have a huge FOMO in the future if I let that founder go without finding a way to partner with them. And so I think at the earliest stages, there's fancy decks, there's fancy business schools, things like that. But at the end of the day, when you as a founder have that 30 minutes with an investor, it's your job to create the most insane sense of FOMO you ever can and make sure that they leave that meeting thinking, oh my gosh, could I be missing out on the next X, Y, or Z huge company?
Yeah, I think that's a lot of it. Adam, I wanted to jump into you next. We're at Cosmic heavily into fintech, and I think we're all navigating, especially in Web3, which we all are in some capacity here, navigating a really interesting time in the world with the SEC basically saying that everything we're doing is illegal, to just navigating how commerce is going to happen, decentralized economies, decentralized tokenomics, all the things that we're living through right now. I was really digging into Daffy and what you've been doing along those lines, and I'm curious about how you weigh the social responsibility in fintech against the philanthropy and outreach that you're doing at Daffy, and how you're marrying those two things and kind of leading the ethos forward.
Yeah, well, it's a good question. So I just have to say, Johnson, your answer most founders make this mistake of thinking that venture capitalists invest out of greed because they see this huge opportunity. Fear is actually the better driver to get that term sheet, and it's always fear of another investor getting that deal. But no, when it comes to Daffy, I mean, I've always believed in mission-driven organizations. I don't think I ever joined a company where I didn't believe in the mission. Like at eBay, it wasn't about technology or just marketplaces. It was about millions of people being able to make an extra few $100s a month and how much that could change people's lives. At LinkedIn, it was giving people control in the modern economy over, you know, their reputation and their relationships, two of the most important things that we all have. And of course, at Wealthfront, it was about democratizing access to sophisticated financial advice. Most people don't have enough money to get the best financial advisors, but if we could put it into software, then everyone could have access to it. And so for me, Daffy is no different. We have a really simple mission, right? It's to help people be more generous more often. And true to my background, it's grounded in research, right? It turns out there's actual research that says if people put money aside, if you set a goal for your giving, you end up giving 32% more. I mean, in the US, that's more than $500 billion. I think it was 557 billion in 2022. Money given to charity just in the US. So it's a huge market as a percent of GDP, et cetera. But to me, the exciting thing was actually making it bigger, right? What if we gave 32% more? That could be trillions over the next decade. And so when you're building a team, I mean, in Silicon Valley, it's so competitive, right? Those great engineers could work for any hotness, right? I mean, you've got AI booming, you've got, you know, deep tech. There's so many fun things for engineers to work on, talented designers. And so for me, it's a little bit hiring people at your company. I've always said that getting an investor is a hiring decision in some ways. You're looking for people who are in sync with the business you're trying to build, who believe in the vision, and actually those are the risks they want to take. And so with Daffy, I think the reason we were able to raise, at least so far, we're still very early. We've done 2 rounds, but we've done a good job both internally aligning the mission with the type of people who say, you know what, I'm a brilliant technologist, I'm a brilliant designer, I'm a brilliant investor. This is actually the platform I want to build. I want to see this in the world, and I think it could make a big difference. And I think as a founder, you have to find a way to get that story tight, and not be afraid with the fact that most people won't want to go on that journey with you, because most people have other journeys they're going to go on.
I mean, that's probably one of the most important lessons I think I went through too, is as a founder, you basically live in a sea of no's, and it's really easy to start taking that personally, or they're attacking your company. And the truth that everyone has to understand is everyone's living their own life, and most of the stuff that's going on with a lot of the VCs or investors has nothing to do with you. There's all kinds of anecdotal things that are driving their mission statement, or for the most part, they're not even interested in investing in that field. It really kind of changed the dynamic of how I was approaching things, from the shotgun approach at the start to really honing in and finding like 5 or 6 people that specifically understood that field and not taking things so personally. I do have a question kind of piggybacking off of what you were just talking about. I'll leave this open for the panel here specifically, but you know, with all of the regulatory changes and everything being in flux right now, how are you weighing the risk and reward of doing investments in fintech right now with the landscape of we don't even know what the policies are going to be 6 months from now? How are you protecting your assets or protecting your investments? It's open to the panel.
I'm so early in my like angel career. Like Adam's such a legend in this, but like, so I really don't know this regime, if you will, versus maybe a previous one. We go through a lot of cycles. So this is definitely like the early stage of my like learning trajectory on like the fintech investing cycle. I think the biggest thing for me is just risk management, and frankly, putting one huge check in one company is just not a recipe that is long term. So smaller check size is definitely kind of my overall motto. And then I think you know, embedding in companies that you can be very, very close to is crucial. Knowing full well that, you know, I work at TradingView, I obviously have a seat where I have like a lot of advantage to this very specific world. And so definitely not like investing outside of that lens, because as soon as I do, I get burned so badly. Like I have no idea how many times my friends like, oh yeah, I have like this new DApp project that like is using like AI as well as like Internet of Things, and like, trading. There's literally like there's a whole meme stock world in the crypto side of things, and I literally get my face ripped off every time I step in there. So no, I think in general, just risk size and kind of moving that down further.
Yeah, I think as an angel, I mean, there's different types of investor, and I think the most important thing for an investor, and this is going to sound difficult because egos are famous in the investing world, but you have to have a degree of humility about what you know and what you don't know, and what type of businesses and what type of strategies you're excellent at or excellent at understanding, and ones that you can. For me, regulatory is hard to predict, right? And I've seen this through my entire career, that there are some great ideas that fail because they hit the wrong environment at the wrong time. It could be regulatory, could be interest rates, it could be the markets. Some of the best Web 2.0 and mobile ideas were things that actually blew up in Web 1.0 because we didn't know all the things at the time and the market shifted. For me personally, I accept that as an angel investor because I know that most companies won't work for one reason or another. But I invest very early, right? It tends to be pre-seed, seed stage, etc. For me, given my background, what I tend to look at is both the technology and then the distribution. The answer for me always has to be there's something that was very expensive and hard to do that's now very inexpensive, almost free, and can scale. And then second, there has to be some new way to reach the customer. There has to be some distribution model that didn't really exist before. I mean, Daffy, I will tell you, I couldn't have built Daffy 10 years ago. We are riding on the back of an incredible wave of fintech investment, right? I don't have to worry about payment. I have Stripe. I don't have to worry about KYC and AML. I've got Sardine. I don't have to worry about dealing with crypto. I've got Coinbase. Like if you just go through the platforms that I have, I was able to get Daffy up and running with high quality, with better features than most of the incumbents in just a matter of months. And that wasn't possible before. And then on the distribution side, if we were in a world where people were just buying the next product from the bank that they were already a customer of, it would have been hard. But we have a whole generation now that's been trained to look at the app store, that's actually willing to try out new brands, that is interested in learning and doesn't necessarily assume that just because this firm's been around for 100 years that it has the best product. And that's not everyone, but it's such a big market and growing that you can actually reach them and actually build out new brands and new platforms.
Yeah, that's really interesting. I wonder, to the panel as well, I think the one thing I've noticed too is just how the path to capital has changed, especially recently. I mean, we have like Reg CF, Reg Ds, we have token, we have ledgers, we have SAFs and safes and all these kind of different ways that people are investing now. And there is this FOMO complex that it is just this fear of missing out literally with the token launches and the quick returns and how you can flip these things around. What's the most innovative things that are compelling to you guys as investors right now?
Yeah, I mean, for myself, just to narrow the topic of fintech a little bit more, I think fintech can literally mean insurance or payments or banks or Web 2 or Web 3 or infrastructure. But specifically at General Catalyst, I focus on consumer applications of financial technology. So things like wealth management solutions or new payments or banking rails, things like that. I've actually been focusing mostly internationally outside the United States because I feel like from a consumer use case perspective, the United States is quite competitive and efficient from a market perspective. A lot of the emerging countries around the world, whether it be India, Brazil, Mexico, parts of Africa, where there's emerging middle classes who for the first time have money they can actually put in a bank account, and then they need to figure out how do they save it or how do they invest it, things like that. That's where I see a lot of the consumer application opportunity these days.
For me, when I was a founder, we were backed by a firm called Founder Collective, and this guy Eric Paley was always telling us not to get too far out in front of our skis and really just to be capital efficient. So like for me, it's not so much about the vehicle or the mechanism in which you guys are raising now. It's kind of going back and being old school and just not raising too much capital and using the money that you have. So like the things that look sexy to me, they're interesting to me, are companies that aren't going to be highly dilutive. They're going to raise a couple rounds and maybe they have opportunities for non-dilutive capital. There's equipment finance. We just invested in a composting company that has equipment financing available to them. And like 99% of startups at their stage aren't able to get that type of financing. I called up JP Morgan and they're like, yeah, we're going to finance this. And like, that's great because they don't have to raise additional capital for like this high CapEx that keeps a lot of people away without digging in under the hood and finding out this company is actually going to be relatively capital efficient. And so like the market is looking at this as like very high risk. When I'm looking at it as like not as risky as everyone else. So it's not so much for me the mechanism, but like just being kind of old school and thinking about things from a capital efficiency standpoint.
Yeah, that's really interesting. I know that the non-dilutive thing has really been a focal point, and that seems like a new concept, or at least a center point concept since kind of the pandemic. And we started doing that too with just doing lines of credit or token launches or waterfall tiers out or project based, setting up SPVs for individual projects that people could invest in and out of. But I think the big question that I want to open up as we're kind of rounding to the end here is we're going into 2025. The global economic shifts that we're about to enter into. There is a absolute financial war going on right now around the world, and I'm just wondering how you think that is going to impact where you're investing and how fintech should be structuring for that. I know personally from our company, we've been spending the last 6 months setting up foundations all around the world and moving bits of technology into different pieces just because of how we're going to interact with SWIFT and the SEC and how fintech is going to work across all these different domains as the global powers are shifting in real time. So what do you guys think of that?
Well, I mean, I think this falls a little bit under my previous answer, but I think the good news is when things shift, I actually think that's an advantage for new companies and new platforms, right? At previous companies, I'd always get asked this question about what happens if they pass these new regulations. I get this at Daffy too. There's always a bill out there that could change it, the regulations. And if you're going international, even a bigger deal. But if you're a small company, you have a modern technology platform, you can actually adapt to those changes faster than the incumbents can. The incumbents have business lines, they have organizations, they have people all dedicated to that. And so never forget that as a founder at a company, your ability to move fast actually can be advantageous when the world is shifting quite a bit. Then again, I will also caution founders that sometimes they're so focused on that next change or what happens there that they trip over their own feet, right? You rarely have enough capital to go more than 18, maybe 24 months. The bar for building a venture class company keeps going up, right? The days even like 5-10 years ago where people said, oh, you have to be able to get to be a unicorn, $1 billion, 100 million in revenue. That's not the bar anymore in the public markets. A lot of venture capitalists I talk to are thinking about companies 3 billion, 5 billion. I've even heard 10 billion. And if you are not building a platform or a company that can reach that scale, that actually might mean that venture capital isn't the right path for you to finance your business. And the reason I bring this up is because I see in this stressed financing market, I see people reaching around the world for financing, right? Different pools of capital, different ways of funding things. And some of that is regulatory. Some of that has to do with this financial war, different people wanting to get into different things. But you have to be careful, once again, when you raise money, it is a hiring decision, right? Like one of the things you get from traditional Silicon Valley style venture capital is somewhat predictability. You know what they're looking for. You know how they make their money. You know what they're funding. And you can build a business that's aligned with that. And if you aren't, don't take that money. There are other ways to finance it.
Yeah, I would say in terms of like just regime shift around the world, obviously running TradingView makes it very challenging for us to work in 180 countries or whatever. But I will say we do have like a total startup mentality in terms of how we engage with each individual country. And hiring local is a key factor there. It helps us be extremely fast and nimble, which has been a huge benefit. And we really just came by that happenstance, but then realized that other incumbents were sitting in Silicon Valley or sitting in London trying to build models for like how to work in Australia or like how to work in New Zealand. And it's always best to have like local boots on the ground, even if they're consultants, because frankly, it just allowed us to get way ahead of other markets. And some markets have always been like that, like Japan as an example, but frankly, like huge help to like have them giving us local knowledge about the market ahead of time.
Yeah, that's it's changing rapidly. I just wanted to thank everyone here for coming into this panel here today, especially thanking Pierce, Johnson, Ethan, and Adam for all of your contributions. This has been pretty enlightening, at least in kind of like switching the sides of the story for us. For all of the founders out there, the constant failure, we started calling it falling up inside a Cosmic Wire, and it is just a constant learning process, and all of those failures are really helping you to hone in your trajectory. And I think the biggest thing that I've learned from all this is just execution and understanding your vision and your story, because if you're not clear about your story or where you're going, no one else is going to be. And that's the most important thing that you're going to sell if you're starting a company. You have to show people, what this is and paint the picture and show them every nook and cranny of it. And one of the most impactful quotes came from my chief strategy officer when we were halfway through, and it was just something: ideation without execution is hallucination, and you need to make yourself execute and get up every day and make that the point of the story that you're selling. So I hope this was impactful to everyone. There is a path to capital out there. Just keep going. And thank you all for the panel today.
All right. Thank you so much, gents. Thank you so much for the great discussion. I really appreciate it. I'd also like to thank you for braving the Benzinga sauna, apparently, because it is freaking warm. All right. Thank you very much. I'm told they're bringing fans in for those of you here. So from my mouth to God's ears, I guess we'll say. So from T+1 to continuous markets, the evolution of market structure. Here to lead this next discussion is Raisa Ashimovich, U.S. General Manager at ShareGain. We've got Harry Temkin, Chief Digital Officer from Drive Wealth, John Avery, Head of Markets Specialists, Americas, EMEA, Sales Growth Office, Capital Markets. What don't you do, John, at FIS? George Nario, Head of the Fidelity Center for Applied Technology, and Arjit Das, SVP Digital Asset Innovation Tech at Northern Trust. Thank you. Let's bring on our next panel. Let's give them a round of applause, please. Thank you. Do we have all the mics?
Testing.
All right. Thank you.
Hello.
Bottom of the ninth, third quarter,
Are we the
2-minute warning.
Are we the last one?
Got this. Second to last.
Second to last.
Good afternoon, everyone. Welcome to the panel and from T+1 to continuous markets, the evolution of market structure. My name is Raisa Ashimovich. Patrick is doing God's work, hyping everyone up and pronounce my name perfectly, which doesn't happen too often. I'm here today representing ShareGain. We are a capital markets fintech that enables retail-facing financial institutions to offer fully paid lending to their clients quickly, efficiently, and at scale. I'm honored to be sitting here next to my esteemed colleagues from Drive Wealth, FIS, Fidelity, and Northern Trust. And before we get into it, I'll let my guests quickly introduce themselves.
Cool. Thanks very much, Risa. I'm Harry Temkin. I'm the Chief Digital Officer of Drive Wealth, and I'm basically responsible for the digital innovation of the company. And what that means is I'm always thinking about how we take analog, traditional brokerage functionality and modernize it, make it available through a digital API. If you don't know who Drive Wealth is, basically we are the first cloud-based API-delivered brokerage as a service platform. You might say, what is brokerage as a service? Well, effectively, it allows our clients, our partners, to natively and easily embed investing directly into their web or mobile experience with literally zero traditional brokerage infrastructure. That's the key. The company was founded in 2012 with the mission to democratize investing. We were the first to build real-time fractional trading. Today, we support about 100 partners, ranging from digital wallets, neobanks, e-commerce platforms, broker-dealers, and RIAs making the move to digital. 100 of those around the world, and we support tens of millions of end users.
John Avery, FIS. Thanks everybody for supporting our panel here. I have actually been in the capital markets industry for about 27 years or so, and most of that time has actually been with FIS, and we're one of the largest providers of fintech in the markets today. We actually help many of the clients with their needs on both the sell side and the buy side. So we have a tremendous amount of experiences to share from our technology backgrounds in this space, and particularly the evolution and the history of settlement and settlement durations over the many years here as we look back. And we're helping many of our clients sort of look forward as well. So I am here representing a small team of thought leaders who actually help engage with our clients during the sales process. And we get to experience a lot of our clients' demands when they really first articulate, for example, what a broker might be thinking about, where they want to go over the next 5 years. Myself and my team get to experience and hear that firsthand. So really excited to share some of that with you all today.
Hi, I'm George Nario. I'm with a little company known as Fidelity Investment. I used to run capital markets. I was CEO of capital markets for quite a number of years, ran trading, and I said I had enough in 2017. And I was going to retire, but in reality, I was going to go back to my roots because I was originally a founder here in this area in the New York Stock Exchange. And then there made me an offer I couldn't refuse, which was to run FCAT. And so with FCAT, it's sort of like I'm a startup inside of a financial giant. And so we have a whole bunch of different things. We have incubators on blockchain, on digital crypto, but we also on real-time trading, on AI, on you name it, and we have it. And we often reach out to a number of startups and try to find relationships. If you want to, we also have quantum, so I can show you some quantum. We think we're the only ones that have 2 networks quantum that are actually working. So anyway, whether it's on the technology geeky side, and I'm originally a geek myself, or whether it's about the business issues and about the trading and about the trust and about T0 and all that other stuff, FCAT is a great way to, if you want to connect with Fidelity, FCAT is a great way, right? Because we're looking to partner with people of different backgrounds, different companies, from the very big banks to the very small ones, and with just figure out how to do things better in today's environment. So the cloud and all the stuff that we talked about here is where I live.
Thanks. I'm Arijit Das. I work for Northern Trust, which is a Chicago-based asset servicing, wealth management, asset management company. We have roughly about 15 trillion assets under custody. My team focuses on emerging technologies in the digital asset space. So we look at anything that is going to significantly change how assets are exchanged, how the life cycle of an asset is going to be made more efficient. And we try and work with the rest of the traditional systems to make sure we are coming up with solutions and eventually products which works seamlessly across both worlds. So I'm head of development of that piece, and my team really builds the POVs and the MVPs and even some of the production systems that we have, mostly using DLTs, distributed ledgers, but also other emerging technologies. We haven't quite done quantum yet, but certainly intriguing. Thank you.
Thank you, gentlemen. So just to set the scene a little bit, in May of this year, the US and a couple of other countries moved to a T+1 settlement cycle. By many metrics, this was a success. We're today talking about evolution, right? So before we talk about where we're going, John, you described yourself as a little bit of a historian on our last call. So do you mind just setting the scene and telling everyone how we got to where we are today?
Indeed. I'll set the scene real quick. And this is an interactive session, so I am going to ask you all to raise your hand at some point here for a little test. We just quickly, definitionally, for those that aren't aware what T means, it means today, right? If you're making a trade, well, then, and if you're making that trade today, that's T. T+1 means that something happens tomorrow. T+2, 3, 4, etc. just pushes the time out into the future a bit. I am a little bit of I've actually grown up around settlement cycles. I did a little bit of homework for this panel. And I realized that when I went back into the Wikipedia and looked at the history of settlement dates, I was actually born in 1975 when we went to T+5, right? There was some acts, there was some legislative activity I was not aware of in 1975, but sure enough, there it was, 1975. That means 1993, when I graduated high school, we went to T+3, all right? So you could sort of start to see the journey here. We were, T+2, 2017, and then 2024, T+1, right? Ideally, if we just waited a year for T+1, that, if there was any delays, it was a great rollout. But if there were any delays, I would have got to my 50th year here on T+1. So the point is, we've been on this journey for quite some time. Ironically, before brokerage-based trading in equities got really complex, sort of post-World War II, we were actually settling T+1 in the 1920s, right before the Great Depression. So this concept of settlement and settlement dates has actually been something that's been around for quite some time, almost for the history of Wall Street here, but definitely a lot of compression and acceleration in the, let's call it, the past 50 years. Now, I do want to do a little bit of a quick show of hands before we jump into the rest of the panelist discussion here. A quick show of hands. How many agree today is November 19th? Right, and that's sort of it's a trick question because everybody should agree. Now, yeah, it's about 50%. It does highlight
everybody else
maybe a bigger problem there. Now, if I asked you to tell me what time it was, and I asked you, is it 3:58 p.m.? You could raise your hand if your watch says 3:58 p.m. But the point is that there's actually less people who can actually agree on time inside the day. So some people might have a clock that says 3:58, 3:50. Some people have 3:57. Some people have 3:59. Whereas everybody agrees on November 19th, right? And the point is that there's a big leap to get from T+1, where you have a nice, clear, agreeable end of day boundary, to the point where you're actually doing things inside the day, right? And that's the crux of this panel discussion. We could probably spend an entire day talking about it, at least based on our prep call. But I'll stop the history lesson here so we can talk about what lies ahead, what is going on that you should all be aware of to really embrace and maybe take back, or have a deeper dive discussion with us after the panel. So hopefully that was helpful, Reza.
That was very helpful, and thank you for the little games. I did my homework too, and I didn't have any cool dates, that popped up. But in terms of how successful this transition was, the metrics actually did surprise me. Okay, so as of the end of September, DTC affirmation rates were in the mid-90s, which was above the recommended 90 rate, and then higher than 73% in January. Everyone in this room knows that doesn't just happen, right? So let's just now uncover the work that had to be done for that transition to be possible. Like, what are some of the catalysts? What are some of the technologies that have enabled us to be where we are today?
I can start if you want. I mean, we were talking about this before. I think the reason that T1 went so smoothly was because we actually did all the heavy lift to go from T3 to T2. And I remember when we did that on our technology stack back in 2017, I didn't realize it was 1993 that it was T+3, but it was pretty much hard coded. And so we had a brand new technology stack. As I said, when we built the company in 2012, we were cloud-based right from the beginning. And so we had made the investment in making that configurable and changing the systems to support T+2, which was a little more challenging back then. So I think we were in a much, much better position today. And certainly the technology has changed since 2017. I mean, we're completely cloud-based. The technologies that are available to us, even, we're in Amazon today, are much more advanced than they were in 2017. And I think from a scaling perspective and the ability, as an example, to have all of our ID confirms set before 8:30 in the evening when you finish trading at 8 p.m. because we go extended hours, so that you have everything ready for DTC at 9 o'clock. The technology, I think, to speed that up and have the efficiency to have all that complete in a short period of time was key. I think the other thing is, again, we've done a lot of really innovative things with our tech stack. We have an API that basically tells our clients exactly how much they need to settle with us, and we give that to them at 8 p.m. Many of them can integrate with that, and they can automate the process to actually then wire their funds to us next day. So again, I just think having done all the heavy lift back in 2017 well prepared us to go to T+1. And then again, just the emerging technologies and the way we built our tech stack, it kind of made it quite seamless. And actually it did go very, very seamless for us. You know, to John's point, I don't think it's as simple to go to T0, right? To go to real time, there is a lot of things that come into play. I mean, even just the most basics of if you're working with a foreign client and you know their wallet is in a foreign exchange, in a foreign currency, there's translation that has to happen before they can settle in US dollars, right? There are trade errors that occur that you need to handle before you actually settle, right? So I think there's a lot to have happen. I think the technology is making it easier for sure, and at some point we will get there. But the entire sort of ecosystem has to be aligned with that, right? Even other markets have to be aligned to do that.
So I like to take a shot at that. Definitely agree with what's been said so far. The reason why we were able to go to T1 is because of all the mindset thinking. But just to now go back in history a long time, the T5 was not the longest. In Europe, in the UK, for example, settlement there were 26 settlement periods a year, every 2 weeks. So settlement A started first 2 weeks in January, settlement B was the next 2 weeks in January, and so on and so forth. And we have T5 and we have T3. What it really came down to it is that people needed time to reconcile these systems. Before my time, I'm old, but not that old, but the exchange used to close on Wednesdays so that people would have time to settle. So the work that's being described here to bring in a real term, so what's happening is there's all of these systems, the front ends may be on real time, but there were batch jobs and processes that had to happen, and they had to occur overnight and over multiple nights, right? When the towers came down, everybody at Fidelity was telling me, "Oh, we're not going to run a batch cycle tomorrow, right?" I said, "Oh, yes, we are." And why? Well, because I got money sitting out there that hasn't settled yet, and every day we had that question. And so the real change to go to T1 is that all of these processes that were being fed, I don't even know in terms of question, do people here know what a batch job is, right? It's basically a job that you submit in the background and the computer works on it. That's really what has had to have changed. So going from T3 to 2 and now to 1, it was easier because we started thinking differently. So that's the behind the scene, why it used to take so long. I would like to take a different viewpoint on going forward. The timing is difficult, but the exchanges, not now, 10 years ago, implemented clock synchronization. So everybody that wants to trade with the New York Stock Exchange and with any other exchange, you have to have your machine synchronized. When you stamp a trade as A5213, we all have to have those things synchronized. I think the real obstacle now is less about technology and it's more about the support system. How do we get that money across real time, right? The trade-off of money taking a day or two to get to you and getting it real, it's not trivial. Anybody looking at the headlines, you see there's a number of fraud, right? There's a very large bank that had an issue where people were lining up to fraudulently do something with checks. So even today, so I would argue that yes, it's not going to happen tomorrow. I think we figured it out. Like for T1, my group participated in the test, but we had to make no changes because we have started to write our systems for instant settlement. So instead of having batch in our system, we do it real time. When you open a trade now, I compute the TLA, the tax lot accounting, so that you decide to. I do all that real time, and I just wait for the rest of the world to catch up to me. And I'm sure I'm not the only one. I'm sure there are other people doing that. I think the real problem is going to be instant settlement of money, and that is a whole different conversation. And you could see that can it be done? Yes, but the fraud factor goes way to the roof. I think that's the obstacle.
Yeah, if I could continue on the thread, right? So I agree with everything you say, and I want to emphasize that point, right? So going from T3 to T+1 yes, we had learned a lot from T3 when we went from T3 to T+1. But really going to continuous, the next one, next piece, that's a different ball game. Because fundamentally, all the systems have been designed to be batch oriented. What does that mean? That means the systems have a concept of a chunk of data and a point in time where I take a snapshot of the chunk of data and I hand it over to the next system to do its thing. Now, as you're shrinking this window, you can keep shrinking it, and you can do more intraday transfers, and you can do more real-time stuff. But at the end of the day, fundamental architectures are still snapshots, move the data, snapshots, move the data. But what I wanted to highlight is that there are some fundamental technical changes that are happening, which are going to change that, I believe, for the better. So one of them is that a lot of systems are moving away from transferring files for transferring information to things like event-based streaming. So we, for example, made a conscious decision some time ago to start implementing corporate-wide, streaming mechanisms with event-based. So what does that mean? What that means is that when an event occurs, a trigger then sends some sort of data stream to the next system to be able to react to it, rather than waiting for a certain point in time. It's more of an event-based triggering system. That's one thing that's happening, that's going to change. But the real big thing is, as we are going more into a distributed ledger type of technology with the markets which are continuous, those systems already have the ability to have information transmitted across the different participants at real time. The challenge is this has to work with your traditional batch oriented systems, because you're not going to have a DLT based system sit in isolation. Most of the assets in the world, 200 trillion of them, are in your traditional systems. You have to find a way to make them work together. And we have invested in a platform, and where we have put connectors in place so that you translate these events as much as possible using technologies like event-based streaming and other things. So I mean, I'll pause there because there's lots to talk about.
Great.
There,
We already moved into the forward part of the discussion, which is great. Last week when we spoke, we talked about this concept of retailification of finance, right? Of everything becoming more user-friendly, of expectations being that everything is instantaneous. Can institutions keep up with this trend of retailification?
I think so. I don't think it's something that people want to do, because it's going to cost a lot of money, and there are going to be people that say, well, the system works fine the way it works now. Why do we need it? I think what's raising the bar is that even if you think of the federal banking system as probably the most conservative thing in the world. Well, last year, or was it the year before? Last year they announced not one, but 2 real-time payments. So they went on May and said, Fed now, it's instant. And then a month or 2 later, real-time payment, RTP is ready. I think what that recognizes is what we all know, right? You have people come to your house, you pay them with Venmo, you use Zelle, you what? So the need is there. In countries that are less developed, it's actually happening. Like, that's the only way people transfer money, right? People have never been inside of a bank. If you walk the Great Wall of China, they have QR codes that you scan for that bottle of water that you need. So the reality of it is that in some way it's already been sold and adopted by the masses. But we now got to figure out, and again, I go back to the point, is the obstacles in my head, we have learned how to go around them. So what does that mean? Well, we got to start writing message real time.
Right.
We have to use event driven instead of waiting for a batch cycle to say, well, at 7 o'clock I'll start running. All of that stuff we learn. But it really comes down to it is, how can I validate that this transaction is real? Because once that money is gone, it's gone. And that's where I think you've seen things like cryptocurrency and all this other stuff. Well, guess what? Even cryptocurrency is not instant. You may see the stuff in the chain, but try to go buy it. You may see delays arranged for 30. So what it really comes down to is a series of regulations and a series of mindset changes that are going to be the ones that take it there. I personally think it's going to happen, and we might as well embrace it. But I also think it's going to make us think outside of the box, and there's still many patents that will be written on this.
I would argue that actually our company is already there, and I'll give you guys some examples. So first off, our communication between our partner, the introducing broker, the RIA, and us is all through a REST API within an associated real-time streaming event. So we use Amazon's SQS events, and for every API request that you make of DriveWealth, you get a real-time update. So once you actually create the user and create the account, everything that occurs, right down to a corporate action on the account, status change on the account in order, you now get an event you just listen for and update your data store. So we're already kind of at a real-time interaction with our clients. The cash available for trading, the cash available for withdrawal, the positions, how much is available to trade, everything is in real time and is updated in each and every event that goes back to the client. Now, on the other side, on the back end, right, there are still batch processes, right? There are still files that are created, right, with DTC or with other custodians and so forth that, will need to be enhanced. But I think what we've been able to do with our technology is actually create that instantaneous interaction between a brokerage account and a wallet. So one of the things that we created is something called cashless brokerage. There's never any money in the brokerage account because all the money resides in our partner's digital wallet. They are the account of record, okay? And the experience that they wanted to create, the Cash Apps of the world, the Revoluts of the world, the Tosses of the world, is they wanted the experience of, buying a cup of coffee with your debit card or your phone right out of that digital wallet to be exactly the same experience as buying $5 of Starbucks stock or $5 of Apple. And so our technology actually enables them to directly have the money come out of the wallet when they purchase securities. And more interestingly, when you sell securities, the money in real time flows directly back into the wallet. Now, under the covers, we settle T+1. So from a regulatory perspective, it's all fully regulatory compliant. We're not sending any money back before it has settled. But the partner, being a payments company, can provide effectively an interest-free, unencumbered loan to the client, no different than advancing a deposit of your, check, your paycheck 2 days ahead. And then we settle within the next day, and they take that little short-term risk to create this incredible embedded experience. And so what happens is the technology enables what was once a very bifurcated experience, right? Here's brokerage in this app, and here's banking in this app or digital wallet. I have to onboard over here, and then I have to send money over there, and that takes a day or two, and then to get the money back takes a day or two. Where we are now is the onboarding is instantaneous, and then the transaction comes instantaneously after that. So I can go from not having a brokerage account to instantly owning stock in seconds. Now, with the evolution of 24-hour trading, imagine a world in which it's 2 o'clock in the morning and, I need access to $100 that's invested in Apple. I could sell that stock overnight in the overnight session and have instantly access to that $100 to spend on the debit card, right? All being done in a compliant way. So the back end, yes, still has some batch processes to make the settlement work. But at the front end, we actually are now literally simulating a real-time interaction between investing and the digital wallet.
And I think most of us there. What I'm saying is the cycle banking also needs to be there.
Oh, no, 100%, right?
Because otherwise you can provide a buffer of money, but up to a certain point.
And that's this is very important, for you all to take away. The experiences, the real-time experience you might have just transferring cash, right? Now, on a retail basis, we're all retail investors here. So the amount of cash that we're ever moving with a fintech app is going to be relative. There's going to be some boundaries around that. Retailification of the trading experience is such that we by moving cash in real time, in my case, probably some of my kids are moving cash in real time all the time. Their expectation of trading is that it's real time and it's 24/7. So they're going to demand it. They're going to demand a real-time user experience. Now, even if settlement doesn't happen right away, you might have real-time settlement for cash. You might have real-time payments settlements on the RTP or the FedNow rails. But when settling the actual regulated securities, equities transaction might not be in real time. But I think the retailification user experience is the real sort of key message here, is that is an expectation. Either it's already in market or it's an expectation, and folks are building to that already. The other point I wanted to make is that there is when you start to think about retailification, it is a bigger journey for institutions to get there, right? And I'm going to throw out some big numbers like, let's say call it $2 trillion or so, give or take, probably a couple $100 billion. I never really normally get to say that, but I'm saying it here. But $2 trillion of settlement a day, right? That's sort of, just think about the U.S. securities industry settlement happening daily. That's a big number. So obviously there is a potential, there's a lot of risk if you get any of that settlement wrong. Retail is let's call it 20% of that number as well, right? So it's not as big of a risk in retail, but that's where the innovative trading real-time experiences are going to come, and expectations, which is really cool. But I think to George's point is that you're trading an asset in return for cash. So you can't just look at the asset in isolation. You have to look at the end-to-end flow of what's real time from a end user trader perspective, and then what ends up happening behind the scenes. And that's where a lot of the exciting innovation and technology comes, to actually make that stuff that happens behind the scenes happen faster, right? Not just T+5 or T+3 or T+2 or T+1, but actually, starts to do things in more of a real-time basis, so that, when the entire environment of, I think there's about 600,000 registered FINRA reps around the United States just working in the securities industry. There's a lot of people that need to conform to a faster settlement cycle. So that's going to take some time and effort. But I would argue, based on what we heard today, that a lot of the tech is already there. It's waiting for everything else to catch up.
Just last question, before we wrap up. Is there a big tipping point coming up, or is it just a lot of small tipping points? Like, what are we, in the context of continuous markets, what are we going to be talking about next, Benzinga?
I think the tipping point is that all the stuff that we hear in different ends of the world, emerging technology, is going to start making an impact. We've always, for example, done back testing for trading. That's the notion. If I bought it a year ago, what would it have made? Well, with AI, and there's a lot of hype, so much hype about AI, but there's some real capability. It is so easy now to apply AI to a world where you could make that calculation and with a much better precision. I think that's going to start showing up initially in back office to help things happen. We're going to be a little bit more judicious about bringing it into the public, because we have to. What you guys are missing is all of us sitting here, we're burdened by tons and tons of regulations, right? There's regulations that have been written over the 50 years. We're still calculating SEC fees, even though we may not use them, and so on and so forth. So is it going to happen? Absolutely. I think you're going to get emerging tech, meaning even people are going to want to trade. We foresee a day where people use Discord to check their balances. So we have a bot today that does that, right? And this is all experimental. Remember, I'm speaking on behalf of the Center for Applied Technology. I don't want people to say, hey, Fidelity said you could do this. But we are already there, and we are already doing virtual stuff. And so the answer is yes. I think it's gonna get even better than what it is now. But have a little patience, because at the end of the day, we got to settle all of this, and fraud is everywhere.
So we are out of time. So I just want to make one point, okay, to what you were saying. The front end being real time, but in the entire cycle, there are pieces that are not. So there is someone's carrying that risk, and that has a cost. So unless that thing can be optimized, you're not going to get that benefit to the end user. So we got to look at the entire ecosystem. And the tipping point is probably regulations in my head.
Thank you, everyone. Thank you, gentlemen.
Thank you.
A wonderful way to end that panel. Thank you very much, my friends. Much appreciated. Thank you so much. And also thank you to the venue for the fans. We very much appreciate it. We'll get some airflow in here. Thank you. Thank you very much. Ray's a wonderful job. Thank you. All right, my friends, our last session of the day, just a quick reminder, right? We're going to take just a brief break. We'll resume at 5 o'clock after this session, and we'll get right into our awards, okay? The awards will be right at 5. So this last session, AI's role in elevating compliance and security in fintech. Moderating is Ian Carr, founder and CEO of Arcana, and Will Lawrence, co-founder and CEO, Greenlight. Gents, come on out. Let's give them a round of applause, please. Thank you.
Hey, can you hear me, but you can't hear you in there.
Hello? Okay. What's up, everybody? Thanks for joining us. Very excited to talk about AI and banking. I think obviously a lot of us have been reading about it. Will is in the trenches building it. The CEO and co-founder of Greenlight. Will, why don't you start off by telling us a bit more about Greenlight?
Yeah. Hey, everyone. Great to see you all. I know we've been talking a lot about AI today, so happy to spend a little bit more time on it and even talk about where we think their best applications are within banking and financial services. So I'm Will. I'm the co-founder and CEO over here at Greenlight. We build AI agents for compliance teams at financial services companies. SEC, FDIC, and OCC regulated institutions already use Greenlight to scale up their compliance as opposed to over-hiring or relying on outsourced teams. I think a theme that we'll talk a lot about today is this wave of AI that we're talking about a lot is language model driven. And language model is really good at some of those back office tasks we see across financial institutions. And I think that's where we're seeing a lot of the pull here at Greenlight, and happy to dive into that a little bit more.
Yeah, I mean, I'd love to hear a little bit more about, some of that market pull and what you sort of think banks are looking for from potential vendors in AI and what they're looking for from a product perspective.
100%. So I think efficiency is the top theme we hear across most of the institutions that we're working with. Everyone's trying to find opportunities to improve their profitability, but also making sure that they maintain their regulatory posture. And so I think a really key area for people to be looking at is we're looking at their cost centers as a starting point. Almost the prototypical examples of generative AI involve customer success. Another one we're seeing a lot is compliance. Why are those areas of focus? It's because they're large cost centers within most financial institutions. And they're also things that rely on a large force of people to staff those operations. Those operational staff might be here in onshore, or they could be offshore. Whenever I see big pockets of individuals doing repetitive work, I think those are great opportunities for generative AI. And banking executives seem to think the same thing.
So yeah, I mean, I'd love to hear a little bit more about how you guys are actually automating that manual work. I mean, I think for those who don't know, the compliance analysts do a lot of manual research into things like knowing your customer, knowing your business. Will, you can talk ad nauseum about this, but I'd love to hear a little bit more about how these workflows are actually being automated and the benefits that that your clients are seeing.
Yeah, sounds great. And I'll actually share a quick story about this. Prior to Greenlight, I used to lead the product team focused on anti-money laundering at Facebook Financial. And just to share the shape of this problem in compliance, what we often see is a two-part problem. The first one is detection of compliance risks. In the anti-money laundering space, that often requires traditional machine learning methods to detect things like suspicious transaction patterns or people who might be risky for the institution to work with. That's a very traditional problem, and it's the domain of the neural networks and supervised machine learning that we've seen over the last 15 years. And that's what my team really focused on. But whenever a risk was detected, it was almost sent over this invisible fence to a human team. Those might be investigators or analysts. And when you look at their workflow, it's not nearly as sophisticated, unfortunately, as a lot of those detection tasks. Again, looking over their shoulder and answering the question Ian shared, they're following a set of standard operating procedures. That might involve things like, let's Google that customer's name. Let's review their documentation they have on file. Let's review their last 12 months of transaction activity. Working through a checklist in many ways to make sure that they can address the risk and show an audit trail of addressing that risk. And you may have heard this meme almost of AI is like a smart intern. I think we've gone past intern a little bit to almost this entry-level employee. And I think every couple of months we're moving up that scale. So it goes to the question, if you're looking at a financial institution, where do we see a lot of those entry-level employees? And they're in those functions where doing those standard operating procedures, execution of those standard operating procedures. So our goal at Greenlight, and what we're seeing from some of the most successful AI agent companies in our cohort here, are they're looking for big pockets of operational resources dedicated to solving almost checklist-style problems and deploying agents that can do those workflows in a more automated way. And again, because those often sit in cost centers, it drives up to this key theme of efficiency that we're seeing across financial services.
So these cost centers are being a lot more optimized. What does the future look like after we sort of get past this like messy middle of like automating the rote work?
Yeah, so in a lot of these, in compliance and customer success, they're actually really, they almost seem like they're opposite ends of the spectrum, but they're all share the same paradigm of different layers of handling of an item. So in customer success, if you reached out to someone, you'll probably get hit with their L1 team, their layer 1 team of customer success analysts or support team. Those people can handle about 80 to 90% of the routine customer requests that are coming in. And if they can't handle it, the 10 or 20% gets escalated up to a layer 2 customer success team. I draw that example because it exists in pretty much every or many operationally heavy parts of financial services. It's the same with our world of anti-money laundering. If an L1 analyst cannot handle the task, they'll escalate it up to the L2. Why do I spell that out? It's because we're currently in the process of automating the L1. Can't do end-to-end to it right now. I think give the industry 3, maybe 4 years to do the full automation of that L1 work. That unlocks a lot of resources for more complicated work and more proactive work, which we're really excited about. And ultimately, we'll probably redeploy some of those resources towards either L2 functions, which are more complicated investigations or complicated work, or into a more proactive measures like policy or regulatory relationships. And so I think that's the trend that we're seeing. If we fast forward 5 years, I think we'll see even that L2 start to get automated a little bit more. Again, what is this doing? And the same thing in the L1 layer. They're creating more operational efficiency, unlocking resources from some of this repetitive work, and ultimately redeploying those resources. My strong belief is that the operational teams are the ones that can feel the change of generative AI the most, and these often sit in the back office, not necessarily the front office. Maybe it's a hot take, especially I see a lot of the teams out here. I think AI for the front office is still going to be very much focused on the supervised machine learning that we've seen in the past, predictions, trading, execution. Language models are not that good at those types of things. I wouldn't trust a ChatGPT to make trades. I don't think that's the right use of that technology, and it wasn't meant for that. It's really good at doing operational tasks, which is why we'll see the deployment on the back office.
That's super interesting. I think you mentioned, you give us like this nice little time frame. I think a lot of us here have been reading articles in the Wall Street Journal and other places, obviously Benzinga too, but about how there's a massive gap between the expectations of what organizations are expecting from AI products and what the reality is. So what is the chasm there? Like what's happening?
It's a really good question. And I think it's the chasm is created from the first products that they're using. Most organizations we speak to, their first gen AI product is like Microsoft Copilot or something that came from Salesforce. And while those are good, they're almost definitionally broad. They're vague claims around productivity improvements. And that's a really hard thing to measure. Our entire team is using GitHub Copilot. That's great, but I can't tell you how much more effective that's making our engineering team. And when you have a use case, your first deployment is on a fairly vague use case with unproven ROI, it makes it challenging to continue to do that, to invest in those initiatives. I would certainly be skeptical myself. And so what we've tried to do is really try and do AI with ROI in a fast time frame. We always start with a very small use case that they can deploy in about a month and a half, and shows tangible benefits in the forms of cost efficiency gains, quality improvement of handling, or just better consistency of handling of the cases that we do. So to answer your question, I think this chasm is created because often we're starting with these very broad products that have a pretty unspecific claim of generating more productivity for your team. Where we need to go as an industry is adopting things that solve a targeted problem, something that is tangible, and something where there's a time frame for ROI, where you can look back in 2 months and say, did we hit our goal? Otherwise, we're going to be stuck in this chasm of proof of concepts for a very long time.
Yeah, it makes a lot of sense. Back to the time frame, because I'd love to hear a little bit more about, when can we see a lot of these efficiencies? I think already we're seeing it on the cost center side, but where, are we going to see mass Gen AI adoption in banking in 2 to 3 years, or is it going to be 5 years or 10 years? And we'd love to hear a little bit more about your thought process there.
Yeah, I think I'll share a very opinionated view here. Is if we use Gen AI in the back office, what that's going to unlock is capacity to do more new initiatives. I'll give you a really clean example. When I was working at Facebook Financial, we would do international market launches for new products. So we do peer-to-peer payments. For example, I can send you money on WhatsApp or Messenger. Every time we want to launch into a new market, we need a new compliance infrastructure to do so, right? Handle the operational load, handle fraud, handle chargebacks, things like that. Now, what if you could solve for that and you can scale up with the amount of users you're using because you use an automated system instead of bodies? You would just go into new markets faster. So my perspective on how revenue will be generated through these generative AI initiatives is by automating the back office, you'll allow more market expansion, more product launches from the front office, essentially, to allow you to generate revenue on that side. Again, I'm not optimistic that we'll use Gen AI traders to do own our trading flows. I don't think that's a good use case. It's going to just unlock capacity to do new initiatives. The time horizon for that is not 5 years. I think we're going to see that in the next 2 to 3 years. 10 years out, I think we're going to see different staffing models for back office staffing. Today, the dominant model is you hire people or use some outsourced bodies somewhere in the world to do the key operational workflows. We're excited to be pioneering a third kind of category here. We call it the AI managed service. So rather than using a managed service for like customer success or compliance, you use an AI managed service that ramps up or down with your volumes to make sure that you can handle the workload that's coming up, regardless of what time of year it is or what products you've just launched.
And it's super interesting from a sales process. Correct me if I'm wrong. It's something that the banks and institutions are already very familiar with, right? So you're not selling them something brand new, right? You're selling them something that they're familiar with, but also is much more tech enabled, much more optimized for their needs.
Right. And I think in our space of compliance, the status quo is just not working. Financial institutions, it seems like every week or every couple of days are getting fined for non-compliance because they have these large backlogs that have been accrued. You probably have all seen the multi-billion-dollar fine for TD related to anti-money laundering that dropped about a month ago. If you dig into that, it was a lot of controls were missing or unstaffed. You fast forward, rewind a year ago, we had large fintech companies getting multi-$100 million fines. So the status quo is just simply not working because there's a real gap in the amount of capacity we're putting at these problems. So teams are really looking for ways to fill that gap now, and regulators are very active. And so I go back to this point. It's not a question of, should I invest in it? It's like, how am I going to solve this capacity gap? And you can hire more people, but we don't have budgets like we used to have in 2021, 2022. Or you can use some new technology to introduce automation as opposed to throwing more bodies at the problem.
I think we are coming up pretty close on time. And I'd love to hear, Will is one of the few people that I know that is deeply experienced in compliance and AI and crypto. So I'd love to hear your perspective on, maybe you could tell us a little bit about your crypto background as well. But I'd love to hear your perspective on AI agents and crypto and stable coins. I think I've been reading a lot about that too recently. So I'd love to hear your thoughts.
Yeah, we were just talking about this one backstage. It's a really funny topic. So I used to work at a company called Paxos, which is an NYDFS regulated trust company that also issues stablecoins. I'm extremely strong believer in stablecoins as another payment rails that allow us to actually have more easy global trade and more efficient global trade. That said, I've heard a lot of the pitch for let's say wallets for agents or stablecoins for agents. I just don't think we're there yet. More from a regulatory framework. Agents are going to, in the short term, be operating on behalf of someone. And as you know, you're going to need to KYC someone to facilitate money movement. So if an agent was working on my behalf, I would assume I'm still going to be KYC'd, and it's going to be my wallet on the line. I don't believe you'll have truly autonomous agents for a long time that actually handle payments and stablecoins. But in the 5-year time horizon, who really knows? As we have already seen, smart contracts are a light version of agents. They don't rely on people to interact, to release or receive money. So I think we'll just see better evolutions of that. There have more conditional logic in place to do more complex operations or trades.
That's a great point. That's a great point. And then just to wrap things up, would love to, what's the biggest takeaway that you can share with everyone for the next 12 months about Gen AI and banking?
Yeah, I think really the opportunity right now, as it currently sits in the next year or two, is how do we get more efficiency out of our operation? I don't think we're in the mode right now. We're deploying it for revenue generation. And so as you go back to your organizations and you're thinking about how do I get more efficiency? How do I do more with less? How do I grow faster without simply throwing more bodies at the problem? Look to the spots where you have large headcounts doing repetitive work. That work can either be done by leveraging a partner like a Greenlight, or you can also build a lot in-house. We're huge advocates for building LLM-based workflows in-house to automate your company's specific processes. So I think it's not a far off horizon. Don't think about it too far. It's as like this 10-year horizon. It's really, you can start to use that automation today to unlock pretty meaningful efficiencies wherever you see large bodies collected in your organization.
Awesome. Thank you so much, Will. Really appreciate it. And where can everyone find more info about Greenlight?
Yeah, feel free to connect with me on LinkedIn. Happy to chat through any parts of your AI strategy or compliance strategy, or feel free to get me after this this panel.
Thanks, everyone.
All right. Thank you, gents. Very much appreciated, as always. Thank you. Thank you, Ian. All right, my friends, I'm going to close us out. Again, we have a brief break. We're back in here at 5 o'clock to start our awards. So to close us out for our day of content, especially for those watching at home, I'd love to bring out a good friend, somebody who's been with us for, nearly the beginning. Rob Hoffman, founder, CEO of Wealth Charts. Let's give him a round of applause. Rob, close us out, my friend.
Thanks so much, Patrick. What a great day, right? How many of you have gone ahead and made some sort of connection today with somebody? Raise your hand. Look at that. Pretty much basically everybody in the room except for the guy taking the picture. I mean, isn't that an exciting day? I mean, if you went and didn't have a connection today, then the problem might be with you, because everybody here, I saw everybody talking with each other at our booth. There were so many people there. It was so great. The talks that we had today, earlier today, I was teaching you how to build, scale, and launch fintech businesses. People came up and talked to me about that afterwards. Every single one of you is given a phenomenal opportunity, and I want to thank Benzinga for going ahead and doing just that, giving us this format, because how many formats do we have like this where we can get together with our peers and talk about how we can work together, how we can do business together, how we can innovate together, build new relationships, grow and expand, our networks. What a phenomenal event today. And I was super excited to be a part of it. And I see people in the audience here that I've gone ahead and talked to today. And, thank you for that. And so what we're going to do now is, so we've got about a little less than 30 minutes, about 22 minutes. I think we're going to start the awards. And I'll bet you some of you in this room are probably going to be winning awards today for your innovation, for your contributions to the fintech industry. And so I just want to thank everybody for being here. Thank you for Benzinga for hosting such a phenomenal event. I don't know about you guys, but I'm looking forward to being here next year again as part of this very special event. I've loved coming here over the years. And, so thanks again for all of you that stopped by with us, talked to us today. And let's have a great awards ceremony and then spend some more time networking afterwards. So thanks, everybody. Let's have a great rest of the evening. Bye-bye for now.
Testing, testing, check, test, 1, 2. Test, check, 1, 2. Copy that.
Ladies and gentlemen, welcome to the 2024 Fintech Deal Day Awards, proudly presented by Wealth Charts.
All right, are we ready? Are we ready? Wow, that was a dream come true for me. Thank you. I want to welcome up a couple of people. I'm going to give you some instructions. We're going to move through this thing. It is hot as hell in this room. You've been here all day, so we're going to move quickly. Here's your instructions, right? I'm going to, in the very beginning, I'm going to do a quick slide for some of the folks that couldn't make it, right? So the folks that couldn't make it, I'll get that out of the way first, but I want you to know who won and who the runner-ups were in those categories, right? So we'll do that first. When I call the category, I'll do the runner-up. Nothing is needed from you runner-ups, but thank you, right? Nothing is needed. I'll call the winner. Please come up to the stage. No remarks. I know you're disappointed. No remarks. Come to the stage. We'll have Jason Raznick, our executive chairman, and Jerry Ferrara, our CEO. Come on up. They'll be our Vanna Whites for a quick photo opportunity, right? We're going to move quickly here to get all of you to really what you want, which is the alcohol, okay? All right, my friends. So, Joe, if you wouldn't mind, let's put our slide up of our friends who could not make it. It's here, and I think over here, I'll give you a quick preview of this. Best portfolio tracker, the runner-up is TradeZella. The winner is Delta Investment Tracker. Best robo-advisor, the runner-up is Titan. The winner is Wealth Charts. The Wealth Charts is here. I don't know why it's fine. We'll get to it. You're literally right up front. Best social investing platform, runner-up is Tradeverse. Winner is Parrot Finance. The award Best InsurTech Company, the runner-up is Milo. The winner is Infinio. The award Best Brokerage for Trading Futures. The runner-up is Ninja Trader. The winner is Edge Clear. The award for Best Portfolio, no, we already did that one. Best Portfolio Tracker, we already did. Let's give a round of applause to our friends who could not make it. Thank you very much. And now right into it. Best Alternative Investments Platform. The runner-up is Ground Floor. The winner is Arrived Homes. Arrived Homes, are you with us? Come on up. Let's give them a round of applause, please. I appreciate the music from the soundtrack of Air Force One. That's great. Thank you. Thanks very much. Congratulations, Arrived Homes. Next up, my friends, Best API Solution. The runner-up is Drive Wealth. The winner is Polygon.io. Polygon, are you with us? Come on up this way, guys. Thank you, thank you. Look right there in the center for us. Never seen so many men on stage. This is great. Here we go. YMCA, we're going to do that? Okay. Best Automated Trading Software. The runner-up is Algo Bulls. The winner is TickBlaze. Where's Sean? Come on up, Sean. Thank you very much. Joe, we can make that music a little louder. That is great. Lovely. Wonderful. Thank you very much. All right. Best Broker for Sophisticated Traders. The runner-up, TradeStation. The winner, Alpaca. Alpaca. Awesome. There we are. Wonderful, wonderful, wonderful. Right there in the middle, fellas. Thank you. All right, Best Brokerage App. Best Brokerage App. Runner-up is TradeStation. The winner is Webull. Weeble. There we are. Yeah. Yep. What a fancy jacket. Awesome, awesome, awesome. All right. Best brokerage for beginners. Best brokerage for beginners. The runner-up is eToro. The winner is Stash. We have Stash with us tonight. Stash. I don't see Stash with us. We'll keep moving. Thank you very much. All right, I'll give a quick shout out. Thank you to those of you who came from overseas, right? I know many of you came from Europe, from Israel, from the Asia Pacific. So thank you again for being here. We really appreciate it. Best brokerage for day trading. Best brokerage for day trading. The runner-up is Moo Moo. The winner is Trade Up. Is Trade Up with us? There we go. Cheers, cheers. Yeah, absolutely. This way. Thanks. Great job. Oh, even more applause. We like that. Thank you. All right, my friends. Best brokerage for Forex in the U.S. Best brokerage for Forex in the U.S. The runner-up is IBKR. The winner is Trading.com. Trading.com. Are you with us? Yep, right over here. Awesome. Best brokerage for options trading. The runner-up is First Trade. The winner is IBKR, Interactive Brokers. Are you with us? Here we go. It's a great bow tie, isn't it, you guys? Who likes a bow tie? Raise your hand. Yes, we love a good bow tie. There we go. All right, best brokerage for short selling. Runner-up, IBKR. The winner, Trade Zero. Where is Mr. Pipitone? There he is. I'm not going to do that. Yeah. No opera singing tonight. I'm sorry. What? Well, we won't talk about that. Yeah, right? Best brokerage for trading futures. We already did this. Now, the runner-up was Ninja Trader. The winner is Edge Clear. They could not be here tonight. Oh, do we have Edge Clear with us? Nope, just maybe looking for a stretch? Okay, cool. We'll keep going. Best Canadian brokerage. Best Canadian brokerage. The runner-up is Q Trade, direct investing. The winner is Quest Trade. Quest Trade, are you with us? Yes. Come on down. Anybody know the Canadian national anthem? Anybody? Yeah, Oh Canada? Thank you. I don't know the song. I'm not from Canada. I don't know Oh Canada. I'm sorry. Come on up, my friends. Thank you. I feel like I want to storm a castle with this music. This is very good. Right there in the middle. Wonderful. Thank you, guys. Thank you. I'm going to keep going. Best data analysis tool. Best data analysis tool. The runner-up is PitchBook. The winner is Northern Trust Investment Data Science, their equity data science tool. Come on up, my friends. I should mention, too, there are two different categories of awards here. The one category are those I use the word category freely. Those categories that a lot of companies applied for, those were judged by the Benzinga editorial staff, right? And we also have our Chairman's Awards, which we'll be doing after that, right? So if you have any questions about that, let me know. But those are the two categories. Best day trading software. Best day trading software. The runner-up is TickBlaze. The winner, IBKR, Interactive Brokers. Let's get that bow tie back up here. A bow tie for you? Thank you. Best ETF launch. Best ETF launch. The runner-up, X-Trackers U.S. National Critical Technologies ETF. That's CRTC. I know, right? The winner, iShares Bitcoin Trust. Are you with us? Yes. Fairly timely, I hear. While we're getting this photo op done, I'd love a round of applause for my Vanna Whites, Jason Raznick, and Jerry Ferrara. Thank you very much. Thanks, fellas. You want to take off that way? Thank you. Best financial literacy tool. The runner-up, MoneyLion Digital Financial Ecosystem. And the winner, Financial Finesse. Financial Finesse. There we are. Good looking crew. Best financial planning software. The runner-up is Origin. The winner, Asset Map. Asset Map. Are you with us? Asset Map. Nope, I don't think so. Keep it rolling. Best financial research company. The runner-up is EPS Momentum. The winner, Toggle AI. Toggle, are you with us? Right here. Jerry, have you ever smiled this much in person? I don't know. Best in financial education. Runner-up is TradeStation. The winner is the Options Industry Council. You with us? OIC. Right here. Great job. Best InsurTech company, InsurTech. The runner-up is Milo. The winner is Infinio. Infinio, are you with us? Right here. Best investment research technology. The runner-up is Outperform. The winner is Trading Central. Trading Central, are you with us? Nope. We'll keep going. They're here, Trading Central? Yes, we are. I do want sprinters. If you're not running, you're out of here. That's exactly right. Amazing. Thank you. Best lending solution. The runner-up is Prosper. The winner is Pagaya Technologies. Pagaya, are you with us? Pagaya. All right, we'll keep going. Best matching engine. The runner-up, EP3 by Connemara Technologies. The winner, DevExperts DX Match. And they're with us. Come on down, guys. This feels a little bit like The Price is Right. I'm not gonna lie. All right, thank you. Thank you. Best paper trading platform. The runner-up is Charles Schwab, and the winner is Trade Zero. Trade Zero. Thank you. Thanks for running, Dan. I appreciate that, buddy. Double the hardware. Okay, best payments solution. Runner-up is AeroPay, and the winner is Modern Treasury. Modern Treasury, are you with us? Modern Treasury. All right. Best prop trading platform. We only have one winner here, and it is IBKR. Interactive Brokers, come on up. You didn't want to carry all your trophies back up here? All right, my friends, thank you very much. Best RegTech tool. Best RegTech, the runner-up is Core with a K, Core. And the winner is Green Check. Green Check, Kevin Hart, come on up. Best social investing platform. The runner-up is Traderverse. The winner is Parrot Finance. Parrot Finance. You with us? Okay. Best software for long-term cryptocurrency investments. The runner-up is iTrust Capital. The winner is Path Crypto. Path, are you with us? Path Crypto. Cool. Best software for swing trading. The runner-up is Wealth Charts. Wealth Charts. The winner is Auto Chartist. Automatic trade identification is Auto Chartist. There we go. Great job. Best software for trading cryptocurrency is up next. The winner is DevExperts DX Trade. DX Trade. Come on down, guys. What? Quite a few. Yeah. Welcome back. Do you need a break, Vanna Whites? Do you need a break? It's like the Oscars. You want a seat filler? Where's Andrew Lebos? Andrew, you want to come on down? Come on down. Come on. Jason's tired. Let's get him a blanket, maybe a glass of warm milk. Be great. All right, best trading technology. Best trading technology. The runner-up is TickBlaze. The winner, GTN. GTN, are you with us? Yes. All right, right there in the middle. There we go. Thank you. Best venture capital firm. Best venture capital firm. The runner-up is Bank Tech Ventures. The winner is Tribe Capital. Tribe Capital. Come on down. Great job. Thank you. Breaking Barriers is our next award. Breaking Barriers. The runner-up, Apex Trader Funding. The winner is GoTrade. GoTrade, are you with us? Great job, thank you. Emerging InsurTech is next. The runner-up is TrueStage Payment Guard. The winner is Aspida. Aspida, are you with us? Oh, the Swaggers, right? We had a whole panel about Swagger earlier, led by our friend here. Thank you. All right. Next up, institutional innovation. The runner-up is Quinn. The winner is Tipico. Tipico Insights. Come on up. Great job. Most innovative ETF company. The winner is StockSnips. StockSnips, are you with us? Great job. Most innovative in capital markets is next. The runner-up, Open Yield. The winner, GTN. Come back up, please. GTN. Great job. Thank you. Best new product. Best new product is this category. Always a popular one. Runner-up is SoFi Alternative Investments. The winner is Freck. I hope I'm pronouncing that right. Freck. All right, good. I got the thumbs up. All right. Final two in our categories before we get to our Chairman's Awards. This is always a good one. The most impactful FinTech executive. This year's award goes to none other than Anthony Denier. Come on up, sir. Congrats, Anthony. All right. Last one of our categories, People's Choice. People's Choice. This was the social voting that was done online in addition to your application. The People's Choice winner this year is Investly, social investing. Thank you. All right, my friend, the Chairman's Award. Okay. Come back to that one. Chairman's Awards. Best AI Chat API. The winner, FinChat. Come on down. All right. The Chairman's Award for Best AI Finance Startup goes to Winston.ai. Winston, come on down. Right in the middle there. Preserved for posterity. Thank you very much. All right, we're going to stay in AI for the next couple. The Chairman's Award for Best AI Research Platform goes to Quasar Markets. Big beat! Come on up, baby. Thank you. Staying on brand, best AI tool for software performance. The winner is Tech AI, Tech. Tech, you with us? All right, we'll keep going. The Chairman's Award for Best Backtesting Software, FX Replay. FX Replay, are you with us? All right, we'll keep it moving. The Chairman's Award for Best Fraud Prevention Solution is ID DataWeb. ID DataWeb, there we go. Thank you very much. The Chairman's Award for Best Gold Broker. Gold Broker is Multibank Group. Multibank, are you with us? All right, we'll keep rolling. The Best Hybrid Trading Solution, the Chairman's Award goes to TickBlaze. Sean, come on up, brother. All right, great job. Chairman's Award for Best in Customer Loyalty goes to Cartera. Cartera, are you with us? There we go. Look at that suit. Great job, pal. Best Shareholder Engagement Platform, the Chairman's Award goes to Ticker. Ticker, come on down. Well done. The Best Stock Scanner. The Best Stock Scanner, we've got Wealth Charts. Come on up, Rob. Great job. Oh, okay, more. So many photographers. All right. The Chairman's Award for Excellence in Democratizing Options Trading. The winner is Sensa Market. Sensa Market, are you with us? Yes. A handful more of these, my friends, and then it's all the booze. The Chairman's Awards for Excellence in Futures Education goes to Ninja Trader. Ninja Trader, are you with us? Okay, thank you. The Chairman's Awards for Excellence in Futures Prop Trading. The winner is Apex Trader Funding. Apex, are you with us? Yes, Daryl, come on up. Well done. Chairman's Award for Excellence in Holistic Trading Education. The winner is Piranha Profits. Piranha Profits. Chairman's Award for Most Innovative Leveraged Issuer. The winner is Microsectors. Microsectors. Thank you very much. 4 more to go. Most Innovative Options Brokerage goes to Tradier. Dan Raju, come on down. Great job. The next one, I'm not sure if I've read this, so I'm going to read it again. Most Innovative Prop Trading Firm for Traders. Most Innovative Prop Trading Firm. Thank you. Come on down. Two left, my friends. The Chairman's Award, Best Software for Trading Futures. The winner, Optimist Futures. Optimist Futures, are you with us? All right, we'll go back to our last award of the evening. The Chairman's Award for Best AI Analysis Tool. The winner is True Trading Group. Adam, where are you, buddy? There we go. Thank you. Let's give it up one more time for all of our winners, all of our runner-ups. Hundreds and hundreds of applications we received. Thanks to all of you. Thank you to my Vanna Whites, Jerry Ferrara, Andrew Lebos, Jason Raznick for when he wasn't tired. Really appreciate that. And last but not least, we could not do this without all of you, all of our sponsors, our supporters. We are here for you. After this conference, this does not end, right? We have API suites that we're happy to talk about. We have news, we have data, we have other events. Benzinga is just now, even though this is the 10th year we've been doing this, we're just now getting started. Thanks to each of you. Go get a drink.